Good morning, what's up, guys? Thanks for joining me once again. We are here trading live this morning. So today we woke up and we've got a couple things happening right now. The markets are down big. Looks like our TLT bonds are gonna be up, and more buying pressure is gonna send us to some higher levels here. Gold is up another 2.5% here, so really happy with that move. This is the gold contracts. This is the ES contracts here. What a pop this morning, actually. After last night's lows there, 21.74. That's pretty low for the market in general. Let's go in here and see what the markets are going to be telling us this morning here. And first of all, let's check all these quotes. Let's see what's going on. Microsoft is up. Maybe they came out with some good earnings. Gold, silver is up. Costco, Target, Walmart, Facebook, Amazon, Netflix, U.S. Steel. Really mixed market here today. UNG oil is still down. That's probably why the market is overall down. The whole entire market is it's kind of actually following oil right now more than anything else. It's probably because of the drop that is taken, the fact that the U.S. economy has so many oil producers and oil jobs that are going away right now. So oil is a really big play here. A big factor, I guess I should say. It's not a big play. I'm not touching it with a 10-foot pole. Same thing with anybody that's got coronavirus. Woo! Just getting into things here today. There's that TLT, UVXY, the VIX. That means the VIX is dropping very hard. I heard over this weekend, guys, that someone might have got their account blown up. A pretty big trader that had their accounts blown up, and it might have been related to shorting the VIX. And that could be why we saw the VIX rise to unprecedented levels. So yeah, that's kind of what's going on right now. Gold looks like it wants to continue higher there. Same there. TLT is on the rise. Let's see if that one can get to 165 by the end of today. I'll bet it can. This stuff has been moving so volatile. It might not, though. It's really falling VWAP right now. It'd be nice. That blue line right there is the volume weighted average price. Let's go check the positions here. These are the current positions. Go listen to some talking heads now.
States that have joined in, 7 other states, you can see them now. Americans now under stay-at-home orders. We are expecting Governor Cuomo to hold another news conference momentarily, about half an hour from now, and expect a new update then. Kelly?
I'll take it, Contessa. Thank you. Contessa Brewer, of course, outside the Javits Center. Let's get back to potential treatments for the virus. And for that, we're joined right now by Distributed Bio CEO Jake Glanville, the company, amongst many others, trying to develop a COVID-19 antibody treatment and partnering with a number of important institutions to do that. Mr. Glanville, thanks for joining us this morning. Why don't you just start off by telling us what your efforts are centered on right now and whether you're making any progress.
Right. Well, thanks for having me on. My company, Distributed Bio, is focusing on creating an antibody therapeutic. So this is a medicine you'd inject into a patient, and within about 20 minutes, those antibodies would be able to neutralize the virus and provide protection. It lasts about 8 weeks, so this could also be administered to healthcare professionals to provide them some protection while they're in a high-risk workspace. We are anticipating finishing the engineering of our antibody on the week of April 13th, or even the week of April 6th, at which point that goes to the U.S. military, U.S. AMRID, and they're going to be evaluating the potency on live virus.
Well, now, forgive my ignorance here. What is the difference between this and a vaccine, or are we talking about the same thing? You said only 8 weeks, so that would imply it's not obviously a lifetime immunization against the virus.
Yeah, so they're two pretty different medicines. They're both important, but here's the difference. With a vaccine, I would give it to you, and then your body would respond to the pieces of the virus in the vaccine, and after 6 or 7 weeks, your body would produce antibodies to protect you. Whereas with what I'm doing, I'm skipping the middleman there. I'm just giving you the antibody directly, so it works right away. It doesn't last for years like a vaccine does, but it works immediately. And the critical difference here is that vaccines, because they take many weeks to work, you can't give them to patients, which means when you run human studies, you have to give them to a very large number of healthy people, and you have to watch them for a very long time. That's why they're estimating it's going to take 12 to 18 months for the vaccines to become available. Where this, we really just need to do one phase 1/2 human study, and we can do it over the summer on about 600 subjects. And as long as it works, that's enough for us to be able to release it for compassionate use by September.
Well, we'll obviously watch that. I know you worked on Ebola. You're a pandemic expert. I'm just curious if you think as a country we're doing enough to fight this, and what you think about the testing right now.
Sure. So we were definitely caught a little flat-footed in the first few months of the outbreak. China did a great job of buying the world some time, and we took a while to adapt, as did many other countries. At this point, I am glad that we are applying very strict social distancing measures. So here in California, we have some of the strictest. It seems scarier, but the truth is we are safer. What we're going to see over the next month, unfortunately, is a continued growth in cases, just because that's all the cases that are already out there catching up to us. So this month is going to be tough. The good news is social distancing measures is going to slow the cases, similar to what we saw in China. The bad news is China is going to have to start sending people back to work. And we're going to run into that same experience. Either you tell everyone to go home, you slow the virus, or you tell everyone to go back to work and fix the economy, in which case there's more growth of infections. And I think that's what we're going to see for the rest of the year.
Dr. Glanville, have you seen any mutations in this coronavirus like we do see in the seasonal flu?
So other groups are looking at that, and we definitely see an accumulation of mutations happening across all the viruses around the world. Scientists are doing a really good job of comparing notes on this. The question really becomes, is there enough mutation that you could become infected, and then by the next season, if this stays around, will you be reinfected by a new mutant version like happens with flu? And we just don't know that yet.
Mr. Glanville, how many other companies are you aware of that are working on a similar antibody kind of a treatment? And what distinguishes your company in terms of your ability perhaps to get there before others?
Sure. So there's, I'd say 4 or 5 other companies that I'm aware of that are working on this. What we're doing that's pretty different is most of these companies are starting from scratch. They're either taking blood from COVID-19 recovered patients, or they're immunizing mice and recovering the antibodies there. What we're doing that's different is we went back to anti-SARS antibodies from 2002. So the SARS virus is a cousin of the new COVID-19 causing virus. And so we took these antibodies that are great neutralizers against SARS. So if SARS ever came back, those would be great drugs. And we're using technology in our laboratory to create hundreds of millions of mutations on those antibodies to evolve them to catch up to the new COVID-19. And the advantage of that is that suddenly we're piggybacking on years of research on those old anti-SARS antibodies to bring them to become a strong therapy towards COVID-19. And in our estimation, this means we're going to have the first antibody that's actually optimized towards the target compared to other groups who are just trying to find an antibody in the first place.
Mr. Glanville, Jim Cramer, we keep hearing from a variety of sources, whether it be in China, whether it be in South Korea, whether it be in France by a distinguished doctor, that HCQ with the Z-Pak absolutely works. And yet, the president obviously has a good feel. Dr. Fauci's the man I respect, and Dr. Fauci is really saying, please don't get ahead of yourself. Why do you think that there's such widespread use of HCQ Z-Pak, and obviously it's now in New York, versus the skepticism that we hear? Is it just because they haven't done the definitive test? Because I think it's a national emergency, and sometimes I feel that even though I know what the rules are and what the FDA wants, let's just throw the rules away for a few minutes.
So there's a mix there, right? So the chloroquine has been applied in China and South Korea, but then there have been these reports saying that it's effective, but they didn't share enough data. So it is essential that when you have an outbreak like this, you just start throwing all the spaghetti against the wall to see what sticks, and that's what happened with these medicines. Now, there's a real chance that these medicines could help. They obviously don't act as a total cure, otherwise we wouldn't have any of these problems in South Korea where we still have cases. But what we need are studies to test the effect. Now, to your question about can we throw the rules out, we don't want to throw them all out because these serve to protect human lives, but we can soften them and expedite them, and that's that cutting of red tape. So, for instance, with the project I'm working on, normally it would take a couple years through traditional pharmaceutical development to make an antibody, but in this case we have a couple different steps of expediting production in partnership with US AMRID and DARPA and the military, and then second, setting up this phase 1/2 study that's done usually by oncology groups, but that enables us to work with the FDA to prove that the drug works very quickly. And then finally, we have this thing called compassionate use, and that was used in the Ebola outbreak and other outbreaks where if there's nothing else out there that works and you have a medicine that does, even though there's still more studies you can complete, you can start releasing that to hundreds of thousands or millions of people that need it.
Yeah, I was just going to ask about the timeline. You know, we do interviews with people like you, and I get instant feedback. This is hopeful. This is good. This is cool. We need to get this out faster. So you said, what, September is the best case scenario? Is there any way to speed that up even faster?
It could be a little faster, but it could also be worse. So the September is the technical time it would take us to basically manufacture the material, assuming all the red tape was out of the way and the FDA worked with us aggressively on this. And that's why I'm hopeful about my active partnership with US AMRID in order to expedite that. That's an arm of the military that works with infectious diseases. Then you have to do one human study, and you should do that because it makes sure that the drug is safe and it makes sure it actually works. Otherwise, it's not productive. And that's going to take, it doesn't take that long because you can give it to patients who are already sick. So within 10 days, you know whether or not the drug works. That's much better than a vaccine that you have to monitor for 6 months. And then after that, you have to scale up. So these things in principle could be out to September, but we need additional funding. We need coordination with the U.S. government and the military, and ideally coordination with other nations because we want this drug to be available globally. This is a global problem, and we need everybody to have access to medicine.
You have to understand how does money.
Mr. Glanville, appreciate your taking some time with us, and good luck, of course. We're certainly all hopeful. Jake Glanville is the CEO of Distributed Bio. Jim, of course, it reminds us once again, we're dealing with two separate crises here that are inextricably linked. Of course, a health crisis in which we're trying to get ahead of, and it focused on any number of different therapies, whether there are antivirals that would mitigate the effects of the virus, to antibodies that would apparently help healthcare workers for 8 weeks, to a vaccine. At the same time, we're dealing with a moment-by-moment economic crisis that is only worsening as more and more people lose their jobs.
David, it's really kind of strange. The stocks that are definitively going down, and everything's put up in ETF these days, are the, let's just call them the Procter & Gamble's, okay, the consumer packaged goods. Those are the stocks that are going down, in part because I think people are making a bet that when we do get the legislation, there's going to be a snapback rally in tech, because tech is something where there's still demand. I mean, if you're building for 5G, then what happens is you've got something cooking. There are people all over the world who feel like it's an inexorable move to buy 5G. But the idea that somehow you should throw away the drug stocks here, I think it's a big mistake because they have good yields, they have good balance sheets, and just because you think that there's going to be a bill pass, and I do think there'll be a bill pass, let's come back to the idea that where the bargains might be created are companies that have good growth, where the growth isn't going to stop, and people are throwing away because they somehow expect some snapback rally that's going to be able to make it so that there's demand when there is no demand, unless you're talking about a secular trend like 5G.
Jim, can I jump in here for a second? Because I just want to point out that I know we've talked about this, but Zoom's up 18% today, which is just incredible. I mean, the stocks that $154. I can't go a paragraph without reading about, people are saying to Mark Cuban, hey, join our small business Zoom tomorrow morning, because Cuban had some interesting new ideas today about, trying to let businesses overdraft so they can keep going about their thing. I just had my neighbors, Jim, tell me, download the House Party app. We're all going to do a virtual hangout tonight.
I got a Zoom birthday party for Carmine DeCibio, who runs EY tonight. I don't know if I can attend. I've got a Zoom party with my daughter, too. But I would say that I go back and forth with Eric Yuan, who's just a really great guy and a true patriot. He's the CEO. And I always feel badly that he even bothers to answer my email, because he's got so much business. And he's there doing the business this weekend. But he's got the product people want. And secondarily, Cisco has WebEx. Don't want to forget that. But it's become overnight like Kleenex. It's good as Xerox.
That stock chart, Jim. That makes me. We all remember the Tesla stock chart in January, and I'm not saying Zoom is exactly the same thing, but look, that's a pretty steep slope on the right there.
Yeah, look, that's an actual parabolic move, and we all know that a parabolic move is unsustainable. But then again, Tesla did get to 900 before it got to 400. Zoom's a rather extraordinary thing, because people, when they find out, hey, look, I want to do telecommunication, I want to stay at home, it's just the word that comes up is, okay, well, Zoom me. So I think it's really worth noting. You know what? Until Zoom levels off, that's a great tell of where we are in the economy. You want to see it level off, if only just because maybe people can go back to where they used to work.
Well, the fact that it's up 18% day isn't much assurance.
But I want to be optimistic here, because let's say HCQ works, let's say ZPAC works, let's say Regeneron works, let's say Gilead works, let's say something works. I don't want us to. I see so many people, and it's driving me crazy. Well, you know what? China has it, because they're a totalitarian society, and we don't have the guts to do it. I don't know. We got people like Dr. Fauci, we got President, we got Governor Cuomo. We can do moral authority, and we can do better. What drugs? How many Nobel Prizes do they have? What drugs did they discover? So I'm kind of tired of hearing that. No, you see, what we need is a communist totalitarian thing to beat this. We're all at risk, and you know what? We're all going to get it. And Jim, with the gloves and the mask. Are you kidding? I don't buy that. I'm more optimistic than that.
Yeah, and when we look to your optimism, I think it's important right now, Jim. I just want to point out some other things happening in the market, which are a little bit unusual. So we have oil prices down, but they're down less than 1%, so nothing extreme. Energy stocks, though, worst performing sector on the S&P. So we've looked at oil as a leader. Also just would note, Jim, that we have Treasury yields lower after the Fed came in with, with what some are calling the QE infinity. We'll do whatever it takes to stabilize the market. And gold and silver are higher today, which is something a little different. So you don't quite have that sell everything mentality that we saw on certain, brutal days over the last few weeks. It's a lot that the action today is a little more subdued.
What a great point. Look, there's two numbers that we're worried about, confirmed cases and unemployment on Thursday. If we saw any flattening of confirmed cases, boy, we're not going to see a good employment on Thursday. Then I think that people would say, you know what, it's not the end of the world. Remember, it's older than 60 where the risk is. Thank you, Lisa, for constantly telling me that I can't work anymore. Not going to happen. Hey, I got
we
a show
hope
now.
not. We hope not, Jim.
Someone's supposed to ask me about my show.
Yeah, well, hold on a second. I got something else to ask you first, because I did want to reference Sarah's mention of oil prices. At some point at the end of this, we are going to see a lot of consolidation. Now, when it comes to oil, Jim, and you follow this closely, a lot of those smaller operators are in deep, deep trouble. We know that, obviously reflected in the price of their bonds and the high-yield market and the likes. But there is an expectation that we may see a wave of consolidation. No big surprise there at some point when we get to the other side of this in a lot of different industries, certainly in oil and gas. Although not clear to me that there's going to be a buyer at all for Oxy, which we should point out there were some reports that perhaps they're getting closer to a settlement with Carl Icahn. But given their debt load and properties, it's funny. A number of people tell me, the valuable asset there is the Permian, but don't look for anything on that front. Certainly not in the near term, even if in the longer term. How are you viewing energy at this point, given all the cross?
Mike Wirth from Chevron. He's the only guy I know who has the firepower. Royal Dutch Shell suspending its buyback. BP is doing quite well, but they are really moribund. It's like, hey, I don't know what's going to happen. But Mike Wirth is the guy. And Mike Wirth this is Chevron. He's going to come out on the other side. Exxon borrowed a lot of money last week. I just saw through that bond deal, David, in order to be able, in large part, to pay that dividend. That's not Wirth's problem. Wirth's got the cash. But everybody else, I don't want to say everybody, but most others are pretty strapped. They need 30 to 35.
Yeah.
30. That's why I thought the president this weekend, it was a Pyrrhic move by the Texas Railroad Commission fellow to go over to Saudi Arabia. The president has to call Saudi Arabia and read him the Riot Act, but he favors lower gasoline prices.
Jim, you've been saying that for weeks now. It hasn't happened. Okay, so either he's not doing it or it didn't work.
I think you should say I'm wrong. And we can only put for the SPRs, for the petroleum reserve, that's about 5 to 7% of production. So no, I mean, deaf ears, I don't know. I mean, the president, he's got his counsel. My advice was to call them. My advice is not being heeded.
Yeah.
See, I have a TV show.
Clearly, or at least we've seen no evidence of that.
None whatsoever, David.
All
Why
right.
don't you just, rub it right? Jim, that has not been that's been a suboptimal strategy, Jim.
Well, yes, the strategy might be correct, but it has not seemed to have been employed. I think is the way to put it.
How about that?
Suboptimal results. Certainly if you're one who's trying to get, who's operating the oil and gas business, which is a connected story given the decline in demand overall, but also a separate story because of this fight between the Saudis and the Russians, conceivably focused on trying to hurt our operators in the Permian. All that said, Jim, what do we got coming up on MAD later tonight?
Every night I have a new work at home. I try to get a new Zoom. So I've got Cloudflare. Then I also have, I have Teledoc, which is another one like Kelly. Please note that Teledoc also has a Zoom-like chart.
There we go.
And then at the heart of the issue right now in terms of credit and belief is our real estate investment trust. And Deb Cafaro is an amazing operator. She runs Ventas, which has a percentage that is senior living, which we know is right on the red hot griddle. So we got to find out. She did declare her distribution last week. A lot of people thought she wouldn't. I hate betting against Deb, but let's see what she has to say.
Great mix of stuff. Jim, it's been fun sort of hanging out with you from a distance.
Well, we zoomed. We zoomed right here. Kelly,
zoomed.
by the way, is probably about 60, but maybe like 60 feet,
Right.
which is now the new distance. 60 is the new 6.
And I'm still, got the mask, got the hands. Anyway, this has been fun in these
Thank you,
times.
guys.
Jim, we'll see you later.
Thank
Great
you.
stuff, Jim Cramer. We do have time now for our coronavirus update. Sue Herrera joins us here in the studio as well for that. Hi, Sue.
I do indeed, Kelly. Good morning, everyone. Here's what's happening at this hour. Worldwide cases have now topped 350,000. The death toll from the virus is above 15,300 in Spain, and they are reporting another 4,500 cases and 462 deaths since yesterday, bringing its total above 8,000. Here in the U.S., there are more than 35,000 cases and 471 total deaths. The hospital ship Mercy is getting ready to leave San Diego this afternoon. It will be heading to Los Angeles, where it will take care of non-coronavirus patients, allowing local hospitals to focus more on the outbreak. In eastern France, an army field hospital with 30 intensive care beds is being set up for coronavirus patients. This as Paris is extending a weekend ban on gatherings along the Seine River and around the Eiffel Tower. No date for the end of that ban has been given. And the international retail giant H&M says more than 2/3 of its 5,000 stores have been closed. The company is now looking at temporary layoffs that will likely affect tens of thousands of employees. And as always, for more coronavirus coverage, you can always head to CNBC.com. Sarah, back to you.
All right, Sue, thank you. We'll turn back to the markets now, and NASDAQ's still positive, but S&P and Dow are lower. Crescent Capital's Jack Ablin and Morgan Stanley's Chetan Aya join us now to discuss what to do. Chetan, your economic note from Morgan Stanley getting a ton of attention today. U.S. growth to a 74-year low in 2020. Explain your forecast.
So, Sarah, essentially what we have is a significant decline in personal consumption expenditure as well as the business investment in the second quarter. So this is definitely going to hurt our forecasts. And so we are now expecting this to continue into second quarter and then expect a recovery from the third quarter, assuming that virus cases peak by sometime in second half of April or early May.
What is the economy going to look like if we do peak by that time? How strong can we rebound, and what kind of unemployment numbers are we looking at?
So we expect the unemployment numbers to rise to about 12.8% in the second quarter. So this is going to be quite a sharp and steep deceleration in growth. But we expect the recovery to be relatively strong from third quarter, but it really picks up from the fourth quarter in a meaningful manner to the extent to which we will get back to the normal levels of output sometime in 2021. But definitely the near term looks very painful.
So, Jack, I mean, the market's off, what, 30% from the highs? Happened quickly. It happened painfully. How much of that bad news of that economic forecast is already in the market?
I'm going to say most of it, Sarah. You know, the first phase of this selling was probably a lot of it forced, you know, based on all of the algorithmic style, margin-related, volatility-related trading. Also add to the fact that we had a lot of passive exchange-traded strategies where investors pretty much just disgorged everything, baby in the bathwater, so to speak. So I think now for investors who need to be long-term, we have to look past this valley, and there may be more to go to the downside, but probably not much more, is really three things that we're looking at and we're advising our clients to consider. One, shift out of passive and into active. The fact is that, while everything is down, we know that the coronavirus and this standstill will likely impact 30% of the economy pretty harshly, and then probably 20% to 30% almost, no issue at all. And so if you move to an actively managed equity portfolio, a manager has the wherewithal to pick through who will likely be the winners and losers that perhaps a passive investment won't. The second is provide liquidity if you can. The liquidity premium right now is enormous. So we have a private equity secondary strategy where we're providing liquidity for would-be or limited partnership holders that just want to get out. And that is a great long-term strategy because we can offer liquidity at a pretty sizable discount to fair value. And then the last, of course, is distressed credit. We think now, after, that has probably been the Maytag repairman of the investment strategies over the last few years. They're going to start getting busy, and I think providing them with some dry powder could offer investors that are, again, willing to look past this valley at an interesting opportunity.
Jack and Chetan, thank you both for phoning in.
Thank you.
Appreciate your insight. Want to go straight now to Stacey Cunningham, the president of the New York Stock Exchange. Stacey, on this historic day where the New York Stock Exchange is closed for floor trading and operating through computers for the first time in its more than 100-year history. How's it going so far?
It certainly is a historic day for the New York Stock Exchange, but it's a historic day for the United States more broadly, right? We are all battling this crisis and taking the steps that we think makes most sense to protect people more broadly across the U.S. So we made the decision to move to electronic trading temporarily until we have a good sense of how can we keep people safe.
And what are you seeing in terms of the market action? Is it interfering at all with liquidity? Is it operating normally?
Yeah, stocks open normally this morning. The market makers that stand on the trading floor every day who aren't standing behind me today are remotely opening and closing stocks throughout the day using their technology systems to interact and provide liquidity into the market throughout the day. This is something, and as we've highlighted, a lot of trading is done electronically already. The people on the floor are using algorithms to trade. So a lot of that is happening off floor now, as it would on a normal day. And as soon as we can, we'll get the people back in the building.
What are you looking for to see if that could happen? Because some people are saying, look, we might not see the New York Stock Exchange floor open ever. If this proves to go well, why do we even need floor traders?
Because it's a level of service that we can provide to our listed companies as well as their investors, and to provide a premium offering. Just like many restaurants are offering delivery and takeout and close their dining rooms, or CNBC is broadcasting remotely and not doing live on-set interviews, once we have a sense that we can protect the people we're working with, just like you would go back to live interviews and restaurants would reopen their dining rooms, we'll reopen to the trading floor so we can provide full service to our customers.
Yeah, Stacey, it's Kelly here at Studio picking up on that. Does that mean it's a privilege for traders to get access to the floor Can you explain that a little bit more? What the difference
is? It's their customers. It's a privilege to their customers. So the customers off of the trading floor, those investors that are buying and selling stocks every single day, and those listed companies who are choosing the New York Stock Exchange, choose because they have that additional level of service of having people at the point of sale providing human judgment. Importantly, those people aren't open outcry trading each day. They're adjusting their algorithms and to respond to changing market conditions. So like any industry, we've introduced technology to scale their products and services, scale their businesses. So that's why there are fewer people on the trading floor today, is because they're using technology to accomplish so much more. But that technology is a critical piece of it. So is the people. Anytime you empower people with technology, and you get a much better result. And that's what we see. Our stocks trade with less volatility as a result. And today we're taking that piece of the service offering off the table, just given the circumstances. It's a well-considered response. It's not a panic reaction. And I would challenge all Americans to be thinking about their actions right now through that lens, right? This is a crisis, but it doesn't give us the opportunity to make decisions based on fear or panic. It's very important that we use this opportunity to become the best versions of ourselves, make decisions that are good long-term decisions about how we can protect ourselves, our neighbors, and how we can be part of the solution. Just like we're seeing healthcare workers rise to the occasion every single day, every single person should be thinking about how they can help and how they can be a united member of this country.
But many people, Stacey, are fearful. And I know we've talked about this point before, but it still continues to be live. And there are still calls for the market to close for some period of time, because people are emotional and they are scared and there are worries. And a lot of that is manifesting itself in the markets, which is adding further pain to this sort of economic and health crisis that we're seeing. State your case of why it's so important to keep the markets open versus, say, 9/11, where we saw the floor close for a few days, but we also saw the market close.
So those are very different scenarios, and I understand that it is hard to not make emotional decisions, but we have to do that. People need to make sure they are not panicking and making decisions, whether they're investment decisions or personal decisions. People should be staying home, and they should be focusing on protecting their long-term investments, and that means not to panic right now. When you referenced 9/11, the market was closed for 4 days during 9/11 because at that point in time, it was not capable of opening. The industry, the New York Stock Exchange, many of its clients were not able to operate remotely. We have since introduced that capability. We've also, I've heard referenced over the past few days, back to World War I, that the markets were closed for 4 months. At that point in time, the number of Americans that had their life savings and their money invested in the market was dramatically different. Right now, people are being stressed, and many of them need access to those dollars in the short term because of the trials that they're undergoing right now. We can't take that access away from them. We've made adjustments to the market to deal with situations like that, and those situations have been designed, well thought out, data-driven, and actual responses to market conditions, not knee-jerk reactions to a sell-off. I spoke a few times last week with former Treasury Secretary Nick Brady. He was the Treasury Secretary following the 1987 market crash. He and the team designed market-wide circuit breakers for exactly situations like this, when there is a major sell-off in the market, so that we can have an informed slowdown that limits panic at moments in time, to give people a moment to react and to think wisely about what they're doing and to not feed into a panic sell-off. His point and his message to me has been consistently, you need to make sure the markets stay open. This is why we designed this. Now, it was easy for me to say, don't worry about that, because I'm sure, and I also agree, the markets need to stay open. They need to be able to provide access to investors, their money. And that's number one, that's most critical. It is also very helpful to understand and to highlight what the public sentiment is. That's a useful tool to have. On its own, I think it's really critical that people have access to their money, but having the markets reflect back how Americans are dealing with this challenge is a very useful tool as well.
I see you're still at the floor, Stacey. Is there any thinking that the floor could open sooner than many think? I believe in Cuomo's order, financial services are part of the essential workforce of New York.
Financial services are an essential workforce. We will open the floor as soon as we're confident that we can do so safely.
Stacey Cunningham, thank you for joining us. President of the New York Stock Exchange. Kelly, over to you.
All right, the coronavirus is taking a huge toll on the retail sector as major notable retailers like Nike, Nordstrom, Macy's, Apple, and Victoria's Secret are all temporarily shutting down stores across the nation. Our next guest sent a letter to President Trump last week seeking financial aid for retailers and small businesses. He's the president and CEO at the International Council of Shopping Centers, Tom McGee. Tom, it's great to have you here. What do you say to people who, and I'll quote from a Motley Fool article, say you are among those seeking a quote-unquote bailout?
No, we're not seeking a corporate bailout in any way, shape, or form. 70% of the tenants in shopping centers are small businesses. Look, we're facing an historic national crisis. The government has taken appropriate public health actions. That has placed insurmountable strain upon our members. And all we're really suggesting is that during this period of time when we all should be focused upon the health and safety of our fellow citizens, that the government does what it appropriately should do, which is step in and support small businesses. And quite frankly, the economy as a whole. We're reacting to appropriate actions taken by the government. And as a result, retailers and restaurants have closed their doors throughout this country. And so we're just asking for action. We're very focused and hopeful that today the CARES Act will pass. There is language in there around small business protection and loans. We're hopeful that will be broadened to ensure that small businesses can not only maintain their employees, but cover all their operating expenses during this period of time of historical crisis.
So to be clear, make sure everybody caught what you just said. You're supporting this bill because it supports small businesses, which are, as you said, people with less than 10 employees are critical to your shopping malls and centers. So what would the language in this bill do both for those tenants and for you guys? I mean, what happens to people who own shopping malls?
Well, I think, to be clear, we believe this is an appropriate first step. Look, we're in the midst of an historic crisis. We don't know how long this crisis will last, whether it's a month, 2 months, 3 months. I believe that there will likely be other necessities for government action. But we believe right now it's urgent that the government step in, and the CARES Act is what's on the table right now. We applaud the administration and Congress for taking action and putting legislation in play to discuss. We think it needs to be passed immediately. I think what this act does is it provides short-term liquidity into the marketplace, which is necessary to ensure that businesses can maintain their employees and keep and be positioned to recover from this crisis. And it's really important that companies are positioned to maintain their employees, because while I've heard some conversation around this being a sharp decline and will bounce back quickly, if companies don't have employees, whether it's in the retail industry or any other industry, once this crisis abates, and it will abate at some point, if you don't have employees, it's very hard. The ramp up to get back to really be positioned to serve your customers is going to be a much longer one than it would be if you're able to maintain your employees. That's why I think government action is so important, and we are supportive of tying that support back to employee base.
I mean, do you think the government can really save retail jobs in America? It's such a key part of the employment picture in this country. Do you have faith that these kind of bills can really keep Americans working in this sector for an extended period?
Well, look, 1 out of every 4 jobs in the United States is retail related. If you want to save the U.S. economy, it's really hard to do that without leaning into the retail segment. I think every job that's saved is important. And so obviously there has already been actions taken by many companies, not just in retail, but throughout the U.S. economy, to already adjust their headcount. That's why I think time is of the essence. That's why I think passage of CARES today and then moving on to the next recovery bill, because I think there will be a next iteration. We've been and you mentioned the letter that I sent to the administration and Congress last week. We've been very focused upon suggesting that there should be a broad-based, holistic approach, something like a business disruption recovery fund that would operate similar to business interruption insurance that's guaranteed and funded by the federal government may be appropriate. We are in the midst of something that we've never experienced as a country before, and we fundamentally have shut down the U.S. economy. And I think this is the time for government action.
All right, Tom, we appreciate you joining us today. Again, be well through this. Take care of everybody. Hope that we can get this back up and going quickly.
You too.
Appreciate your point of view today. Tom McGee's president and CEO of the International Council of Shopping Centers. All the major averages are now lower. It's been a seesaw here, but the Nasdaq has joined the Dow and the S&P in negative territory, down just 0.33%. Dow's down 322. Stay with us.
Welcome back to Squawk on the Street. I'm David Faber, along with Kelly Evans and Sarah Eisen. A unique opportunity here for me to use both of your expertise. Sarah, we haven't talked about your beloved dollar of late, but that certainly figures into the equation here. It's been quite strong, even with the prospect of adding whatever the number may be, $3 trillion or more to our national debt.
Right. So everybody's beloved dollar right now is really the story, David. And what we saw over the last few weeks of trading is there's been this rush into anything that is dollar denominated. And that's a real sign of fear and of crisis and of the fact that, you know, companies and countries overseas, they've all borrowed in dollars. So it's going to be pretty painful. It just adds to the economic pain. The dollar got so strong last week, it just had its best week since 2008, that you really began to hear speculation that the U.S. and other central banks and treasuries around the world could actually intervene. Something like the Plaza Accord back in 1985, where they all did come together in a massive step into the foreign exchange market to weaken the dollar, to alleviate some of the pain. That we were getting to the point of that. So you're seeing the dollar down now today about 1%. So some of that pressure has been eased, whether it's speculation that we could see stepping in, actual intervention in the market, perhaps, but also things today are a lot calmer. And I think that the key is how the credit market and how the treasury market are functioning. And if that goes okay, then the dollar hasn't been at those super strong levels. But last week, when there were some points where it was looking dicey, it was this mad rush into everything dollar based. And that was a real sign of fear.
Yeah, but you raise a good point, Sarah, because there was also a mad rush to cover trades or to get out of things where you had to actually buy dollars in order to do so, was your point. So that did create demand for the dollar that did not necessarily have to do with rushing to a safe haven currency.
Right. I would use that on your dashboard as sort of the levels of pain and sort of the alarm bells in the market. If you really start to see some notable dollar strength, that's sort of an uh-oh point. We're not seeing that today. And I would use crude oil, as we were talking about earlier as well, because, you know, crude has had some dramatic, aggressive sell-offs lately, and that's also been hard for the market to process and hard for the high yield market, which we know it has much more exposure to energy than the overall equity market. So those are sort of some pain points to be watching. Gold as well. When gold was weakening and the dollar was strengthening, it was a sign that even the safe havens that you traditionally go to were getting dumped in favor of just dollars.
Yeah. Kelly, I know a number of people who were looking at the move in gold and sort of wondering what it actually meant, given you would typically expect, as Sarah sort of referenced, the idea of moving into gold. That was not the case at this point.
Right. And the fact that people were saying, I need to sell what I can in order to just raise cash. And we saw everything do a drawdown. David, I pointed out earlier, but you asked me off the top as well about what's happening in credit markets, which Sarah referenced too. And I mean, I wish the news was better. You know, guys who I really respect, the Brian Reynoldses of the world, say the pricing there is just not that encouraging for equity investors yet. The fact that Berkshire Hathaway issued debt at higher yields than than what it was already trading. OK, yes, the debt markets are open. Companies use them, but they did so. They had to unfortunately, investors really demanded a premium. So, you know, there are people out there saying we really haven't seen equity prices catch up yet with those conditions. Yes, the Fed is helping. It's back in a leadership position, helping calm things down. But that, people are able to access the markets, but it comes at a really high cost right now on the credit side.
Yeah, and we're keeping a close eye on
David,
credit,
I have a
guys.
question.
I know you are as well. Yeah, sure, Sarah.
David, my question to you is what you're hearing out of hedge funds and just how much pain there is and what sort of moves are being done to meet margin requirements and to liquidate and what their clients are doing with their money.
Yeah, I mean, listen, as you might imagine, of course, a lot of people have taken off an enormous amount of risk. And, in this kind of an environment, Sarah, you can't necessarily trust what you're hearing because no hedge fund is going to tell you that it's in extreme duress. And they certainly don't want other market participants to be aware of that. You can expect that there are going to be a number of casualties here, although from what I'm hearing, a lot have at least mitigated some of the risk. They've taken a lot off. They've taken their grosses way, way down at this point. But I don't have a great feel in terms of where some of the real pain may be, Sarah. We know it's out there, and we know a lot of the moves that we're seeing are a result of people taking off significant trades and sort of dislocating in certain markets as a result of that.
Well, we're keeping an eye on that thread as well as many others. The Dow is down about 462 points right now. We got as low as down more than 600. So we're off those session lows, but we were also looking higher as well with another day of extraordinary, unprecedented intervention from the Federal Reserve to shore up the markets. S&P down 2.4%, losses picking up steam. Quick programming note here as we head to break. Don't miss the CEO of Quest Diagnostics on their latest testing efforts. How many tests there are and how widely they can get them to Americans. That's coming up with us on Closing Bell, 4 p.m. Eastern. We're going to take a quick commercial break here. Stay with us as we continue this breaking news market coverage.
Good morning. I am John Fort with Morgan Brennan and Kelly Evans, all coming to you live from separate locations as we put social distancing into effect here at CNBC as a precaution. We're going to start Squawk Alley this morning with Bob Pisani with an update on today's markets. Bob?
And, John, the important thing here is I want to show you the futures because a lot of confusion overnight here. We were futures down overnight. Then we had a big rally at 8 a.m. Eastern time as the Federal Reserve announced new programs. And yet the open was a real disappointment. And it shows you that liquidity is fairly thin pre-open. A lot of people were quite surprised that we opened down so much, but we're off of those lows right now. In terms of sectors here, banks have had a tough time all throughout the morning. Most of them were down 4, 5, or 6%. Energy stocks also had a tough morning. Everything else, 2%, let's say. Industrials, technology, also down about 2%. Semiconductors started strong, but have been weak for a while now. Dow movers, Boeing, one of the few stocks on the upside, only 3 or 4 of them up today. They got an upgrade over at Goldman Sachs saying they are going to remain a going concern. Elsewhere, though, Home Depot still on the upside, but Caterpillar's down. Chevron's having an ugly day again today. And United Technologies down 9%. Remember that Raytheon deal is still out there. That's a little disappointing, I'm sure, to see it down 9%. Elsewhere, the Fed announcement, one of the little footnotes there, they're going to be buying investment-grade corporate bond ETFs. This is a real game changer. The ETF business is really squawking about this in a big way. Now, Japan has been doing this for a while, but not here in the United States. We've never bought ETFs, not buying equity ETFs, but buying corporate bond ETFs, that's a very big deal. LQD, I've talked about many times in the past. This is the largest corporate bond ETF that is out there, and you can see moving to the upside. All these corporate bond ETFs are moving to the upside. You got to be careful about this, of course. There are underlying bonds that trade. You just can't keep buying ETFs ad infinitum. You got to have some kind of bids for those bonds underneath that. So it'll be interesting to see how the Fed's going to deal with that sort of liquidity imbalance that may be out there right now. As we said before, the NYSE floor has been is down today. Not down. It has been temporarily closed. I just spoke to representatives over at the New York Stock Exchange to describe the open. They said it was very smooth and very orderly. And indeed, that's the way it looked from my perch sitting here. And as I talked to some market makers that were on the floor and they're doing business electronically, the opening was indeed very smooth. Of course, we're fortunate we didn't have to deal with any particular issues around circuit breakers this morning. So the fact that the market opened relatively smoothly, certainly a very good sign. I'll keep monitoring that and let you know if there's any problems. But so far, a smooth, clean, electronic open for the first time at the New York Stock Exchange. Guys, back to you.
All right, we'll take those good signs where we can get them. Bob Pisani, thank you. Now let's bring in Scott Devitt from Stifel, recently out with his best ideas note. Talk a little tech. I mean, you kind of have to hold your nose, I suppose, if you're looking to buy things, Scott. But you got a number of names in here that you think perhaps even just in the medium term could be good bets, including Amazon, Alibaba, Netflix, Peloton, Alphabet, Uber, Lyft. What was the lens you used to pick these names?
Yeah, thanks, John. Thanks for having me. You know, I strongly believe humans are resilient and have survived many setbacks in the past, and I think we'll survive and thrive on the back of this as well. That said, you know, there's unprecedented uncertainty about our way of life and the future of business, and we really don't know the depth or duration of the current crisis. So now more than ever, I think it can be useful to look at the world in years rather than days, weeks, or months. You know, it's during times like this that consumer habits change to better options at an accelerated pace. And when the economy recovers, those habits don't revert back. And this is a significant long-term positive for consumer technology companies. We're focused on companies that are long-term beneficiaries of this change in behavior. Given that we don't know depth and duration, we also have to be very conscious of balance sheet risk. The names that do float to the top, you named a few in Internet for safety, are Amazon, Alphabet, and Alibaba. Amazon's very clean in terms of fundamentals and a beneficiary of the current trends and future trends with a strong balance sheet, $50 billion in cash, $23 billion in long-term debt. Alphabet will certainly have demand issues given the cyclicality of advertising, but it's also a long-term beneficiary with a strong balance sheet, $120 billion of cash and $5 billion in long-term debt. Alibaba as well, $50 billion of cash and no long-term debt. I would also highlight Netflix as a beneficiary of these changing habits, but doesn't quite have the same balance sheet strength as the first three.
Now, I want to ask you about what I don't see on this list, and I would refer to this as perhaps the chicken breast and toilet paper of technology, and I'm thinking PCs, Intel, things like that. This is technology that perhaps people had seen as rote, unsexy in the past, but during this coronavirus outbreak and working from home, PCs, which had been viewed as being dead from a growth perspective just a couple years ago, being seen as essential. You don't have those on your list. Is there a particular reason? Do you think the companies are in a tricky position, or do you think the essential nature of those is temporary?
The only real reason is it's not part of my coverage area, so that would come from a different Stifel analyst. But certainly there are trends more broadly across technology, including enterprise tech and PCs, I think that could lead to investment ideas as well. But our focus is on consumer tech and specifically internet.
So, Scott, I'm curious about Peloton on this list. I get on the one hand, you could see more people starting to order some of these workout bikes and the like, and doing more exercises at home and becoming subscribers, and that could be something that's sticky. On the other hand, so many of the users, so many of those subscribers are on payment plans with so much focus on lending and on credit and on just potential economic hardship for Americans out there. How much of a risk is that?
Certainly, Peloton is one of the trickier ones on the list. But I do think that long-term, with what's happening right now in terms of the change in habits from exercising outside the home to in the home, is accelerated by what's happening. But as you mentioned, Morgan, there are offsets to that, particularly in the short term. There's a potential negative demand impact from a very high ASP item, even if it is financed. On top of that, in the case of Peloton, you do have the fact that they're not delivering treadmills at the moment, and they're leaving the bikes at your doorstep to bring inside so that they don't put their own employees at risk. So there are short-term headwinds for Peloton, but I do believe that when we do get to the other side of this, that change in the consumer's mind and that preference towards exercising more in the home is something that will be ever more powerful.
Scott, before we let you go, just a quick question for you. Everyone's concerned or curious about whether there's backups in their Amazon deliveries. Are you hearing or kind of seeing anything from your channel checks about essentials versus non-essential items and some delays maybe for those non-essential items and when we can expect, if we should expect that to get worse?
There's certainly been preferences in inbound shipments for essentials, and that's had impacts throughout Amazon's system, particularly around third-party merchants that use fulfillment by Amazon. There's also been anecdotal evidence on the outbound side in terms of delivery guarantees. I think consumers have to be somewhat patient given the circumstances, and it's very possible that with what's happening in the supply chain, that does get worse before it gets better. Having said that, Amazon's one of the few companies within our coverage list at which the near-term impact on their business actually could be net positive relative to everything else, given the significant shift in purchasing habits to those essentials.
All right. Scott Devitt,
Scott,
watching the internet space specifically. We appreciate you being with us. Scott Devitt from Stifel.
Thank you.
Yeah, it's another thing to watch right now, too. Air freight rates seem to be moving. At least we're starting to get some commentary that they are exponentially increasing right now, what that's going to mean in terms of some of those shipping costs. In the meantime, another market mover today, oil, lower again today. Another volatile session, down more than 60% for the year. Citi's global head of commodity research, Ed Morse, joins us now for more. Ed, thanks for being with us this morning. First question for you, at this time where you see this 1-2 punch on both the demand and the supply side, how much lower can crude go? What are you forecasting?
Yeah, so I think it can go much lower. We don't think the 1-2 punch is over, particularly on the demand side where, the impact on transportation fuels in Europe and the U.S. is just beginning. So we think we're going to see sub $20 through much of the second quarter unless there's some kind of producer response that doesn't seem yet in the cards.
Yeah, I mean, I think about just here in the U.S., you've got 8 states and more potentially being added to the list on an hourly basis right now, representing more than 27% of U.S. gasoline consumption right now with all these shelter-in-place orders taking effect. RBOB gasoline futures also at record lows right now. What does this mean in terms of crude oil demand at the refineries and production into some of those refined products?
Sure. Well, it means a significant amount. It means that refiners have double the reasons that they thought they were going to have to reduce their intake of crude. One of them is simply where you're going to put it, because if inventories are growing to the degree we think they are, the cost of storage, like the cost of freight that you mentioned a few minutes ago, are going to go up. And the other one is that a lot of refiners are in financially precarious positions on the independent refining side, and they're going to need credit from their suppliers. Without that credit, and the suppliers are not in a position to provide that credit, they'll have to, another factor to reduce runs. So we think runs are going to be reduced sort of a major order of magnitude, maybe 7 or 8 million barrels a day lower than we thought they were going to be when we first looked at the refining turnaround season.
Ed, based on U.S. federal action and from the congressional side, lack thereof so far, is there any particular impact that you expect on the oil market?
Not directly from it, because, whatever impact there would be on the consumer side is really made up from the, we're in a 50 cent per gallon gasoline market, and that's a kind of very different market from what we've been experiencing. So there are incentives to consume. There's just no ability to consume. And much of what we're waiting on the congressional side is to see whether there's going to be not just incentives for companies, but incentives for individuals and to get their consumption up.
So as we see oil and gas producers beginning to cut CapEx, bring rigs offline right now, how quickly can wells be shut in? And once the worst of this pandemic is over and the economy starts to come back on a global basis, how quickly can it be brought back online?
Sure. So we're seeing something being fleshed out that has never yet been fleshed out, and that is there are a lot of companies that were brought into existence that probably should never have been brought into existence. It's hard to make a judgment call on exactly how much of the U.S. 13 million barrels a day of black oil production is tied to that kind of company, but I'd say it's a good million at least barrels a day of our production should probably never have come into the market. On the other hand, we're seeing significant cutbacks by the healthiest of companies, and they're doing this faster on both the elimination of fracking crews and on the elimination of rigs that are coming off the market at a very rapid rate. So we actually think that with all the talk about the Texas Railroad Commission rationing production, that the market is going to see it faster than we otherwise would have thought. We would not be surprised to see a 400,000 or 500,000 barrel a day drop in Texas production in any event, not over a year, but over a short period of time. At today's prices, we'd expect there to be a drop that would be worse than in 2016. A year from now, probably a loss of over 2 million barrels a day, maybe 2.5. That would help balance the market. And then the question is, how fast does it return? And I think we shouldn't underestimate the U.S. shale play. It is short cycle. It is responsive to prices. We get prices back above $45 and into a $50 range, which we think is reasonable at some point in 2021. And cash is going to be generated, and the better companies are going to be putting it back in the market. So, yeah, we'll see growth again. Probably never again at the rate of 1.5 million to 2 million a day per year. But I think, at a reasonably priced market, 45 to 55, we should see U.S. production growing steadily at the 500,000 barrel a day level.
Ed, it's Kelly. Let me just ask you, you said you think that crude oil will be trading below $20 a barrel for much of the second quarter. What does that mean for the gasoline price because we don't have the demand response. Usually when it collapses or we get that seasonal pickup going into the summer, we might have neither one of those things. So how cheap are we talking about per gallon?
So I hesitate to say anything other than this is all unprecedented. I would not have forecasted where gasoline is currently being priced. It's a distressed market, and distressed markets do funny things. Among the funny things that distressed markets can do is price a commodity at below zero, where you have to pay people to take it away.
So you think that's a real possibility? We just spoke about this last week, Ed, as more and more people in the market are saying it's possible that crude oil could go negative. Are you one of them?
Yes, we are one of them. We published this a little bit more than a week ago.
Wow. I don't even have any follow-up to
finally,
that. Yeah, go ahead, Morgan.
Yeah. Ed, finally, I mean, we're talking to you about crude and the collapse we've seen in prices in the energy complex, but we've also seen these huge sell-offs in other industrial commodities as well, whether it's copper, whether it's iron ore, whether it's palladium, which has been extremely volatile in recent weeks as well. How much of that is tied to crude and potential forced selling, given how steep the drop is and how quickly, and how much of it is just indicative of where we're at more broadly within the global economy?
So it's a combination of the two, and I would not underestimate the degree to which the energy cost drop has affected other commodities, and it's kind of an ironic aspect of what's happening in that so much of the commodity world is energy intensive that when energy cost goes down, their cost structure goes down, and their ability to respond to an incremental increase in demand goes up. So I'd say what's happening, no matter which of the metals you just mentioned, whether it's copper or palladium, we're going to see an ability to respond that's going to be significant for their profitability of the companies in those businesses with the recovery in the economy.
All right. Ed Morse, thank you for joining us today.
Pleasure as always. Take care.
Fascinating. Absolutely fascinating. All right, coming up in just under an hour, we have an exclusive interview with David Tepper, the founder of Appaloosa Management. He will be joining Scott Wapner on the Halftime Report today at 12 p.m. Eastern Time. Be sure not to miss that. In the meantime, let's get over to Rick Santelli now. Good morning, Rick.
Good morning, Kelly. I'd like to welcome a special guest, former ECB President Jean-Claude Trichet, on the phone. Jean-Claude, thank you for joining me today. Let's get right into it. You know, whatever it takes on a different meaning when it isn't a bailout. This is to combat a pandemic. We shut off the main circuitry for most businesses. Do you think that the central bankers and governments of the world, A, are doing enough, and B, does whatever it takes include all the different fringe areas that we know were overly speculative, like some of the junk bonds and the triple Bs?
It's a pleasure to be with you, Rick. I have to say that we are experiencing the worst crisis since World War II without any I would say, other qualification. We never had to cope with such a many dimension situation, sudden stop of production, and the combination of a health problem, of a supply problem, and of a demand problem simultaneously. So, as you said, authorities in such circumstances have to do all what is commensurate to the immense challenge that we have, and it seems to me that unlimited effort is the rule of the game. I understand it is the case in the United States with the most recent decision taken by the Fed. I have to say that the unlimited supply of liquidity is the rule of the ECB since a long period of time, but it has been renewed very, very powerfully, I have to say. And yes, indeed, as at the level of the central banks, it seems to me that the fantastic effort they are making to permit liquidity to be everywhere in the economy, to permit all markets to remain liquid and appropriately functioning is there, and all credit and financing available for the economy as a whole. And on the government side, it seems to me that when we have the $2 trillion in the U.S., you have in Europe approximately the same amount of I would say, powerful efforts made both in terms of fiscal appropriation and in terms of guarantees of all kinds. We are the same level of order of magnitude of $2 trillion, you name it. I don't know whether it will suffice because we don't know. We are living at a level of uncertainty. But, of course, everything is done to avoid a depression. And I think that it is a correct qualification of what has been in the pipe on both sides of the Atlantic, not to speak of other countries in the world.
Now, Mr. Trichet, when it comes to dollar funding, this has been a huge issue. And many of us have been talking about it long before any crisis. Emerging markets really wanted to put their best face forward. Many analysts throughout the globe pushed that sector, saying that their numbers had more room to travel, where many other markets like the U.S. had already been overly priced. So here we see this dollar funding issue, and it really is a problem, especially when you look at commodity prices and the disinflationary spiral many are working on preventing. So my question to you is simple. Are central banks doing enough? Do we need to actually see a dollar intervention at this point? Because a strong dollar just hurts and once again creates a negative spiral that we are already trapped inside of.
Yes, you're absolutely right. The question of the dollar funding is a very, very important one, and particularly at the level of the emerging world and the economies that are developing. All that being said, it seems to me that I expect the central banks discussing in Basel at the level of the global economy meeting in Basel to see exactly what could be done to enlarge the swap network in order for the dollar funding to be as available as possible. It's important, of course, that we all realize that we are on the same boat, and there is an absolute necessity of international cooperation. By the way, I was deploring myself that the G20 would be absent in the picture at the very beginning. I understand the G20 is mobilizing again, and at the moment we are speaking, there is a teleconference between the ministers of finance of the G20. But again, back to the dollar funding, it's a very, very important issue, and I expect that appropriate cooperation. And in the last time, the Fed had been extraordinarily cooperating. In the present situation, again, they have reactivated the swap agreement, which permits the dollar to be present in major markets. The problem is that it has to be present at the global level.
Excellent. Mr. Trichet, thank you for your thoughts. We'll continue to have you back as we move through different phases of the coronavirus and its impact on the global economy and the health of many in the world. Thank you for your time. John Fort, back to you.
Pleasure to be with you, Rick. Pleasure.
Rick Santelli, thank you. As we head to break, want to note the major averages here at session lows. The Dow down more than 650 points, off about 3.5%. S&P also off nearly 3.5%. The NASDAQ faring slightly better. This as New York announces that coronavirus cases surged 38% overnight to more than 20,000. We're back after a quick break. Welcome back. Our next guest is working with the White House and Department of Energy to curb the spread of the coronavirus, launching the COVID-19 High Performance Computing Consortium, allowing scientists, medical researchers, and government agencies to harness IBM's supercomputing prowess to help stop the outbreak. IBM's Director of Research, Dario Gil, joins us now. Dario, good morning.
Good morning.
It's good to see you. Dario, tell me what the use of supercomputing will allow here. I think short term, certainly people are concerned about delivery of medical supplies. Medium term, there's work going on to actually work on the science of stopping this virus. Where will supercomputing be most effectively applied?
That's right. We got to marshal all the resources that we have across the country to be able to tackle the pandemic across multiple horizons. And on the scientific front, what we need to do is to accelerate the process of discovery to find new therapies and ultimately a vaccine. The role of supercomputing is to allow us to be able to perform these virtual experiments that would have taken us months to do in traditional computers, let alone years if we were doing them experimentally, and compress them to matters of days or hours. To just give you an example of work that was done at the Oak Ridge National Laboratory with scientists also collaborating at the University of Tennessee, they took 8,000 molecular compounds that they needed to be able to screen to see which ones would bind to the protein spike that is present in the virus and then infects the cells. And they were able to down select those 8,000 to 77 small molecules that are most promising to be able to deactivate the virus. That's an example of that acceleration.
So to make sure people put this in the right perspective, I mean, good news is good news, but we want to be sure to give people an accurate sense of hope. When will we see, at the earliest, the results of supercomputing's ability to speed up some of these discoveries?
No, you're absolutely right that this needs to be seen in the context of the core science that then enables the development of therapies and vaccines. And as we all know, that's a process that takes time because it needs to be, thoroughly tested. But the important thing is we all need to do our part. And the high-performance computing community and the people engaged in this kind of modeling, we need to come together. And that is why this effort that we've done in partnership with the White House and the Department of Energy is so vital. Because what we're doing is aggregating the supercomputing capacity of the United States. We're talking now, we've aggregated over 330 petaflops of computational, 330,000 trillion calculations per second that is possible ultimately, and match it to the best scientists so that we can do our part to accelerate that process of discovery.
Dario, you lead IBM's research. A lot of people might forget the majority of IBM's employees actually outside the United States. So I imagine you've been in contact with other research institutions around the world. What kind of work is going on in cooperation with other global research institutions, and how much will other countries, other regions that are also being hit by this pandemic, how much will they benefit from the work you're doing?
Yeah, so this consortium where we're all coming together is something that can be available for all. So any scientist that wants to be able to contribute ideas and proposals to be able to then match it to the supercomputing capacity is welcome to do so. We would love to be able to also expand the international dimension of the consortium by aggregating also capacity around the world and really being able to engage with all that are pursuing modeling associated with the consequences of the pandemic, as well as sort of these molecular simulation dimensions that have to do with therapies and vaccine. So this is really the most fundamental aspect of this, is us joining forces across the federal sector, academia, and industry, and to make it international and accelerate the process of science. We have a great sense of urgency with which we need to conduct this work.
So Dario, just to dig into this a little bit more, I realize this is a consortium. You're working with government laboratories here, also academic institutions. IBM does have a number of commercial clients as well, private sector healthcare companies that are using your supercomputing and quantum computing technologies as well. Are they going to be part of this, or is that something separate? And what does that activity look like?
Yeah, so from the IBM side, in addition to help coordinate this effort, we're also, of course, making free of charge available some of our supercomputing systems. And then absolutely correct, like we are going to partner with clients and academic institutions that we're already collaborating with, historically, and be able to then say, hey, let's prioritize this work. What are the resources and talent and scientists that you can also bring to the table as part of this effort? So yes, it's about really mobilizing our respective communities. And we look at IBM as an institution where we're mobilizing the 350,000 IBMers, but of course, all our clients and partners against the pandemic.
Dario, I was watching the movie Contagion over the weekend, which is suddenly actually quite educational, this and the research they did on what would happen if a global pandemic broke out. One of the key moments is when a researcher in private industry actually helps the government come up with solutions. I wonder what you think of private industry's role, technology's role at this time in helping to find a solution here for the world.
We need to play our part without a doubt. And that's why it's so important that we take our best minds and best scientists and best technology, and we approach it in a spirit of collaboration and cooperation, bringing communities together. That's why we appreciated so much being able to work with the White House Office of Science and Technology Policy, with Michael Kratsios, the CTO of the United States, and with Paul Dabar in the Department of Energy, and so many other leaders when we've come together. But we have a role. I mean, private industry has extraordinary talent and scientists and engineers and designers and people that can come together. And this is a moment to, we're proud of our companies, but it's a moment to look beyond competition and come together to do what it takes.
Dario Gil, IBM Director of Research. I think I can safely say we are all, the entire world, pulling for those supercomputers right now. Thanks for being with us.
Thank you.
All right, well, we're going to take a quick commercial break, just getting a check on both the Dow and the S&P. Back in your session lows, down about 3.8% for the Dow. Both of those averages at their lowest levels since late 2016. Stay with us.
Hi, everybody. Welcome back. Markets near session lows. Dow's down 760 points this morning. Let's get to Sue Herrera now for the latest on the coronavirus. Sue?
Thank you very much, Kelly, and good morning, everyone. Over 1.5 billion people worldwide have been told to stay home to slow the spread of the coronavirus. That's according to the Associated Press. That is roughly 1/5 of the world's population. Here in the U.S., Massachusetts joins the growing list of states that have issued stay-at-home orders. Governor Baker is also shutting down all non-essential businesses. And moments ago, Michigan's governor issued a stay-at-home order for her state. Milwaukee's Journal-Sentinel newspaper is reporting that Wisconsin's governor is also preparing stay-at-home orders. And former presidential candidate Amy Klobuchar has tweeted that her husband has the coronavirus. She says not being at his side is one of the worst things about this disease. She says that she is praying for him as she continues her work in the Senate. And as always, for more on the coronavirus coverage, you can head to our website, cnbc.com. John, back to you.
Thank you, Sue. Note again, the major averages are near session lows. The Dow off more than 700 points. That is 3+%, nearly 4%. The S&P off about the same amount. NASDAQ off about 2.5%. We're going to take a break and be right back.
Welcome back. Well, as the selling accelerates here in the U.S. for major averages, your markets just closing a few minutes ago as well. Seema Modi has the action overseas. Seema.
News from the Fed providing temporary relief for European investors. We saw losses cut in half, but then ending at session lows for the day, working off a pretty ugly session in Asia as well, where India posted its worst day on record. Back here in Europe, Germany, Italy, UK, off about 3% on the day. Now, as Germany readies a fiscal stimulus bill, just getting word that its Chancellor, Angela Merkel, tested negative for COVID-19. She had self-quarantined after her doctor tested positive. Separately, watching shares of Airbus falling here after canceling its planned dividend payments and securing about 15 billion euros in new credit. It follows news of layoffs at GE's aviation unit as the coronavirus grounds several airliners. Now, a number of European luxury retailers have stepped up their efforts to ramp up production of protective gear. Kering, the parent of Gucci, is providing 3 million surgical masks to France, and LVMH supplying France with 40 million to tackle the shortages that hospitals are facing across the country. Now, taking a step back, European stocks have lost about 35% since their highs hit back in mid-February, just about in line with the S&P. John, sending it back to you.
Seema, thank you. We continue to watch the markets, which are trading near just about at session lows. The S&P well off the low levels of earlier in the session, now off 4.5%. We're going to take a break and be right back.
Welcome back. The sell-off is deepening as we move throughout the session today. The Dow is now down more than 900 points. That's a 4.8% decline, and you can see the selling pressure has really picked up in the last hour or so. Chevron, one of the worst stocks in the Dow, it's down more than 10%. And in fact, the flip to negative in crude may be one of the reasons why we've taken on a worse tone here. Gasoline futures, by the way, not looking pretty right now. They were just down nearly 20%. So RBOB is below 50 cents for the first time in, I think, a couple of decades. We just spoke with Citi's Ed Morse about whether crude could go negative. He certainly didn't rule it out. So a lot of red ink for that sector in particular today. Meantime, movie theaters also hurting. They're one of the many industries seeking relief because of the coronavirus slowdown. And many states are now restricting screenings or banning them entirely. Julia Boorstin is here now with a special guest. John Fithian is president and CEO of the National Association of Theater Owners. Julia?
Thanks so much, Kelly. And John, thank you so much for joining us today. Just last week, the National Association of Theater Owners called on Congress for a bailout. What exactly are you asking for?
So first, to make it clear, all movie theaters in the United States are shut down now. Last week, we closed them all. And we did it because it's the right thing to do to prevent the spread of the virus. And so now what we need Congress to do is to step in and to help industries like ours that are completely shut down. We have fixed costs ongoing. We have not a single dime coming in revenues. And so what we're looking for Congress to do is to provide loan guarantees so our members have liquidity to survive the next few months. So when they get through the crisis, they can bring the employees back, reinstate the jobs, and people will come flocking out of their homes to see the cinema again.
Now, your member companies have about 150,000 employees. Can you tell us what kind of commitment to those employees your theater chains would make if they did get this bailout in terms of keeping them on the payroll?
So there are three things stepping back in this bill that are really important. One is direct help to furloughed workers. So the federal government is proposing to make quick payments to anybody with income under $70,000, and that's the vast majority of our employees. The government's also looking to extend their unemployment compensation. So the first thing we're seeking in this package is help for our workers first and foremost. Second, the bill has a whole bunch of great things in it that help healthcare providers to stem the virus. That's really important, obviously, for the country and the world. On a micro level, it's important for businesses like ours. The longer the virus lasts, the longer we have to stay shut down. So we're very, very grateful for the work Congress is doing to combat the virus in this bill. And the third thing that's fundamentally important about this bill is it helps to sustain businesses long enough through the crisis so we can be back up and running when it's over. And some people have called the loan guarantees and the other provisions a slush fund or a bailout. That's not what this is. We aren't asking for a bailout. We're simply asking for liquidity. We're asking for lines of credit guaranteed by the government that can keep us afloat long enough that we can get through the crisis, bring back our workers, and bring back people to cinemas sometime this summer.
And John, have you received confirmation that the theater industry specifically will be included in that bailout bill? Because we have not seen theaters or cinemas mentioned in the latest draft we have read through.
Right. Well, we've been going through drafts all night. Secretary Mnuchin and Leader Schumer are negotiating as we speak. We hope that there will be a deal announced today that will be voted on in terms of a cloture vote today, later in the Senate. Fingers crossed for the sake of the country and all the individuals out there who are unemployed right now. But the way that the bill is currently structured is that specific industries aren't carved out or in, right? With the exception of the airline industry that has a specific provision, all other distressed industries, as they're called, are lumped together. One is the loan guarantee provision, about $425 billion. One is the small business loans, very important for our smaller operators. And in both of those draft sections, industries are not specified. You'd simply have to be qualified as a distressed industry. The Secretary of Treasury would make that determination, and we believe we'll be close to the top of the list. I mean, if you think about what's out there, yes, the airlines are hurting. They're still flying some. Yes, the restaurants are hurting. They're still making deliveries and carry out. We're not making a single dime because we shut down every single theater in the country in the interest of the country's health. And so we are probably top of the list on distressed industries right now.
John, I could argue that movie theaters as a business were in a really tough position already, even
the rest of the movies are going to come back up this fall and into next year with the same kind of business model we had before the crisis.
All right. Fascinating conversation. Thank you both for joining us, Julia and John. Meantime, taking a look at another industry, more furloughs for hotel employees, and Seema Modi has that story. Seema.
Morgan, Hilton and Hyatt confirming with CNBC this morning that they are undergoing furloughs of employees following a sharp decline in hotel occupancy. Hilton saying it'll affect tens of thousands of workers, and it does follow a similar decision taken by Marriott last week. It coincides with also more hotel REITs suspending operations. Pebblebrook says 28 of the company's hotels and resorts have temporarily closed across the nation. CEO John Bortz telling me it doesn't make economic sense to keep these hotels open when occupancy is running so low. You can see shares of Pebblebrook down 6% today and now almost 70% so far this year. Kelly, sending it back to you.
All right, Seema, thank you very much. We're going to take a quick commercial break with the market sitting near session lows. The Dow's down almost 900 points. That's a 4.5% drop. Don't go anywhere. Scott Wapner on the other side of this, joined by a very special guest. David Tepper of Appaloosa will be on the Halftime Report. We'll see you for that.
Hey.
Good afternoon, everybody. I'm Scott Wapner. Our breaking news coverage of the markets continues right now. Welcome to the Halftime Report, where your money is front and center, as it always is. A big day already with historic action by the Federal Reserve. We are also waiting on Congress to vote on its massive rescue and stimulus plan sometime today. We do start today's show with a very special guest. David Tepper is the founder of Appaloosa Management. He joins us now by phone. David, thank you so much for being with us today.
Sure, Scott.
There's a lot, obviously, to talk about, but I want to start by getting your reaction to what the Fed did first and foremost today. They turned on the liquidity faucet, you could say, and it's going to be on for a long time.
Yeah, look, no doubt. Hopefully, they can get this stuff done between the Congress and the Senate, and then there'll be a lot more to do. So it's a good start, but given the dislocations in the marketplace, hopefully we can get this thing done in Washington, and will be a good backstop for the markets.
Does this take, I'm talking about what the Fed did, does it take a significant amount of stress off of the credit markets, which I know you've been concerned about and you watch so closely?
Well, I mean, listen, it takes a certain amount off. It doesn't take, there's still a lot of stress in a lot of different places. So it takes, like I said, it takes a little bit of the stress off, and you really need the Washington package. The package in Washington is just a lot bigger. What they were talking about doing, 7 times bigger. So if I got my numbers right off the top of my head, just to help support, corporate, small business, et cetera, which are going to need, support, and to basically buy secondary stuff in the marketplace of some of the other things that they started to do today, so that we can have the economy functioning the right way.
How confident are you that Congress is going to do, quote unquote, the right thing? I mean, we've seen this movie before at times. We can't afford to have a TARP redux.
Well, listen, even if you have a TARP redux, they got it done eventually, and they'll get this done eventually. Whether it's today or tomorrow or the next day, I think there's parties there that understand how important it is. And look, it's just one piece of the puzzle. I mean, we have to get the medical piece right too, and get the equipment, the ventilators and masks produced. Quite frankly, I'd like to see. I think that's just as important as this. I'd like to see, if Mary Barra and GM is doing it, I'd like to hear Mary Barra and GM tell me when the ventilators are coming off the line. You're a business show, right? You know GM? You know that company?
I do. I do. Our viewers do as well.
So whoever those business leaders are, I'd like to hear from them when the time period they'll be coming off. And look, if we can do it voluntarily, great. If not, then the president should enact the powers he has and make sure things are done as fast as possible. Listen, if we can get ventilators and masks and such to New York and California right now and relieve some of that stress, and that'll be also a very important step so we can get out of this lockdown mode. If you look at the curves, this stuff should start, this lockdown mode should start working in 2, 3, 4 weeks, and then we should be in a distancing mode again, which will be in a distancing mode for a while. But we got to get out of this lockdown. I mean, I don't know if people Cuomo talking about months. That doesn't make any sense to me, given what the curves are and what we've seen from other countries, Korea, etc. So, but we have to get the equipment so that we can get out of this mode, and so that we can get into the distancing mode again, so we can get the economy working. And then, listen, there's no reason not to do it as soon as we can get the ventilators and masks and that sort of stuff produced. Or whatever it takes to get produced, that's what they should do. That's the first step, whether it's the Army Corps of Engineers, it's other people, the people there now. Whatever it takes, it should be done, whatever it takes. And I'm confident, listen, this is the United States of America. We can get this done. And it's one step, and they should have a phase, and they should tell people, listen, once we're out of this first phase, what's 3 weeks, 1 month, 2 weeks, whatever it is, it doesn't make any sense, these peaks of months from the previous data. I don't understand it. And listen, I've been watching this data, since February 1st. I talked to Kramer at the Super Bowl about this virus. So I've been watching this. So I don't understand what this month's talk is. You can't go into lockdown mode forever, but you have to plan this out. When does the peak look it's happening? And listen, the main thing is you have to be able to help people who are sick, that they can get the ventilators, that the hospital workers are properly protected with masks and gowns and stuff. So we have to know when this stuff is produced. So we have to make sure it's done. And if it can't, I don't know there's some sort of thing with voluntary. It's great to try to get it voluntarily, but the commander-in-chief is the commander-in-chief. We need to get it done now. And whether now means 1 week or 2 weeks, 1 week before we get ventilators, those new ventilators off the assembly line, then in 2 weeks you have them in the hospital, you'll be at your peak. A month later you can stop the shutdown and go into distancing, and people should be aware. I mean, distancing is going to last a long time. I mean, that's just the way it's a Spanish flu type deal. But so there's two different prongs. One is getting that right, and the other is getting, the liquidity and support for business and for the working man right now, because they're going to need that support. And listen, there's some industries that are going to be, tougher than other industries for a while. I mean, if you look in China one day, they say China's up, but it's one person at a booth in a restaurant. That's not going to work necessarily here to keep companies alive in that sort of industry. So that phase may last for 3, 6, 9 months, that second phase. At 1 year, I don't know what that second phase lasts for. But we got to get out of this first phase lockdown mode, and we got to get this thing passed by Congress now.
You referenced what is a delicate balancing act and a debate that is happening right now about how long to keep people locked down and when to start letting people go back to work. I want to read you, David, if I could, a tweet from Lloyd Blankfein in the last 24 hours, which speaks to this, and get your reaction to it. He says, extreme measures to flatten the virus curve is sensible for a time to stretch out the strain on health infrastructure, but crushing the economy, jobs, and morale is also a health issue and beyond. Within a very few weeks, let those with a lower risk to the disease return to work. It was echoed really in a piece as well today in the Times by Tom Friedman. I'm not sure if you saw that. Gary Cohn's talking about similar things as well. So that's the delicate balance that we have to consider. Is that what you're suggesting?
Yeah, but listen, the delicate balance, and how do you get to that balance, is to be able to have hospitals with the equipment they need. If I get sick or you get sick, I want to know that I can go to the hospital. Listen, I'm over 60 years old, so I guess I'm in the high risk category. I want to know if I can go to the hospital, or anybody that's 60, friends, whatever, can go to the hospital and know that they can get served with ventilators and such sort of equipment. And until we get to that sort of point, we probably should stay in a lockdown mode. But once we get to that point, that's why this production is so key. We should really be going back to a social distancing thing, and that's what he's saying. I mean, there's still some high-risk people that maybe should stay indoors. But listen, the way this stuff works, and if you listen to all these reports, and a lot of the population in the Spanish flu, you do catch it. You do get immunities to a certain amount, and that's if we don't get vaccines, that's the way these things kind of go away. Once it's a certain percentage of the population has been exposed, it kind of dies out. And listen, we got to flatten the curve so people can get the health care they need, or get the health care that's required to keep people alive. So yeah, I kind of agree with those things, and it is a delicate balance, and it is very dangerous to be in this lockdown mode for a long time. Everybody with no incomes and businesses with no incomes. You can't do that. It's just as Lloyd said, bad for morale. I think that's probably right. That's not my expertise. I'm talking about the economy.
Sure.
I don't want to talk about morale, but listen, I don't like to be in a lockdown mode. Yeah, I think we have to go through that sort of things. And the Congress will do this stuff. I mean, it needs all hands on deck. Senate leaders, congressional leaders, and the President of the United States working together to get this thing through Congress. That's certainly a first step, and a very important step, to make sure people know that they're covered, and small businesses will still be around, and they're kind of key. And we have to do that thing. And listen, it's not going to be perfect, and people are going to have to accept the imperfect to get things done in a quick manner in D.C.
So, I'm sorry, finish your thought?
Go ahead.
So how do you put all this into context when you look at the stock market? I mean, I've had people come on the show, people that their names are familiar, who have suggested that now is the time to buy stocks for the long term. The S&P is down 30%, 30+% from its highs. Is now the time to buy stocks?
Which stocks?
Okay.
You have to be very selective right here, because there's some industries that will be changed, and some industries will be more affected over a medium or longer term, because I do believe we'll be in some sort of social distancing. Mm-hmm. Stocks in general, if you look at past periods, I mean, we could be here. Here it could be 10% lower. if you're not worried about being 10% or lower or 15% lower, there's no I'm nibbling, for what it's worth. Now doesn't mean it won't go lower, and I'll nibble more. So it's a question of just being in there and not being over levered, which I've said before in this sort of environment. But there's nothing wrong with nibbling a little bit in here and being somewhat. If you're levered, I wouldn't be levered.
Mm-hmm.
I mean, you don't get too invested. I mean, the market could go down more. On the other hand, this could be near a bottom once they get this package done. So I just don't know for sure because there's too many variables right now involved. But listen, if you're looking over the long term, yeah, I mean, sure, it may be a time to buy a little, and it means buy a little,
Mm-hmm.
or I don't want to go full-fledged 120% right now, but it could be interesting at these levels. I mean, there are some companies that will come out, and I'm sure in a year or two, in 2 years, are going to be higher, no doubt. There are some other companies that may not be around.
You've had a fairly good exposure, bigger exposure, I guess, to tech, that side of your portfolio, with the Amazons and the Googles and Alibabas, at least from, and Micron, at least what we can tell from recent filings. Are those the places that you're nibbling?
Yeah, I'm nibbling there. I would say, I'm nibbling there, and a little bit of healthcare today, hospitals and such, but mostly there I'm nibbling, I would say, in that tech sort of stuff. I'm also buying corporate, some corporate loans, some sort of junk loans, and today, we do a lot of bonds.
Mm-hmm.
So we're doing some of that today, some bank debt. So yeah, we're doing, we are nibbling, no question about it. I mean, we're along a few different asset classes. Things look really interesting for the long term. But I'm not, I once said it's balls to the walls. They're strictly, they're in my jockstrap right now, so.
Well, you said a few moments ago that we could be near a bottom. Those were the words that you used. What specifically will you be looking for that tells you we really are there? You get over this hump of Congress doing their vote, and then what? Is it the number of cases?
Look, the first thing I like to see, I like to see. Listen, Italy, whether Italy's peaking and flattening, I have to see in the next few days. I'd like to see. Now they did some things wrong. They went into a half, not a really great lockdown. I think New York, if we're in 2 or 3 weeks or whatever, 30 days, sometime within the next 30 days or maybe even the next 2 weeks, or 20 days, we may see New York City cases peaking with this lockdown. That would be interesting. And listen, I think the key, like I said, is to get out of this lockdown and into a distancing mode. Figure out. I think you have to be on. It really should be California, New York, and at least right now, California, New York, and potentially Washington State, where there seems to be hotbeds, in agreement with the president, with the president's people, as far as what should be a time frame, an inside and outside time frame, and let people know what they're looking for as far as the flattening. And we have to get this equipment again, Scott. So I like to see the ventilators rolling off the assembly line. Okay, mm-hmm. I like to see the masks, being given. I like to see that stuff so I can feel more confident that we can deal with people. I like to see the healthcare workers particularly protected right now, so they're around. The hospitals being built, the extra beds being built in New York City. So look, I mean, whether it's 20 days, 30 days, 1 month, whatever that number is, let people know when you expect to have the social distancing phase start again, and get some sort of agreement with New York and California, at least maybe Washington. I mean, those main states, and New Jersey, Connecticut. And when I say New York, I mean this tri-state area. And what it is, a real plan. It's a multi-pronged plan. And, and like I said, whether the president should be doing the presidential powers to get the equipment out. I mean, listen, I'm not in charge. It's his thing. It's a hard job. I personally would do the war power stuff to make sure people are doing this stuff right now. But that's me, because I think we need that stuff now, not in a month and a half, but now. and do whatever you can to do it, to get this country moving. The extra money that it costs to build that or to do those things, to make those factories turn into ventilators, spend the money, get it done, because that's much more money will be spent, will be cost the economy not to have it done.
So
the Army Corps of Engineers, and then you need a central supply thing. That's Cuomo's right about this. A central supply thing to make sure that wherever the supplies in the countries are, that they should go what's needed now. And so you should move it around. So you need the right people to be mobilizing and the right people in charge that can mobilize. And I think FEMA's probably using the Army Corps of Engineers right now. Hopefully they are using the Army. And if it's not them, it's Amazon, FedEx, whatever those people are that have logistics expertise. That's what we should be using to make sure supplies go in the right place. So you just have to have a plan, and you have to make sure people know it on that side. And then listen, on the other side, with the congressional side and Senate side, they got to do what they're doing. And I'm hoping that Trump and Cuomo and Newsom and Murphy and I don't know the Connecticut governor are but all those people are maybe they're listening, and hopefully get together and just do that. Get a plan. Realize the curve does flatten. Look what happened in Korea. Look at what happened in some of these other places. Let's get a plan. Let people know they're going to open up again, so we have hope. Okay, that's the real hope. The real hope is seeing things come off the assembly line. Okay, the real hope is having new hospital beds built. Those other facets, let's see it get done and do whatever it takes to get done. Don't stand on any ceremony now. Listen, if they called me right now, I'd help in any way I could. I would to help the government out, and every American should try to do that right now. Try to help this country out, whatever way we can help people out right now. Everybody has to help everybody else, and these guys have to get together, these guys in government, and let's get this done. And let's figure out this plan and plan it out. It's like 1, 2, 3 steps. And listen, and this is what, and I think once we get those things done, I think the market will get a lot more confident. And if they see those things being done, they'll be more confident that we will get out of this first mode and into the second mode.
If we do get the things done that you say is critical that happens, and then we can focus squarely on, where we go next from an economic standpoint and then the market standpoint. Back in 2008 and 2009, when the Fed came in with the cavalry, I remember a guy named David Tepper back then who asked the question rhetorically.
I'm ready to go when I see these things go. I have money on the sides. I can't wait to invest again. Okay? I want to see these things together. I want to see that these guys are together, and I want to see that plan. Day 30, when this thing starts flattening out, day 25, whatever that day is, and we have that equipment in, we will do this. Don't tell me July, August, September. That doesn't make sense to me. That's not how this worked in Korea. That's not how it worked in China. You're going to have to do social distancing for a while longer. Let's just get realistic and stop, with whatever people want to say. And by the way, we don't need people telling us every day on TV, okay, these daily briefings. Tell me when there's something new. Tell me when you got the plan, okay? Listen, I'm sitting here in New Jersey. I'm an idiot, okay? I know I have a great appreciation for how stupid I am. That's one of my great strengths. But in some sense, I do know you need a plan, and you need to go out and do that. And I know this country can do this, and I know we can do this, okay? But it's like 1, 2, 3. Give confidence to the market. Give confidence. We all can do this together. I really think this is the greatest country in the world, and we got to get moving. You can't stop futzing around. And the Republicans, Democrats, get it done in Congress. And, I would say to the administration and these different administrations around, get together, get this central plan, and get the Army Corps and Engineer. I'm sure they're probably doing it already. Yeah, hopefully doing Amazon. Make sure these plants open. Call Mary Barra. Get that thing going on the ventilators. Use the War Powers Act. Don't sit on, whatever it takes. Do whatever it takes to get it done. And so we can get this country working again, because that's what we need.
So you're sympathetic to the president's tweet today, which says we cannot let the cure be worse than the problem itself. At the end of the 15-day period, we will make a decision.
15 days is again, Scott. You say 15 days.
No, that's what he said.
Okay. Well, listen, if you don't have the equipment out, okay, again. The first step is making sure we have the rest of the ventilators, the masks, and everything in these hospitals now, so we can get to the second period. There's no 15 days. I don't see them rolling. Show me the ventilators rolling off the factory floor. Okay, That should be it. Hopefully that can happen in a week or two. Show me them. Take your cameras and show me them. Okay?
We'll be the first ones there,
President of the United
David.
States, the President of the United States should go there to see the ventilators and see him coming off the. I'd love to see him do that. I'd love to have him have that moment. Okay? I really would. Okay? I really would like him to have that moment. Get it done. Use your powers. Get it done so we can get out of this thing. And it will get done. Let's get serious now. Not, whatever it takes. This is a whatever it takes moment to move forward.
Have you voiced those concerns to anybody directly in the administration that while he has the powers to do the Defense Production Act, he hasn't initiated it officially yet?
People that are, talking to them, but not of people inside the administration per se. But I have people close to them. But listen, I think they may hear this.
We hope.
And listen, I think it's common sense. I mean, it's just common sense. Boom, boom, boom. 1, 2, 3. We got to get it done. And once we get it done, we'll be into the social distancing phase, and we'll be back. I don't know if it's 15 days, may seem a little aggressive, but let's call it 20 or 30 days, okay? But first, we got to get the equipment so people don't die, okay? Very important, okay, that you or me, we go in and we're healthy, So, anyways, I don't know what else I can tell you, Scott.
Let me ask you another question, sort of in the bigger picture of, for I think our investing public too. As we look at the way we will invest in the future and judge companies, you may end up, David, with a scenario when you come out of all of this, and depending on what we really see from Congress and when we read the fine print, that companies are not able to do what they used to do with regularity, buy back stock, for instance, which has proven to be a good stimulant, if you will, for stock prices over the last decade at least. Are we going to, do you think, be in a place where we have to think differently
Scott,
about the things we do?
Things will get back to normal. Everything will be back to a certain way, not exactly what it was in in time. Certain industries will take money, will not be in that situation if they do it under this bill. And that's fine until they pay it back. Maybe they shouldn't be, until they pay the U.S. people back, to pay taxpayers back. Maybe they shouldn't be able to do that. Okay, but if you didn't take money, I think you'll be able to do what you want to a certain extent, and there will be changes and things will move slow. I mean, things don't come back, tomorrow, but things will get back to normal, and we are a great country. Period. I mean, we are a great country, and we will get this stuff done. We just got to plan this stuff out and get joined together and just do it better with not different messages going out, but people joining together, figuring out what makes the most sense to move forward. Anyways, I actually have to go back in the markets because I kind of do that still for a living, if that's okay with you, Scott.
It is. And you know what? I was going to say, I think we should leave it there on that uplifting note. Look, it's been a rough go of it. We're thinking of a lot of people and their families. And
listen, everybody has to be safe, and people have to take care of their families. That's the most important thing right now, family and friends and those sort of things. And let's get this country going, and we'll be great again. Okay, we're great now. We'll be great again. So I'm sure of it.
I appreciate your time. I know our viewers do as well. David, thank you so much. That's David Tepper.
All right, take care.
All right, he's the founder of Appaloosa Management, joining us there with a number of different thoughts. Certainly big picture, and in some cases even little, saying that he is nibbling on stocks right now, but wants to see more happen from a combined effort to confront this terrible virus that we're all facing. You can see the stock market, I should touch on this, has come well off of the lows. The Dow's still down 500 points, but it was a somewhat significant move higher as we all assess kind of where we are and where we all think we're going to go from here. You can see there's a real-time chart. The Dow's now down 2.5%. I do have the investment committee with us today, as we always do, and they're in their own locations, wherever that may be, to try and help us make sense of everything. Joe Terranova is with us today, along with Jim Lebenthal, Sarat Sethi, Anastasia Amoroso is with us. She is the head of cross-asset thematic strategy at J.P. Morgan's Private Bank. Also with us on the phone is Steve Weiss. And Steve, thank you for calling in. I'll turn to you first. You know David better than all of us combined. I'm just curious as to what you make of our conversation just now and his thoughts on the market and beyond.
Well, in typical Dave fashion, it was a very lucid view, obviously well thought out because he's a brilliant person, but so much more balanced than what we've heard in the past about saying, hey, generational opportunity, put money in now. Dave laid out specifically what he wants to see, what he would like to see to get greater comfort, while also recognizing that there's value to be had now, but you have to be very, very careful where you go. Unlike 2008, where Dave made an absolute fortune in buying the bank stocks, you don't have that kind of opportunity here because the banks were so critical to any recovery that they couldn't go out of business. It took a lot of guts at that time to go in. And people are saying, do you see the same thing in airlines right now? Well, I'm not so sure that's the case. So I know it gave me great comfort. I'm not surprised that the market moved higher. But what continues to resonate and what seems to be conventional thinking now is that at some point you've got to put the economy ahead of a mass quarantine of every single individual. And that requires a plan out there. That requires having the proper equipment, as Dave points out, the ventilators, the masks, et cetera. So I'll say what he didn't say. Trump should go and call the companies and say, do this now. I'm invoking my right to do it. There's no reason not to do it.
I understand. I think everybody's sort of sympathetic to that point of view. And we know, I'm sure, that these companies are doing whatever they can. They've said as much, and the others that haven't said it publicly, I'm sure, are mobilizing to do whatever they can. I think that's important to put out there. Steve, thank you for calling in. I wanted your thoughts on the backside of that interview. I'll talk to you in the days ahead. Let me get another thought before we bring in another special guest. Anastasia, are you with us?
I am. Hi, Scott.
Hi. It's nice to have your voice on today. Well, what do you think of the markets here?
Well, I'm very sympathetic to the view that Dave shared, which is the reason why the market has continued down this downward spiral is because we don't kind of have an end in sight that is being communicated to us by the policymakers. But I think the reality is that we are likely looking at a few weeks, maybe a month of this extended economic lockdown and not months. So when you think of it from that perspective and figure out what is being priced into the market right now, I think it's the latter, more of an extended economic lockdown that's now going to end in a few weeks' time. If I look at the S&P earnings, of course, they're going to be down significantly this year, and that's definitely in the price. But what's also in the price is going to take us years to get back to those prior earnings levels. That is likely not going to be the reality because, like David said and Steve said, is we've got what it takes to fix the problem. If we get the right equipment, if we get the right treatment, if we let containment work for a few weeks' time, and if we get the fiscal stimulus, then there should be no reason then in a few months' time we look back on this and we're in a significantly better place.
He said that he said he thought we could be near a bottom. Do you share that view, or are we figuring this bottoming process out a little bit quicker now?
I think we're definitely in the bottoming process. I'm not ready to call the bottom just yet because you do have to look at the trajectory. And for the next few weeks, we could still see the build in new cases in the U.S. We're hopeful that over the next couple of weeks, we'll actually see the peak in new cases in Italy, which will definitely be a constructive turning point for the market. We definitely need to see the fiscal package not just be announced and debated, but actually passed in Congress. Mm-hmm. That would be the other tipping point for the market. So the view here is that over the next few weeks, maybe it's a month, we may see further downside as we grapple with this policy trial and error, as we grapple with the rise in new cases. But over the next couple of weeks, maybe a month, we're likely to see a pretty significant and very interesting buying opportunity.
Okay. All right. Let's bring in our next special guest. Avenue Capital CEO Mark Lasry joins us now on the phone. Mark, welcome back.
Thank you. Pleasure to be back. How you been?
I've been well. Thank you. It's good to have you back. Some level of normalcy, I suppose. I don't know if you heard our conversation that David Tepper and I were having. What do you make of it? Just give me your general thoughts on where you see us today.
Look, I think David's right in one sense, which is what the market is desperate for is just information. It needs to know what's going on. And right now, nobody really knows what's happening. So until you have that, you're going to have markets going down. But if all of a sudden we know that hospitals can deal with anybody who's sick, doesn't mean that people may not get worse or may not die. But if hospitals can deal with it, then I think you'll end up having a little bit of a sense of this normalcy.
You've been looking at the markets, and I mean, the last time you were on, it was a handful of days ago. I can't honestly remember exactly whether it was a full week or not. You said there were things that were really attractive.
Yep.
So how do you think about that today?
Well, shockingly, they've gotten more attractive.
Now, are you talking from the sort of distressed credit side of things?
Yeah, on both sides. I would tell you on the debt side as well as on the equity side. I mean, I think for us, really, what we look at is the debt side. And I would tell you the leveraged loan market has gone down. There's just opportunities everywhere. And, we buy. Really what ends up happening is we'll buy something like, we were buying something around sort of 30, and then a couple of days later we bid 25. We bought a little bit more at 25. A couple of days later we bid 20, and we bought more. I think what David's right about, and the thing everybody's got to remember, if you've got long-term capital, you're going to do great. If you're levered, you're going to have issues. So if somebody's forcing you to sell, you're going to have problems. Right now, what you want to do is you want to be a buyer, and you want to continue buying because things will turn. I can't tell you when, but when they do, they'll turn very fast, and you're not going to be able to keep on buying. So do it slowly, but make sure you have the ability to keep on buying.
You think we're getting near the end of this sort of so-called forced selling that you just mentioned from, funds that were, levered to the moon and have had no choice but to sell and liquidate some things?
I actually don't think you're getting towards the end. I think you're seeing more and more of it. And I think you'll see more this week and next week. Because anybody who's been levered now is getting margin calls and is being put in a position where they've got to sell. So I think that'll continue for a week. It may turn. I think what the Fed did today was great. If Congress passes this bill, it'll be better. But at the end of the day, I think you're still going to have some issues. I think it'll still take a couple weeks. So, what David's right about, situations you know well, situations you like, invest in those, and just be comfortable that pricing may go down. But that's okay.
Even with the Congress passing their massive plan and what the Fed did today, that doesn't take some of the opportunities, if you will, off the table for you, because it's going to stabilize what was happening in credit. There may not be some of those credit opportunities that might have existed because of this historic action from the Fed today and then this plan from Congress.
I actually think it's all positive what they're doing, but at the end of the day, people are still going to be nervous. And I think the news that's going to be, over the course of the next 2 weeks, companies, sort of laying off more people, of cases rising, of more Americans dying. I think all that is going to be, obviously, is not positive at all. So I think markets will probably go down a little bit. So I think you're going to have more and more opportunity to keep on buying, at least for the next couple of weeks.
Mark, I appreciate you calling in. I'll talk to you next week for sure. I've got some breaking news I want to get to right now. That's Mark Lasry. Let's go to Eamon Javers right now down in D.C. Eamon?
Yeah, Scott, on the Senate floor just a couple of minutes ago, we got an update from Democratic leader Chuck Schumer on where negotiations stand as of right this minute. Here's what he said.
We're very close to reaching a deal, very close. And our goal is to reach a deal today. And we're hopeful, even confident that we will meet that goal.
So Schumer there saying very close. Now that's similar, Scott, to what he said at about 12:30 in the morning last night as he left the Capitol to a bunch of reporters who were still gathered there, said that they were close to a deal. Democrats want to suggest that they are not too far off where Republicans are. Their main concern, they have said, is this issue of how much control the Treasury Secretary has over a massive amount of funds, potentially up to $100 billion or more that could be used at the Treasury Secretary's discretion. They want to limit that because they're wary of political abuse potentially of that money. They'd like to see some longer time horizons on some of the shackles that would be in place on companies that do take any kind of taxpayer assistance here. We'll see where they land. Mitch McConnell, the Republican leader, was enormously frustrated last night with Democrats moving to block the bill yesterday in a vote. Democrats fired back saying, look, you shouldn't have held this vote when you knew what the outcome was going to be. You knew you didn't have the votes. You put it on the floor anyway. So this has become a real partisan shooting war here over the past 12 hours or so. We'll see if they can pull things together. We were expecting to see votes beginning in the 1 p.m. hour, a number of procedural votes here to start moving things along again. And we'll see where they can land in terms of a deal, Scott.
All right, Eamon, we'll be looking for that. 1 p.m. is an important hour, not only for that, but Larry Kudlow is going to join the exchange just after us. So you want to pay attention to that. Hopefully, even confident, the words coming from Senator Schumer today. So let's see how far that actually goes once they start voting. Do you want to take a break? All right, we'll kick it around a little bit. Sorry, everything's kind of on the fly these days, so I beg your pardon and ask you to bear with us there. Jim Lebenthal, you're with us today, too. Why don't you just give me your broad thoughts?
Yeah, well, I don't want to repeat what everybody said, but basically David Tepper has it right. Keep nibbling and expect the numbers to show some clarity on the virus. And so to add something new, I mean, let's talk about facts that we know. There have been 250,000 tests here in the U.S. The good news is that's 10 times what it was a week ago. The bad news is it really needs to be 100 times that, but the progress is there. So, maybe this time 2 weeks from now, we're feeling better about what the numbers on the virus actually are. Also, and you know me, Scott, I go into the details of things. That Fed announcement today, that was beyond a bazooka. That was a howitzer. And let me just point out one thing in there as to why I say that. They're reestablishing the Term Asset-Backed Securities Loan Facility, TALF. And in that, they're specific that they're going to do this to enable issuance of asset-backed securities that are backed by student loans, auto loans, credit card receivables. Think about what those three things are, all right? Those are not investment-grade securities. The Fed is coming in and they're saying, stop worrying about liquidity in any of the credit markets. I don't think they're done, by the way. I don't think they're done by a long shot.
Probably not.
Munis, investment-grade corporates. So,
right.
Listen, I just wanted to add some other things that maybe haven't been discussed.
Go ahead.
Well, no. That's what I was saying.
Oh,
Testing.
I got you.
And I'm sorry, you know me, I get detailed. I don't want to hog the airtime. Those things are important. The granularity of what's going on is important.
Details, Farmer Jim? No. I'm glad you're with us today, Jim. Joe Terranova, I think you may be on camera as well and not on the phone today. Is it time to nibble, so to speak, as David Tepper said?
So, obviously, Scott, I've been talking about that for the last couple of weeks with you, and I actually agree very much with Mark Lazary was saying. It is absolutely the time to look at selective stocks that are above their December of 2018 highs and take positions, understanding that you'll probably endure much more price pain with lower prices. There are other stocks out there that I would not touch at all. So I don't believe, as Stephen Weiss often will say, you are buying the market. I think also we are getting to a very important point, and that is we're trying to price assets. And a lot of the people that I'm speaking to over the weekend that are in the markets, they're trying to price a particular asset based on time. And what do I mean by time? What I mean is when exactly will the economy begin to move forward again? And I think when we're doing that, there's stages that we go through. There's the denial stage, which I think most of us were in the denial stage previously. There's the misery stage, which we are absolutely in right now. And there's the point when you get to the acceptance stage. And I think when you get to that acceptance stage, there's some degree of confidence that you have an understanding of when the time is that this healthcare crisis can begin to dissipate. And I point towards Italy. I think Italy is very important in terms of peaking. The traders that I talk to are saying, if you look at Italy and Italy begins to peak, then we have an understanding here in the United States what the potential might be for time. And that's an incredibly important element when you're looking at risk assets. The last thing I would say, if I could, is I think everyone is making very strong points about potential opportunities. Let's not dismiss the opportunities that are going to be presented in the debt markets.
Yeah.
That absolutely is where the opportunity is. If we talk about banks, you give me the equity of a bank, not interested unless it's a high quality like a JP Morgan.
Right.
You
Joe,
give
let me just cut you off. I just want to mention that Boeing has been halted for news pending. I just want to make that note at just north of $99. So let's keep our eye there. Joe, you have a lot of names on that whiteboard behind you. I notice a lot of tech names on there. Those the ones that you've been buying?
Those are my positions. Listen, I've been very active in the market. I'm trying to keep my time frame very short, but yes, those are the names. If you, as I've told you over the last couple of weeks, if you're going to sell off Amazon, I am going to be a buyer. If you're going to sell off Netflix, I'm going to be a buyer. A couple of other names. Think about Old Dominion, ODFL, Old Dominion Freight Line. That's a name that I think, again, is going to recover. Lululemon, another name above its December of 2018 highs, lows rather. That name is going to come back once again. So you want to find these quality names in the equities market that are maintaining above the December 2018 lows and understand the rest of the market. You don't want to touch it. You don't want to be here. I tried to be a hero in Delta. You know that. Quickly got rid of that position. That was a horrible trade. I apologize to the viewers. That was brutal. Energy. There's nothing in energy right now that's appealing.
Yeah.
Maybe you look at the debt construct.
So let me bring in Sarat Sethi. Sarat, so what are you doing with the portfolio that you manage right now?
So, Scott, one of the things that I think is important to note amongst everybody who's talked today, you didn't hear one person say we're selling. And I think that's really important because in a time like this, one of the things that we're advising our clients is don't sell. And I think you're getting pressure from, people looking at the news everywhere. So I just want to make that clear. This is not a time to sell and then come back later. It's very hard to time the market. So having said that, what we're doing with our portfolios is, look, if you're fully invested, we're looking within the portfolio to say, well, what are the things that we want to upgrade to? What are some of the companies that, we think that over time are going to add value to your portfolio? And there's some of the ones that we've talked about for a long time. Companies like Disney that are going to exist for a while, home building stocks like Lowe's, JP Morgan on the financial side. And then if you want to go into technology, go into companies like Visa, MasterCard, Qualcomm, companies that have strong balance sheets and have businesses that are going to exist and get even stronger. I mean, this is the time when you can upgrade your portfolio, look at true opportunities at companies that for months or even a couple of years you couldn't really buy.
Yeah.
But again, the point is stay invested, and then if you do have capital, as everybody has mentioned, you can go out and start nibbling. Don't put it all in at once. Don't be levered. And the other point that I think that we're watching also is, investment grade bonds have really blown out. And I think once you get some stability there, this rebalancing that's going to come will occur. A lot of people don't want to sell their bonds right now, good high-quality bonds to rebalance because you're not getting the true value.
Yeah, the LQD has really seen a lot of selling. It'd be good to see some stabilization there, although there is a concern that investment grade might not remain investment grade for all that long, just simply because of the economic stress that is being put on a number of companies. Sarat, bear with me. I'm going to take a quick break. We'll come back. We'll discuss how hedge funds have been holding up broadly during the turmoil. New York Times reporter Kate Kelly is with us next on the Smart Money. Halftime's back in 2 minutes. The Dow right now cutting its losses as we speak, down 400 points. S&P down about 2%. Back after this. I want to welcome you back. We are learning the reasons why Boeing shares were halted. Let's go to Phil LeBeau in Chicago for us right now. Hi, Phil.
Scott, Boeing is suspending operations at its plant in the Puget Sound area, specifically Everett, Washington. That is where the company builds the 777 as well as the 787 Dreamliner. This has been controversial up in that area for a couple of reasons. One, as more and more companies have moved to have workers not in work facilities, production has continued at that plant. And there have been more than a few union members who have been vocal in the local press up there saying, why are we still coming to work with the coronavirus in the Seattle area, this being a hot spot? Well, now the company has said it will be suspending production. We should point out, Scott, that there was a report of the Seattle Times last night that a union worker passed away yesterday who contracted the coronavirus. And whether or not that put further pressure on Boeing and officials in the state of Washington remains to be seen. But again, Boeing is suspending its operations, production operations up in the Puget Sound area. And the most big
territory. The NASDAQ dipped lower, just held up the best of the big three and was actually positive with just minutes to go. Looks like we're going to go out there with a decline of about 1/3%. So more declines for stocks after the worst week since the financial crisis. The Russell 2000 index of small caps, will just hit that one for you as well. It was also lower, and it was down a little less than the others, down 1.13%. There was some action in the beaten down groups like airlines and cruise ships, chip stocks to buy, perhaps a good sign. Joining us to talk about the market today is Liz Young. She is Director of Market Strategy at BNY Mellon, and still with us via phone, Citigroup Chief U.S. Equity Strategist Tobias Lefkovich. First, though, to you, Mike. The Fed's major unprecedented actions getting into the corporate bond market and other, certainly what we heard helped kind of calm the bond market, which should be taken as a good sign. Though, what did you see in the overall stock market?
Yeah, I think that's the fair way to put it. I mean, I think the Fed at least has perhaps insulated the markets from one extreme negative free fall type scenario where the various parts of the capital markets remain locked up. You can't really get trades off. You basically have financial conditions tighten ever more. And so that has been eased up a little bit. So I think you could say if that was on your probability spectrum, you can kind of nudge it off there, but you're still faced with obviously the big wide gulf in what we don't know about exactly how this economy is going to proceed from here. But, you know, in terms of the actual market dynamics, a lot of kind of jumping, yo-yoing around. I think there's a lot of acute attention naturally on when and what this stimulus or support package is going to look like out of Congress. And it just seems to me that you're starting to see a little more two-way action underneath the surface of the indexes. If there could be a day when you were like down 4% for much of the day and it didn't really seem that bad, oddly enough, maybe we're just getting used to it, but it did seem like that for parts of the afternoon.
Liz Young, the Dow is where it closed is down 37% from its record high a few weeks back. Is that enough of a fall for you to start to put money to work in a meaningful way?
I think right now, if you look at it in the context of history, if you have a drawdown that doesn't include a recession, we're right about in that range right now. If you do have a drawdown that includes a recession, we probably have a little further to go. And the other issue with a drawdown that includes a recession is it usually takes a longer time to get out of that. So I think we're hitting that bottoming phase, but bottoming is a process. And even if we're at the beginning of that process, this is probably going to go on for a few weeks still before we really find a reasonable bottom. I do think, however, that valuations are more attractive, certainly in areas that are going to continue to be going concerns after this. And it's okay to start looking for opportunities, but the most important thing to remember is how long is your time horizon and how high is your threshold for pain? Because there's a pretty good chance that we continue to chop around and that we might see some more downside from here.
So a key point during today's session, Tobias, was when that procedural vote failed on the stimulus. So they weren't able to make traction in getting Democrats on board with that stimulus bill. How important is that for the markets? And as far as the fine print there, what do you think investors want to see, or what would cheer up investors?
Well, I think there are a number of things that the market wants to see. They want to see some progress on the healthcare side, that we don't overwhelm our systems and there's movement towards a vaccine. We also want to see that both fiscal and monetary stimulus are there in timely fashion. You know, I do understand some of the debates between the Republicans and Democrats on oversight issues, on money that's going to go out there. There are legitimate concerns that there's some concern there's too much discretion at the Treasury in terms of how they dole out the money. Those are legitimate, and they'll get to a conclusion. What we're worried about, I think a lot of people are worried about, is that you're kind of going the TARP method, where the market goes lower until they finally pass the legislation after rejecting the initial phases. So the market's struggling with that, but I think there's an understanding amongst not just investors but also legislators that something's got to be done, and quickly.
Tobias, again, today's market, financials and energy, the two worst performing sectors on the S&P 500, and they've been the two worst throughout this sell-off. If and when we see that bill passed in Congress, do you think they're the two sectors that will bounce the most?
I think they have the opportunity to bounce the most. The problem with energy is it's not just the coronavirus issues that are kind of weighing on it, but also OPEC, the agreement failure, and will they get back to the table? Will they be able to get a better price on oil? On the financials, it's concern of how many of these companies that Liz was suggesting are still going concerns at the end, and might have to take at the very least loan loss provisions. They may not end up having to use those loan loss provisions, but banks are going to have to take them for some companies that go delinquent and ultimately may be supported by the legislation, get some money from there and be able to pay back those banks. But I think that's part of the concern out there.
Now we closed down about 3% on the S&P 500. Bob Pisani has got a deep dive on all the biggest movers of today's session for us. Hey, Bob.
Another big volatility, 1,000-point swing in the Dow, 100 points in the S&P 500. Although we closed off the low. A couple of highlights here. Very ugly day for those aerospace companies. We talked about GE Aviation laying off 10% of its workforce. Well, that just went through right to the whole business. Honeywell, United Technologies, Lockheed, all down big. Boeing, oddly not, on a Goldman Sachs upgrade. Retail continued to get hit on concerns as the stores remain closed in a good part of the country. So right across the board, Kohl's, Ascena, Gap, Urban Outfitters, all down in the double digits, usually in the teens. Banks, another really tough day for them. Many of them are at 4, 5, 6-year lows right now, but a tough day for all of the regional banks in particular. It was a very big day for corporate bond ETFs. The Fed's buying not just unlimited amounts of treasuries and mortgage-backed securities. They're buying corporate bonds and corporate bonds ETFs. So the LQD, which is the largest corporate bond ETF, had a big up day after being down almost 25%. In the last month. That's a big change here. And finally, tech did pretty well, although Apple, of course, got a price reduction over at Nomura, talking about much constrained consumer demand. Remember, about 10 to 15% of the iPhone sales are online. With the stores closed, that's a major issue, although I would note semiconductors are up for the most part today. Finally, first day of electronic trading in the NYSE. Of course, the floor is closed. I spoke to them all throughout the day. They said electronic trading had gone very smoothly. At least that's a blessing on a down 3% day. At least, guys, we didn't hit any circuit breakers today. Back to you.
True. Bob Pisani, thank you. Also, another wild day in the bond market. Rick Santelli with the details. Rick, Bob just laid out another huge step for the Fed in this market. Is it working?
Well, I'll tell you, the Fed is definitely throwing everything, including the kitchen sink, at a very large kitchen sink. But just as a market observer, we're seeing some movement, but really so much is going on under the surface. Look at a month to date of 10s. Here we are at 75 basis points, down 10 on the session, up 20 from the all-time low close, basically 54. HYG, Bob just talked about the LQD. So the Fed's coming in. I think it's a really bad idea buying corporates, but I get it. And the HYG, as you see there, is at the lowest level in 11 years, even though the LQD investment grade was up 7+% today. Finally, at 1 week of the dollar index. It's down like a little less than 0.5 cents, but it's still within striking distance of 103. This remains super firm, and until that starts to moderate a bit, there's going to be ongoing dollar funding issues. Wilf, back to you.
I'll take it. Rick Santelli, thank you very much. Liz Young, how much are you looking to the bond market right now, the currency market, for signs of stress as it relates to what's going to play out next for stocks?
It's a great question. And back to a point that Mike made at the top of the show, or at the top of the hour, we do have that as a probability, that credit crisis, and some of that turning into what would bake into the real economy. The Fed backstopping this and then purchasing corporate bonds is certainly a huge buffer on that crisis probability. However, I still think the most important piece of information we need is how long this lasts, because if it lasts too long, then we're going to look at that as a higher and higher probability moving forward through the year. So the things that we really want to see, once we get that combination of monetary and fiscal policy, We want to see the market calm down a little bit. And it's funny to say that I'm excited that we didn't have a 10% move in one direction or another today, but we want to see that volatility come down. We want to see those credit spreads come in a little bit. And we want to see that the disease spikes at some point late spring, hopefully. If those things start to fall in place, it becomes a lower and lower probability that we do have that credit crisis, and then we can recover, or at least start to recover, in the second half of the year.
Tobias, are typical valuation multiples and valuation analysis somewhat sort of out of the window at the moment? And if so, how do you assess when we have fallen far enough such that stocks are cheap, so to put it?
So Wilfred, if you look at the going back 80 years and you look at what is the best place to bought the market on trailing earnings, it would have been under 8 times earnings. The second best place, not intuitive, is 14 to 16 times, and they're kind of in that area at the low ebb of that and the 14 level, and would suggest that it is a good time to buy markets. The only problem with valuation is that it's not the best timing tool. And in that regard, we're not going to get every piece of information lined up perfectly to tell us, okay, now there's this sign to buy, and we're unlikely to see what I often refer to as the cataclysmic crescendo of capitulation. We don't get these wonderful ringing at bells at the top or at the bottom. But we're starting, again, I think we might be starting to put things in place that suggest a bottom can be found. And that's a lot different than what we were looking at even 2 weeks ago.
Liz Young and Tobias Lefkovich, thank you both very much for joining us. Still to come here on CNBC, the CEO of Quest Diagnostics will join us to discuss how his company is working with other labs around the country to expand coronavirus testing capacity. We're back in 90 seconds. Welcome back. The number of coronavirus cases in the US topping 40,000, but that number could be much higher as diagnostic testing in the country lags behind, with many unable to get tested or waiting hours for one being far too long. This is companies' race to find a treatment for the virus. Joining us for more is Matthew Herper, senior writer at Stat News, as well as our own Meg Terrell. Matthew, I'll start with you, if I may. What's your take on how close we're getting, if at all, to some of these potential treatments, provided, of course, they are indeed effective treatments? I don't know if we've got Matthew either or Meg at the moment, so we will try and get both of those up to speed. But Sarah, of course, is still with me. Meg is now good as well. Meg Terrell joins us. And Meg, just a question I was putting to Matthew there about these potential treatments. So we discussed it a bit last hour. How close are we to realistically having something that is effective and can be used?
Well, we should get data in the next month, in April. That's the soonest we're expected to get data on Gilead's remdesivir from some clinical trials being run in China, and also from some U.S. trials being run by Regeneron on their existing rheumatoid arthritis drug. That, unfortunately, is enrolling very quickly, and I say unfortunately because that's being used in very severe patients who are hospitalized with COVID-19. The company just told me today, because so many people are being hospitalized at that severe level, the trial is enrolling very fast, and that means we should see some data in mid to late April.
Matthew, what's the latest we can break down in terms of testing here in the US? How quickly have we caught up? Is there still a lot of work to be done? Yes, to Matthew. Did you hear that?
Do you want to call?
I'm not sure we've got Matthew yet either. So, Meg, I'll continue with you. In terms of that on the testing, we're going to discuss, of course, a crucial testing CEO with Quest Diagnostics shortly. But update us where we are and the amount of catch-up we played to the lag that the US had.
Yeah, well, if we are hearing from more and more companies who are getting this emergency use authorization from the FDA in order to get their testing online, we're about to hear from Quest, obviously. They say their capacity is at 25,000 tests per day, hoping to get up to 30,000 per day by the end of the week. However, we are still nowhere near the testing capacity that we've seen in other countries like South Korea and Singapore, which of course is a smaller country, but we've seen those places be able to control their outbreaks on a level that we have not been able to do and that we have not seen in Europe. And what a lot of experts say is those countries had testing in place incredibly quickly, and they were able to roll it out to as many people as possible so that they really knew who was sick, and they were testing people who had come into contact with people who were sick and isolating those people. That is the kind of offensive response that the WHO is saying countries need to be taking. So a lot of people here in the US are pretty worried as we're seeing the testing guidelines, just people who would be hospitalized and whose treatment course would be changed based on the outcome of their test. Because of the US's capacity, they're getting pretty nervous about the fact that we can't test everybody here.
Well, let's continue that discussion, Meg. Stay with us, if you would. The American Enterprise Institute found that as of March 16th, the United States is able to test over 3,600 patients per day for potential coronavirus. AEI expecting testing capacity to increase to over 100,000 patients per day by the end of the month. Is that even enough? Quest Diagnostics is one of the companies behind the test kits. CEO Steve Ruskowski joins us now. Steve, thanks for joining us. How many tests are you doing right now per day, and how many are necessary in this country?
Well, first of all, thanks for having us. And right now, we're actually doing 25,000 per day. We've made tremendous progress since we first launched the test, which was March 9th, so not that long ago. And we're still working on some improvements. We can expand our capacity even beyond that 25,000. And we believe by the end of this week, we'll be close to 30,000 tests per day. So let's say about 200,000 per week.
And how quickly, if someone gets tested, do you get them the results? And why do some people have to wait 2 to 3 days and others get the results within hours?
Yeah, so as we brought up these tests, we brought it up first on March 9th. We brought it up in one facility, which was our laboratory-developed test. That first facility is actually in California. And a couple of days after that, first laboratory was brought up. We moved it out to Virginia. And now we have close to a dozen facilities with our testing capacity. So what you saw in some of those longer turnaround times is if an individual got a test, and we had to run that test out to California initially, it took a longer time to get the result than it would today.
Steve, I know you're not, of course, the only company out there that's massively ramping up its capability for testing, but I also know that you're in touch with some of your peers. How long do you think it will be before the US has an abundant testing capacity?
Well, you look at what I just said, we're getting close to 30,000 tests per day. We're one of a number of large clinical laboratories, commercial laboratories in this country. And so you can think about us being a significant part, but not the entire part. And then also you have a number of regional facilities, you have hospital facilities, and still
federal and state facilities. So I think, by the end of this week, we're going to have a significantly more testing capacity in this country than we had only a week or so ago.
Steve, this is Meg Terrell. We are hearing from people who are lauding the commercial testing industry for coming on board as quickly as you have after we saw those initial snafus, with the government set up testing. But one thing we're hearing now that seems really disturbing is that there isn't enough supplies to run the tests in many places. Can you tell us about what you're hearing about this and what really is holding up being able to process some of the tests?
Yeah, so we could have testing capacity, as I just said, but we have to have the specimens collected. And so what we've been working on is to make sure those supplies, those swabs that you actually use to collect the specimen is in the right location. Actually, over the course of the last several days, we have shipped out thousands of these tests. In the course of the last week and a half, we've shipped out 500,000 swab specimen collection kits to different organizations. These could be hospitals, they could be physicians, but also we put these in the hands of these drive-through centers you're seeing as well. So that is critical to make sure those specimen collection kits are in the hands of those people that are actually going to do the collections.
So is it just the swabs that are in shortage, or is it also the chemical reagents? What are the pressure points that you're seeing right now, and how do we get that fixed?
Yeah, so we're keeping up. The reagents that are coming to us with some of our suppliers are keeping up with our capacity right now, so we feel good about that. We feel we can get to that level that I talked about, 30,000 tests per day, and keep it running, given the projections that we have from our suppliers to do that.
So, Steve, I talked to my friend who's an ER doctor in California, and they're only testing people who they're admitting into the hospital. Who should be tested at this point?
Well, right now there's new guidelines that came out from HSS, and basically there's a prioritization of who should get tested. We want to focus first on patients that are in beds. We also want to focus on symptomatic healthcare workers, and then also symptomatic individuals that are at risk. Those should be the top priority. So actually launching tomorrow a capability that we can identify those patients that are in beds. That'll be very helpful to have those hospitals find out quickly whether that patient that's in the bed that they suspect that has coronavirus is actually negative or positive. So that will be rolled out tomorrow by us.
Steve, it's good to hear that those sorts of things are the priorities, but is there a secondary market trading, as it were, for these tests to get tested, where perhaps money or access can get you tested before others? Are you aware of that taking place at all?
Right now, we are prioritizing on what I just said. It's the patients, the healthcare workers, it's the symptomatic patients. And by and large, those are the individuals that are getting the specimens collected by these centers. And that's where we see the primary volume coming from.
Steve, are you working on any tests for immunity, which it seems to me would be helpful if we were talking about an economy trying to get back to work?
Yes, we're actually working on the ability for us to see the antibodies through a blood test, a serology test. And that's very important for us to take the next step. So we have our team of scientists looking on that as we speak.
Wow. When can we expect some word on when that would be available?
Hard to predict. We've seen some recent papers that have been published. We're collaborating on this throughout the industry. And, we're hopeful, but we can't predict how long it will take for us to get a test to the marketplace.
Steve Rutkowski, please keep us posted. And thank you for joining us.
Thank you very much. Thank you for having us.
Quest Diagnostics. Also, thank you to our Meg Terrell. Up next, find out whether stocks are starting to look cheap amid the massive market sell-off. S&P down about 34% from its record highs. Plus, former Bank of England Governor Mervyn King reacts to the Fed's pledge of open-ended asset purchases to help support the market and the economy. And as a reminder, you can always watch or listen to us live on the go on the CNBC app. Our special CNBC coverage is back right after a quick break. Breaking news on Twitter. Julia Borston with the story. Julia.
Twitter just announcing that the company is withdrawing its revenue and operating income guidance for the first quarter of 2020, also withdrawing its guidance for expenses, stock-based compensation, headcount, and capital expenditures for the full year. That is, of course, due to the coronavirus pandemic. The company also says it expects its first quarter revenue to be down slightly on a year-over-year basis, and it also expects to incur an operating loss due to reduced expenses resulting from disruption, not fully offsetting the revenue impact. Now, of course, Twitter is primarily brand advertising. It doesn't have some of the advantages of direct response advertising that Facebook and Snap have more of. The company does have one bright spot, though, saying that improvements in global conversation, they're seeing additional strength in total monetizable daily active users, so greater engagement among their user base, but still they warn about they can no longer stand by their guidance. They do say that we'll hear more about the first quarter in their earnings call coming up on April 30th. Guys, back over to you.
Julia, thank you so much for that. Still to come here on CNBC, former Bank of England Governor Mervyn King will join us to discuss whether central banks have done enough to help avoid a global recession. Welcome back. Let's get over to Mike now for a look at the damage done to valuations. Hey, Mike.
Hi, Wolf. Yeah, quite a bit of damage in a pretty short amount of time. If you look at a 10-year chart of the S&P 500's trailing price earnings multiple, so this is the earnings over the last 4 quarters, it is down at or a little bit below 15 right now. It hasn't spent a lot of time in this zone in the last 5 years. As you can see, late 2018 did dip down there for a little while. Now, obviously, big caveat here, this is trailing earnings. We know that on a forward-going basis, next few quarters are going to be a mess in terms of S&P earnings. In fact, Goldman today saying they could go down 20-30% for calendar year 2020. But the question is, what does it mean that that's the baseline? The last 4 weeks, the 4 quarters are the baseline earnings power of the S&P 500. The question is how long it takes to get back up there. So you would never say the market is outright cheap. We are not at some kind of bedrock core value for stocks right now, and we did come off relatively elevated valuations, but it definitely has come back into the zone where longer-term investors are not going to be penalized so badly unless this is a very, very long recession if you're buying at or below current levels.
Okay, Mike, thank you very much for that. Now, the Fed launching new programs today in an effort to combat the economic impact from the coronavirus outbreak. Initiatives include an open-ended commitment to continue buying assets, purchasing corporate bonds, and a lending program for Main Street businesses. Will moves like this from the Fed and other global central banks be enough to ease the economic fallout? Joining us on the phone is Mervyn King, former governor of the Bank of England. He led the bank from 2003 through 2013, therefore, of course, oversaw the financial crisis. Lord King, thanks so much for joining us.
Good afternoon, Will.
I wanted to start with that reference there to the financial crisis, given, of course, you're at the helm of the Bank of England at the peak of it. Clearly, there's a very different cause to this crisis, but are there similarities, and which do you think is the bigger threat to economic growth?
So I think there are two similarities. It's a global crisis that makes it much more difficult for us to pretend that the rest of the world can help one country in trouble. And secondly, that what will happen in the next few months will depend critically on people's behavior. Just as it was difficult to predict which funds would be withdrawn from banks and financial institutions in the financial crisis, so now an awful lot will depend on the behavior of people, whether they abide by the advice they're being given by governments, and how companies will respond to the enormous uncertainty that lies ahead.
And is it a bigger threat to the outlook for the economy than 2008 and 2009 was?
Well, I think it's very different. I think that it was a lot easier to handle the crisis in 2008 because we knew what we were up against. And once the banking system had been recapitalized and people had come to terms with the fact that that was what was necessary, then the crisis abated and the banking crisis at least then went away. I think this is much more difficult because we are in a situation where, for very good reasons of combating the health crisis and reducing the number of fatalities, governments around the world are deliberately pushing the world economy down. And this will undoubtedly be a very major factor in people's decisions looking ahead. It is vital, therefore, I think, that governments do two things at present. One is immediately to deal with the cash flow problems that result from people's cash takings disappearing overnight. That is the sort of measure that the Fed can help with. But the second measure is to assure people that there will be compensation from the government to compensate businesses, both large and small, and the self-employed, for the fact that their incomes have simply fallen away. And it is vital that governments put that in place in principle as soon as possible, even if they may take a little time to work out the details of how it would be done. Otherwise, what you will find is massive layoffs, falls in spending, which will exacerbate the problem that we face now.
Lord King, we have seen all sorts of actions from governments and central banks around the world. I mean, I think you could legitimately say that they have reached the sort of whatever it takes mantra and have done so very quickly. Have you been surprised how quickly central banks have managed to respond to this versus whether it's the sovereign debt crisis 2010 to 12 or the financial crisis 2008, 2009?
So I think one of the important things to recognize here is that each country on its own realizes it's facing a national crisis. And that has made it much easier for governments to respond to its own circumstances than to deal with issues that span across nations. The euro area is facing a very big challenge, and governments are not finding it easy to come together to find a solution. The nation state here is acting quickly to deal with its own citizens. I'm not surprised that central banks have responded so quickly, because I think the lessons of the financial crisis were clear, and I think central banks have a history and a track record of cooperating together and of being willing to act quickly and speedily. Many of the facilities that are being opened up again now are things that were created in the first instance in the financial crisis. So we've learned from the past and we've built on it. I think the bigger challenge now is for governments. Central banks cannot make promises of compensation from the collective citizenry to individual businesses, but that is what is necessary now. I think the idea that we would just let businesses fail because they're facing a serious shock now, which has been imposed on them by governments for very good reasons to deal with the crisis of the coronavirus, but it was no fault of these businesses that their businesses now seem to be incapable of continuing without government support. That government support is crucial. That support can then be withdrawn when the epidemic disappears and we can go back to the market economy as usual. But we're not in that position now.
It's Sarah, Lord King. Thanks for joining us. You know, right now it's all about a fix. It's responding to crisis. It's throw everything you have at it. But I'm just wondering, you know, with the Fed throwing its arsenal behind the funding markets and the credit markets and zero interest rates, how do you think about the long-term impact of some of these policies when we do hopefully get back to normal?
So again, I'd like to take it in two steps. One is the credit facilities, the lending supported by central banks, and the other is the solvency business, the compensation which governments, I think, need to offer. On the first, central banks will be able to reverse these policy stimuli very quickly when it seems appropriate to do so. And I think that the epidemic will go away at some point, and then the central banks will be able very quickly to reverse some of the measures they put in place. I think on the compensation front, it's more difficult, because unless we put these measures in place now, then I think we may have a sharply reduced business sector to support the long-run growth of the economy. And I think the immediate need is for governments to act as a purchaser of last resort. We don't need just credit, we need more than that. And if the government is a purchaser of last resort, it can say to businesses, look, these are the takings that you expected to receive over the next few months, and we will ensure that the government provides you with those takings, or at least some proportion of them, maybe 80 or 90%, so that you then don't have to lay off workers. Indeed, a condition of the grants would be that they not lay off workers, and that people can maintain their jobs even though they are confined to their homes at present. And if we don't do that, then I think we could see very serious long-run damage to the economy. But I do think that whatever measures are put in place, it will actually be relatively straightforward to unwind them. What will be more difficult is if we allow this to cause serious damage now, and to try to repair that damage later may be very difficult. And there will be changes in the pattern of the economy looking ahead. We have no idea how far international travel will continue in the way that it did in the past. We don't know whether people's travel preferences will be the same. Their methods of working may change. And these will have consequences for businesses, and some businesses will disappear and other businesses will be created. But this is not the moment to allow that to happen. This is the time to support current businesses, and then once the epidemic is over, then we can let the market economy sort out the allocation of resources among different parts of the economy in the usual way.
Lord King, whilst we've been speaking, UK Prime Minister Boris Johnson has put the UK into a lockdown, including, by the way, banning gatherings of more than 2 people, unless you live with them, amongst other sub-bullet points to that nationwide lockdown. I wondered what your reaction to that was, and as a sort of follow-up part of that question, the pound has been in free fall this year. It's down 13%. It's below 1.15, 115 against the dollar. Is there a risk, whether because of this lockdown or other factors, that it sort of slips into free fall and falls even further from where it already has?
Well, I'm not going to speculate on where any asset price is going to go. None of us really know that. I think the government has been very concerned that the advice it gave, which was very clear, very strong, that people should not go outdoors and congregate with others but maintain social distancing of more than 2 meters from each other, was clearly flouted over the weekend by a number of gatherings where people in the lovely and unusual sunshine of London decided that they would like to be outdoors. These measures will undoubtedly help to reduce the transmission of the virus in the short run. What we don't know are really 2 very important things. One is how long will people be able or willing to put up with these extraordinary restrictions, and will they work effectively? I mean, how will people get food, for example? Will they be able to go to shops? I have not seen the precise statement that he made in the last few minutes. This interview coincided with Boris Johnson's statement. But that's one big question. How will people respond and react to these measures? For how long can they seriously be maintained? And the second question is, we don't really know what the exit strategy is from all this. Will it be the case that if we are successful in containing the virus in the short run, the population will then be exposed to the risk of a second or third wave of the virus down the road once the restrictions come to an end? And the exit route from the epidemic, really, that we can be confident will work, is essentially a vaccine. And that sadly seems further away than most of us are able to think at this stage.
Lord King, thank you so much for joining us. We appreciate it, as always. Should mention, of course, as well, with everyone at home with plenty of time on their hands, looking for a book to read, Lord King's out with a new one at the moment called Radical Uncertainty, Decision-Making Beyond the Numbers. Well worth a look at. We didn't get time to discuss it with him today.
Well, good luck to you and to all your listeners, because this is a very difficult time.
Thank you very much, Mervyn King. Still ahead, we will speak to a prominent venture capitalist about whether this market meltdown could soon spark an M&A boom. We'll be right back. Welcome back. Let's send it back over to Sue Herrera for the latest on the coronavirus. What do we know, Sue?
We have more details on British Prime Minister Boris Johnson's announcement just moments ago that very stringent rules are being put in place to fight the spread of the coronavirus. Britons have been ordered to stay at home for 3 weeks with only a few exceptions. Most stores must close, but they will be able to go out for groceries, also prescriptions and essential services. The police will be enforcing those new rules. The SEC is warning companies here at home to make sure there is no insider trading based on non-public information involving the coronavirus outbreak. The SEC says it is committing substantial resources to investigate possible infractions and protect Main Street investors. And French Olympic officials are calling for a quick decision and an announcement of any postponement of the Summer Games in Tokyo. Several countries have publicly asked for a delay. As always, for more on the coronavirus coverage, you can head to CNBC.com. Wilf, back down to you.
Sue, thank you so much. Still ahead, a hiring surge. CVS and Papa John's both setting out to hire thousands of new employees amid the coronavirus pandemic. A full rundown of some of the good news stories out there when we return.
Today.
Welcome back. Amid all the doom and gloom surrounding the coronavirus pandemic, we're finding stories of hope and of charity, and as companies and individuals step up for the greater good. Here are some of the latest that have stood out to us. CVS says it will award bonuses to frontline employees ranging from $150 to $500. The company also says it will hire 50,000 full-time, part-time and temporary workers across the country. Papa John's is hiring too, announcing it will bring on as many as 20,000 new restaurant team members. Walmart and Amazon have both announced massive hiring sprees, and both companies now say they have hiked entry-level wages for overtime pay for warehouse workers.
Meantime, Citi says it will give special compensation awards to more than 75,000 eligible employees worldwide. Jack Daniels parent Brown-Forman donating $1 million to coronavirus relief, including funds for restaurant workers in the hospitality industry. And Anheuser-Busch says it will be producing and distributing bottles of hand sanitizer in the U.S. And finally, medical TV dramas are joining the real-world efforts as well. Deadline reporting that Grey's Anatomy, New Amsterdam, and The Good Doctor are among the shows donating props and supplies to hospitals and first responders. I guess they had the real stuff on set, Wilfred. And another reminder that much of TV production in this country is also shut down.
But not, well, that's true, as we're aware of. It's not fully shut down. But they're not donating doctors and nurses, which I was pleased to see they didn't go that far, not fully trained. Though we're seeing that, of course, of a lot coming out of retirement potentially. But I do like that story. That brings it back real. And the hiring, I think, is great to point out. And some of those numbers are incredibly big numbers. And again, frontline workers getting an extra pay boost if they're having to stay out there in customer-facing roles especially is very pleasing to see. Moving on, another volatile day for stocks. So what could be in store tomorrow? We're going to break down the charts and have a look at what to watch out for. We're closing down 3% today, of course, on the Dow. Well, welcome back. We've got about 3 or 4 minutes left of the show, and just enough time for some final thoughts and key things to look out for overnight. And guys, clearly going to be a lot of focus on Washington and whether Congress can get its act together to pass that bill. But Sarah, the key thing I think I'm focused on is whether we continue to see a slight easing of those liquidity pressures in US Treasuries and also the dollar. And the dollar was down today only 0.3%, but it's a move in the right direction, which equity markets want to see continuing.
I agree. I think you got to watch that dashboard for the stresses in the system. Weaker dollar certainly helps. Treasuries that are well bid and continuing to hear chatter that the Fed is actually being successful, at least so far. It's early and trying to grease the wheels there. That would be good news as well. And then just company reaction is going to be huge. Tomorrow morning, we've got an exclusive interview with the Coke CEO, James Quincy, about what he's doing for his workers and what he's seeing from consumers. And then on this program tomorrow, we're going to talk to Larry Merlot, who's the CEO of CVS Health, on what he's doing for his workers and how he is responding, because you know, these companies are making some real-time decisions, shifting their business, Mike, and at the same time, the market has been falling very sharply, and so their stock prices are down as well. Though I guess on the plus side of the column, there was some bifurcation. There were winners and losers today.
It was not an all-inclusive one-way downside bet today. That's one of the, very thin reads you can try to grab onto. We are in what we would normally be calling pre-announcement season. Let's remember, we're getting into the last week of the quarter. It doesn't seem to matter. The fixation on Congress, I think, will be like the trade talks. It's sort of, there's a trade tariff deadline, and if we get the decision the market seems to think is coming, which is some kind of a deal, then you find out what's priced in and was it enough to support stocks at these levels.
I agree with Mike on that point. It does remind me, it's reminiscent of the trade deal. We're going to have a deal or we're not going to have a deal. Are we going to have a deal or we're not? And the market is reacting to that. Echoing back to your earlier points, I think the focus the internal plumbing of the credit markets, the commercial paper markets, the money markets is really, really important. I'm looking up at the screen here. There were 4 Dow stocks that were in the green today: Boeing, Intel, Home Depot, and Walmart. I think that's good news. I'm also looking tomorrow for the debate on whether the induced coma we've put the economy in, how long we can stay with it. I think that debate is starting to catch fire a little bit, and I expect it. Finally, I want to wish my wife a happy birthday, because this is the best present she's going to get, a greeting on TV today, because there's no shopping.
Well, Tyler, we all echo that very much as well. A very, very happy birthday to Mrs. Matheson. A couple other crucial little market things to keep an eye out. Consumer discretionary. There was one positive sector on the S&P, and oil turned around sharply to the upside in the final hour or so of trade today. It was down 5%. It ended up 5%. Is that a sign of some improving risk sentiment? But of course, don't want to move too early on that with oil. It's been all over the place. We are pretty much out of time here. Thanks for tuning in from Tyler, Mike, Sarah, and myself. Have a great evening. And Brian Sullivan picks things up right now.
No deal. Stocks fall again as the Senate fails to advance a much-needed aid package for the American people. The Dow dropping 582 points. That is another 3% loss. The sell-off coming despite more unprecedented action from the Fed. The central bank throwing pretty much every single policy action it can at the dire economic situation, offering up far larger programs than anybody had ever thought possible. Welcome to CNBC's continuing coverage of the markets in turmoil, everybody. I am Brian Sullivan. If you are keeping track at home, and we're pretty sure you're at home, here's a sobering stat on the sell-off. The Dow has fallen nearly 11,000 points, just as hitting an all-time high in mid-February. That is a nearly 40% drop, the fastest in history. Investors continue to see their portfolios fall, while Washington, it falls short. Stimulus still on hold. And here's a live look at the White House, where we are expecting a briefing on the coronavirus outbreak in about 30 minutes' time. Of course, we're going to bring that to you live when it begins. So let us begin there in D.C., because Kayla Tausche has been tracking the stimulus situation all day long and is with us now on what happened, what didn't happen, and maybe, Kayla, what comes next.
Well, for a second time in 2 days, Brian, the vote to advance this stimulus package coming out of the Senate Republican side failed. Now meetings are taking place in the wake of that, with Treasury Secretary Steven Mnuchin meeting with the top Senate Democrat Chuck Schumer, followed by a meeting with Senate Majority Leader Mitch McConnell. Those two back-to-back meetings, potentially an update on where things stand. A senior Administration official tells me that it's unlikely that that one meeting with Schumer would yield a deal in itself, but it's important to note that these talks continue with both sides optimistic that a deal of some sort can be reached. The timing of that deal, though, is in question. House Speaker Nancy Pelosi also signaled some optimism this afternoon, suggesting that she would be willing to bring whatever compromise bill emerges in the Senate to a vote in the House as well, even as Democratic aides are circulating talking points for their own response to this, floating a $2.5 trillion bill. Some of the differing numbers here, they want payments of $1,500 per American, up to $7,500 for a family of five. Increases in unemployment insurance, more than $200 billion for hospitals, and triple the amount of spending for education than is currently allotted in the existing bill. Of course, there are provisions for regulations, some conditions for unions, and also environmental provisions as well, but certainly trying to put a marker down on exactly where they are. Over at the White House, as we await that coronavirus task force briefing, the focus has been on what happens a week from today, Brian, when the president wants to reopen the economy and wants to limit the economic fallout where possible if the healthcare crisis is under control and the economy is able to reopen. And even in places like New York, which is the current epicenter of the virus, leaders are wondering how long the economy can sustain this.
I take total responsibility for shutting off the economy in terms of essential workers. But we also have to start to plan the pivot back to economic functionality, right? You can't stop the economy forever.
As New York Governor Andrew Cuomo, he said that this is an important oxygen valve to the economy that is currently shut off. I imagine, Brian, we'll get a question to the president in just a few moments about exactly what his thoughts are on when the economy should reopen and whether the U.S. healthcare system can withstand that.
Yeah, and Kayla, I know there's a lot of frustration with D.C., but for a lot of our viewers who may not remember 2008 from a business perspective, I think there is a little bit of guidance there. Remember, the initial TARP vote, which was in September of 08, it failed. It failed the Senate. The markets continued to fall. It got them talking again, and ultimately a deal was indeed signed. This is not done yet. And I would imagine the folks you talk to say if things keep getting worse from a financial markets perspective, it will force them to get something done sooner than later.
Yes, but Brian, those of us who were covering this in 2008 also remember that the time period that those discussions were going on was condensed compared to right now. The selling in the market, these downslides have been so protracted at this point that the market drop today is relatively small compared to the volatility that we've seen in recent weeks. And there are some questions about whether it was sharp enough to actually stun lawmakers into submission to get them to understand the urgency of this, to pass something. Back in 2008, the market fell 7% on the day that that TARP vote failed, and that was one of the biggest drops of that time, and that was really what it took, although today's drop, as I noted, is much smaller than even what we saw last week.
Yeah, good stuff there. Kayla Tausche, thank you very much. Well, stocks certainly tumbled on the news that the Senate failed to advance the stimulus package. And also, we just got word less than 30 minutes ago that London will pretty much be on a form of lockdown. Let's bring in now Guy Adami to talk more about all this. And Guy, the reason that I referenced London was, listen, that is the capital of the foreign exchange markets. We don't talk a lot about FX, but it is the largest, most liquid market in the world, and everything is priced in dollars or euros. If there's some dislocation or disruption in the currency markets because of that lockdown, would you expect more market volatility everywhere, particularly here?
Hey, Brian. So the short answer is yes, but what I'll tell you is, and you know this, and it's something we've talked about, we've had currency volatility now for the better part of 18 months. I mean, when I first started doing this in the late 1980s, if a currency moved 1% in 3 weeks, it was a huge move. Now we see percentage moves in a couple of hours, and that's been going on for quite some time. So although this obviously is not going to help volatility in the currency market, it's been here, and it's going to stick around. So I hear what you're saying, and it's somewhat disconcerting, but it probably needed to be done in terms of what's going on over there, and the markets will figure it out.
Yeah, certainly, and it did need to be done from a human health perspective as well. It's just kind of one more thing to factor in here, Guy, and I brought up that TARP analogy in 2008 because would you expect the markets will continue to be volatile and likely volatile to the downside until Congress can get something done?
Yeah, and on Friday you asked me, I'm paraphrasing, but you asked if I had any confidence in our political leaders, and I said no, unequivocally no. I said I had confidence in our fellow citizens and in our neighbors, but to the extent that I had confidence that they'd get anything done, the answer is no. Now, something will get done. I have no idea of knowing when it will get done, but they'll push it to the limit. And in my world, that limit probably takes us down once again to that 2030 level in the S&P 500. Again, not that not that technicals matter, but just quickly, because you try to find some silver linings. And I think Mike Santoli sort of danced around this earlier. You did not have indiscriminate selling today. Everything wasn't down. I know Tim Seymour, I think, tweeted about this earlier, and he's going to come on, but you had NVIDIA up 3.5%, Micron 6%, AMAT 5.7%. So you had some move in these tech names and these chip names. And interestingly enough, and I have no idea what it means, but maybe China is just that much farther ahead on the curve, you had Wynn Resorts up 11%, understanding it's a stock that's gotten annihilated. So around the edges, and this is going to sound ridiculous, but at least you're seeing some semblance of normalcy coming back in terms of people not just selling everything and hitting buttons.
Yeah, does it feel like then, guys, some of this forced selling that obviously existed, hedge funds that probably have gone away or are close to it, quants, algos, people in a desperate rush for cash, does it feel like some of that has slowed down?
Yes. The short answer is yes. When you have a market that's gone down, what is it now, 34% in a short amount of time, a record, I believe. Yeah, I think a lot of that's been done. There's probably a little more left to do, but I think the lion's share has been done. So I think we can take some solace in that. And now I think the market will find its footing in terms of winners and losers. And clearly today, if you look at the industrials, not particularly winners. Clearly the banks are not winners. But around the edges, you're seeing some signs of people saying, you know what, these stocks have just been taken out to the woodshed too much, and maybe there's some value here. So I'll take something out of that.
You referenced China. Okay, Eunice Yoon, who, by the way, has been doing Pulitzer-type work.
Well, you saw what I tweeted. Absolutely.
Yes, absolutely.
100%.
Out there, and I don't know if she's watching, Eunice. We love you, and we're glad that you're safe, first and foremost. She was just tweeting out that Yum Brands in China, KFC, Taco Bell, they announced that 95% of their stores are back to being open, albeit they're still social distancing. It's 2 months ago that Wuhan got locked down. The Chinese market began to recover, about a month ago, roughly, or so. If we look at the curve of China, traffic data, all this stuff, it appears that, to your point, if we go another couple of weeks and follow that curve, that's when we might be able to say, there's the trough. Is China sort of the crystal ball here?
Yeah, well, I think we have to hope that's the case, right? Because they clearly seem to be coming out the other end, albeit slowly. She also mentioned, I think, a zoo was open as well, and that, that's just anecdotal, but that's somewhat encouraging. So, yeah, I mean, I think we can take some hope in that. I think there will be a light at the end of the tunnel. But again, I think what's going on, what happened in China was probably far more draconian in terms of some of the things put in place than what's going on here. We can tell people to stay at home and not leave, but you see the videos as well as I do. Unless people adhere to it, it's really not doing any of us any good. I think people need to take it extraordinarily serious, and if we can, we'll all get through it together.
I like the optimism there at the end. Guy Adami, you be well as well, my friend, and we'll talk to you soon.
Brian.
Thank you very much. Well, today's market drop comes from, even despite of, more unprecedented action from the Federal Reserve. Policymakers unleashing the largest policy action program in the history of the modern world. All in, this is going to be exponentially larger than 2008. The plan is to buy a stunning $125 billion of various securities every day this week. Here's what the Fed has said it will buy or help backstop the banks on. Are you ready? Corporate debt, asset-backed securities, municipal bonds, commercial mortgage-backed securities, By the way, that's in addition to a $300 billion lending program backed by the Treasury. It also includes a separate loan facility not yet formally announced, targeted directly at Main Street, which of course is likely to be hit hardest by this sudden downturn. Let's talk more about all of this with former PIMCO chief economist Paul McCulley, now lecturing at Georgetown. Paul, listen, this is very different than in 08, because in 08, we kind of understood what we were dealing with. Some of the programs were untested. The Fed, it looks like, has basically opened the barn door and said, everything we can do, we're going to do, but we still can't get people to go to stores because they're on lockdown. What's going to be the economic impact of this?
I think we learned a lot from the financial crisis of 2008. I think the Fed learned a lot, which is that when you get hit with something of this nature, bold is not a vice but a virtue, and they are being incredibly bold and basically are saying we have the helicopters all ready to go, and wherever they can get them, they are going to get them, which predominantly right now is liquefying markets, and they're doing it with overwhelming force. The important thing, however, is they can't get the helicopter to land on Main Street until Congress acts to authorize essentially the Main Street funding facility. And that's the beauty of what's going on right now. I actually have a fair amount of optimism in that Secretary Mnuchin and Jay Powell are working very closely together, and they're ready to go with essentially a levered up Main Street lending facility funded by helicopter money. And just waits essentially for Congress to say, okay. So I think we're going all in with both monetary and fiscal policy, which will stabilize the situation. It won't prevent a recession. You can't prevent a recession because this is a mandated recession or an induced coma. But what you can do is replace the income and guarantee the contracts of Main Street to get us to the other side. And I think that's what we're going to do.
Yeah, and I think you laid it out well. I mean, there's still economists on Wall Street, with all due respect to them, that are arguing about, whether we will have a recession. That's ridiculous. To your point, this is a mandated recession. The largest cities in America have basically been told, don't go out, don't spend anything unless you absolutely have to. It's going to come. The difference, though, between now and 08, Paul, as you well know, was 08, these things were designed to get people to feel a little more confident, maybe go buy a house, maybe go buy a car, allow the banks to make credit. Here, we had a great economy before in many senses, and now we're being told, don't go out. This is very different.
It is categorically different because it's not about stimulating spending. It's about replacing income that's lost because of the mandated recession. And equally important, it's about liquefying and guaranteeing contracts, whether it's financial contracts, that's called, bonds, or other contracts, so as that we, the people, can conclude that we're living in a going concern. Because we need to have replacement of income and also a belief in the going concern nature of our contracts. If we get there, then I think we've reached the bottom from the standpoint of the risk aversion on Wall Street.
When we look at what the numbers are, and we tried to put it together today a little bit and say adding up this and that, and then you throw on leverage from the Treasury, is it possible that by the end of this, if this goes on a few months or as long as we need it to go on, Paul, that we could have a $7 to $10 trillion total fiscal and monetary action?
Certainly, I think so. Essentially, the beauty of what's being done now and the cooperation between the Treasury and the Fed is the leverage. The Fed is not allowed to take credit risk. The Treasury is with the authorization of Congress. So essentially, what we're doing is having Treasury provide the equity piece into a special purpose vehicle that can be levered to the sky by the Fed. So essentially, the Fed is becoming the prime broker for Congress.
Final question, will this work?
I think it will, yes. Our economy is a going concern, and we're getting really close in the financial markets to playing it that way.
I like the optimism there again at the end. Paul McCulley now at Georgetown. Paul, it's a pleasure. We'll talk to you soon. I have a feeling. Thank you very much.
Thanks, my friend.
All right, take care. Oh, and of course, we're going to have much more on all of this in a CNBC special report tonight. Once again, 7 p.m. Eastern Time. Join Scott and the gang for that. All right, on deck as our special coverage continues here, some signs of stability. The one stock that could be pointing to a near-term bottom for the market. Maybe. We're going to bring you that name ahead. And we are just minutes away from the White House briefing on the coronavirus. We will take you there live as soon as it begins. And we are back right after this short break. And welcome back. You are looking live at the White House, where we are awaiting a briefing on the coronavirus. We're going to bring that to you live the moment that it begins. But in the meantime, let's turn down back to the reason that you're probably here, the markets and the economy. Look at Apple stock. It fell fairly hard today. Apple is down nearly 24% this year and risk of losing its spot in the trillion-dollar club. But the big sell-off in technology has some investors licking their chops for the long term. Here's what hedge fund titan David Tepper said earlier today on CNBC.
I'm nibbling there and a little bit of healthcare today, hospitals and such, but mostly there I'm nibbling, I would say, in that tech sort of stuff.
Let's now bring in Dan Nathan. All right, Dan, welcome. Like last week, you said that when Apple and Microsoft began to really sell off, even as other parts of the market didn't, that actually might, to you, signal a bottom. Again, why is that, and what did you see today?
Well, yeah, Sully. So last week when we were talking about it, to me, the relative outperformance of, let's say, the two largest names in the market, Microsoft and Apple, really stuck out to me last week. And you just mentioned that Apple now is down about 24% on the year. That's basically in line with the S&P 500. That was not the case early last week. It's down about 30% from its all-time and 52-week highs, also made last month. That is also in line basically with the S&P 500. So the fact that it's catching up to the downside after the S&P and a lot of the components and a lot of the sectors were really getting murdered last week shows me that you're finally seeing a bit of that forced selling that you've been talking about. You know, people will try to hold on to the winners like Apple and Microsoft as long as they can, and then finally you're just selling whatever you got, whatever you have that's left that's up. And I think you got to remember, Apple was up 85% in 2019, up 100% from its January 2019 lows by the end of the year. So when you think about that sort of outperformance, it really has to come out on the downside. And that was one of the things that I thought might show a little bit of capitulation. And that being said, I was just listening to Guy Adami, one of the smartest guys I know in this market. And what was he trying to show you? Look at the outperformance today to the upside of some of these groups like semiconductors that were some of the hardest hit first. I think that's a really interesting tell, the juxtaposition between Apple and, let's say, the semis.
Yeah, and despite some really difficult inventory data that we are likely to get, actually oil caught a bid, rising toward the end. But Dan, I want to focus too on the banks. I mean, Bank of America down another 8% today. It's down 48% this year. The market certainly didn't act like we were out of the banking woods yet.
Well, I'll tell you, you mentioned banks. Look at the home builders. You saw energy stocks, despite crude being up. You know, there were some areas in the market today that just acted horrible. And you might say, well, that's near capitulation too. We're one fiscal stimulus headline away from a massive short squeeze in those names. They're just being pressed to the downside for really, at this point, no great reason other than liquidation, because we really can't put our fingers just yet on what Q1 and Q2 looks like. So to me, you know, the selling in those spaces looks a bit indiscriminate, especially for a lot of these people. I see the calls for opening the economy back up sooner than later seem to be growing a little bit, and that's where investors could really get caught offsides a little bit on sectors like the banks, like home builders. I'm not telling you they're coming back anytime soon, but make no mistake, a vicious, vicious short squeeze is coming pretty soon.
Yeah, and so you believe that we could see some violent moves to the upside sooner than later?
Well, I mean, it gets to a point, Sully, where there's no one really left to sell. When you think about how fast we've come down 30% in the S&P 500, and to your point, where bank stocks have basically massively outperformed to the downside versus the indices, you know, at some point you're going to get a bit of a snapback. You know, we don't know what we don't know at this point, but the fact is there's been not a shred of good news for the last month or so. Sooner or later we're going to get some, and we're going to see basically just how convicted the shorts are here, and I suspect you see a really, really violent short covering rally in the next week or so.
Yeah, but from a longer-term perspective, you don't believe it's still safe enough for our casual investor viewers and listeners out there to start reallocating a lot of money to the overall market right now?
Listen, if you have cash right now, the idea with the S&P 500 down 30% to start dollar cost averaging in makes a lot of sense. We've talked about this a lot. The last two recessions we've had in 2001 and then 2007, 8, 9, in that period where the stock market sold off in each instance about 50%. I suspect that we are definitely going to have a recession in 2020. The real question is how deep and how long? And at this point, down 30%, we're discounting a definite recession, but we don't know those other two answers. So if you think about the worst case scenario is down 50%, let's say garden variety recession / market crash, well, then you really have to start thinking about 5-10 years out and start picking at these things. But I'll make one point about Apple. We just said it was up 85% last year in a year where earnings, sales, iPhone units, and margins did not go up, all right? They were basically all flat year over year. So you had this massive multiple expansion. Now the stock is back at 16 times, but consensus estimates is still calling for about 10% earnings growth, about 4% sales growth. That seems a bit aggressive. So the stock is probably still too expensive. So until we start getting more visibility about Q1 and what maybe Q2 looks like and the snapback in the second half, if it comes, stocks are still pretty expensive. If you think about how we calculate P and E, we know that the E is going to be coming down, but we don't have any visibility on that. So Apple has more room to drop. It may rally sharply, but to my eye, you probably have a move back to 200 at some point later on this year.
Yeah, because it's not like companies are saying we're going to be down 10% in earnings. It's we don't have any idea. We're withdrawing all of our guidance. That E is a giant mystery. And anybody tells you otherwise, I think they're just guessing. Dan, Nathan, appreciate it, buddy. Thank you very much for joining us.
Sure.
All right. Coming up, some potentially good market news, because we know you need some. Why one top-ranked technician says we could be closing in on a bottom. Something has happened. It's only happened 4 times in 100 years. He'll talk about that. And we're still awaiting that White House briefing, expected to get underway in moments. We'll bring it to you when it does. Stick around. All right, welcome back. Let's get you now up to speed on the latest in the fight against the coronavirus pandemic. Frank Holland has that at CNBC HQ. Frank.
Brian, here is the very latest. New Zealand is joining the list of countries that are mandating that their citizens stay at home. The Prime Minister says this lockdown will last about 4 weeks. Citizens are getting 48 hours to prepare to go into self-isolation. Back here in the U.S., New Jersey has become the first state in the nation to release prisoners in an effort to slow the spread of coronavirus. The move affects some low-risk inmates at county jails. And Virginia is closing its public schools for the rest of the academic year. Governor Northam had previously announced a 2-week school closure. Some businesses are also being ordered to close. That includes gyms, theaters, and bowling alleys. And some people in Boston, they're trying their hardest to find the lighter side of this outbreak. The duck and duckling statues, a fixture in Boston's public garden, they are now wearing masks. The figures come from the children's book, Make Way for Ducklings, and those statues, a very popular tourist attraction. And Brian, as always, for more coronavirus coverage, head to CNBC.com.
Well, those ducks don't want to run afoul of the law requiring them. Listen,
we don't need puns at this time.
We need something. Frank, it's been a long couple weeks.
It has.
Frank Holland, thank you very much. Appreciate that. All right, coming up, we are just moments away for that White House briefing on the coronavirus. We'll take you there live. We'll also get an update on the technicals of this market. Any reason to be a little more optimistic? We'll talk about it coming up. Stick around.
again.
All right, welcome back. There's a live look at the White House where we are awaiting a briefing on the coronavirus outbreak. We're going to bring that to you as live as soon as it occurs. But while we await that, let us bring in Craig Johnson. He is Chief Market Technician at Piper Sandler and joins us now. And Craig, by the way, if I have to cut away because of the briefing, my apologies in advance, my friend. You sent me a note saying that there are some things technically that you're seeing that you've only seen or have happened 4 times in the last 50 or plus years. What are they, and does it give you some optimism that a bottom is near?
Brian, that is absolutely correct. This is only the 4th time we've seen all these breadth measures from a technical perspective reach zero. And the last several times we have seen this, you had huge opportunities to be buying stocks. Not only are these indicators at zero, sentiment gauges that we look at are all at very, very washed out levels. And now is the time we need to start leaning in and start buying stocks in here. Yes, the news is really negative with the coronavirus, but a lot of it is already baked in at this point in time. And when we have gone to be more than 20% below a simple 200-day moving average, Brian, looking back into the 1974 crisis, looking back at 08, 09, looking back at where we were in December of 18 when we were on the show talking about when it was time to buy stocks, this is when you step up and you start leaning into it and start buying stocks here.
You know, however, though, Craig, we hear often, in fact, we heard at the top of this show that technicals don't matter much right now in this kind of an environment. What's your answer to that?
The answer to that is flat out that is incorrect, because you look at some of the Fibonacci retracement levels, you look at support levels. Yes, you're breaking through some of these support levels because of the coronavirus and concerns about loved ones and things like that and selling in these stocks. But you are seeing support levels being obeyed, and you are seeing trend changes starting to happen. And the technicals do matter, because right now earnings don't at this point in time, because we have no idea what the revisions to these earnings are going to look like. So support levels do matter.
You said might be time to start looking at certain stocks. Is there any stocks or industries that to you maybe look more washed out than others and would be a better long-term bet? Because you are supposed to buy low and sell higher.
Absolutely. And if you pull the playbook of what happened back in 08 and 09, everybody scrambled to get back into the market. You even saw that coming off the lows in December of 18. So some of these companies, like the restaurants, for example, whether it's Chipotle, whether it's Wendy's, whether it's any of those kind of names, they are down more than 50, 60, even in some cases 70% from the highs you'd seen back in January. Also, look at what you're doing with the airlines. There is going to be some support coming from a fiscal stimulus package for those, and I suspect you're going to see the same for the cruise lines. All those kind of names are tremendously sold off, well overdone, and you want to step up and be buying some of those names at this point in time. Also, names like Nike.
Hold on, Craig. I'm going to jump in because I'm sure I know you've got fundamental analysts there as well, and everybody's still working despite not being able to be in the same room. I'm sure there is some talk that some of these stocks, and I'm not going to, no way am I going to name any names, are going to go to zero. I mean, there's going to be bankruptcies in some of those industries.
There is potential for some of these to go to zero, as you would say. But again, think about what is happening with fiscal policy. They're going to put some processes in place, make liquidity available to a lot of these restaurants and to a lot of these airlines and to the cruise lines. And I think they're going to see these companies snap back pretty quickly. You can even go look at some of these food distributors, Brian. I mean, we've got real issues if some of these food distributors are going to zero.
Yeah, well, obviously not those. I'm talking about just sort of, beaten up retailers as well that have already been struggling, restaurants, retailers, whatever, already struggling before this outbreak. Hey, by the way, Craig, have you looked at all the Chinese market? Now, China's got, obviously, they got sort of the iron fist as far as they can, they'll go in and buy stocks of their own companies and the party's part of a shareholder and part of many of these companies. So it's not perfectly analogous. But have you found any solace in the fact that the Chinese market has held up reasonably well?
Absolutely, and I think it is kind of the playbook for us looking forward from here. We're going to kind of hit the peak of this coronavirus over the next several weeks in here. We've discounted a lot of the negative impact for the virus into the market at this point in time. And if we could just get the politicians to kind of get on the same page with each other and put a plan together here, I think we're going to see a long way and see a lot of these stocks come back, just like you've seen over in China at this point in time, Brian.
What's the next most important either data point or anything that you are looking at, Craig?
The next important data point that I'm going to be watching is I want to continue to see strength in the dollar. That means that the dollar is still on good, solid, footing at that point in time. Also, after that, I'm going to be watching to see some of these stocks start to reverse some of their downtrends, and I'm going to ultimately be watching to see if we can see the bond market ultimately continue to remain stable in here. I think the Fed action today was critical to stabilizing the bond market, and I think that's going to be a critical part to what we're going to see happen with equities in the next coming days and weeks.
Yeah, we highlighted last week the LQD and some of these other bond funds. I wrote a piece about it about a week and a half ago about some of these bond funds that you really had to watch as sort of signposts. The LQD actually rising nearly 8%. That's an investment grade bond index. That's the kind of stuff you're talking about. Seeing that go up is kind of a canary in a good kind of a coal mine, perhaps.
Yes, that is correct. And I'd also add into that the VIX. The VIX index spiked at 80, is now starting to come down. So I think we're starting to get a little bit more calm into the market. Things seem to be functioning a little bit better. Today was a great day in the market. Liquidity seemed to be fine. Things seem to be orderly, even though this is the first day for electronic trading across the board with the floor closed. Everything seemed to be functioning normally, and things seem to be getting on the right track again.
Yeah, amazing. And I will let you go. Craig, by the way, nailed the run-up the entire way last year. So, Craig, we really appreciate your point of view. And by the way, I believe it is the first day in 200 and some years that the NYSE has had trading, but without a physical presence. It's been closed as trading was closed after 9/11, but I believe this is the first time they've traded without people. Craig Johnson, thank you very much. Do appreciate that. Well, CNBC, of course, has continuing coverage of today's sell-off, the markets, the economy, and the stimulus plan, which failed the Senate yet again. Be sure to catch that tonight, as always, 7 p.m. Eastern Time. Meantime, studying new details on how the coronavirus is impacting what is likely your most valuable investment. Do you think low rates are just going to keep housing booming? You might want to think again. Diane Olick will join us on that. Plus, again, waiting on the White House briefing on the virus. When that occurs, we'll bring it to you live. Meantime, we're back right after this. All right, and as a reminder, we are awaiting the latest White House press briefing on the coronavirus. When it occurs, we will bring it to you live. We expected it to begin about 15 minutes ago, so it could happen at any time. Now, in the meantime, the outbreak in the move-in bond market's having a big impact on the housing market. Many homeowners, no doubt, are going to be looking for relief on their mortgage payments. And now the mortgage industry is starting to feel the pressure. Diana Olick joining us now live with more on that side of the story. Diana.
Brian, last week, Fannie Mae, Freddie Mac, and the FHA announced loan forbearance, allowing borrowers impacted by coronavirus to delay their monthly mortgage payments. And that's a big help for borrowers. But here's the catch. The companies that collect those payments, the servicers, they still have to pay the investors who own those loans in mortgage-backed bonds, or MBS. Now, servicers can handle some delinquencies, but nothing like we are likely about to see. The Mortgage Bankers Association sent a letter to the Fed and Treasury late yesterday saying the burden on servicers could top $100 billion, which those servicers just don't have.
Nobody predicted the demands that this would place on servicers. So they need an ability to have the liquidity to make it happen. And if there's not some kind of ability through a liquidity facility, then the servicers won't be able to meet their obligations to the investors, and the whole process will break down.
So the servicers could actually go bankrupt, taking the whole housing finance system down with them. Now, just a note, earlier today, the FHFA announced it would allow multifamily mortgage borrowers to delay their monthly payments as long as they don't evict any tenants. So, Brian, you can see this is all trickling down to that system that gets the money from you to the investors in the mortgage-backed bonds and keeps the system going.
Let's go back to the actual market itself if we can, Diana, because obviously mortgage rates, interest rates, they've actually ticked up. When you issue so much debt, you're going to start to see interest rates go up a bit, but they are still very near lows. Mortgage rates, you just look at them on paper, they're near lows. But could you get a mortgage right now if you wanted to? I mean, are we starting to see this impact the actual housing market? I have to believe we are.
Yeah, I mean, can you get a mortgage now? Yes, you certainly can. I mean, the rates have been fluctuating pretty widely. We had them down at record lows just 3 weeks ago. Then they bumped out pretty dramatically toward the end of last week. So a lot of people are in refinances. There's a lot of questions of how are they going to close those loans? You know, if you can't do the closing in person, then can you do a notarization online? A lot of states don't allow it. Right now, they're trying to push to make that system happen online. So closing could be hard. And for the purchase side of it, you know, honestly, I don't know that there are a lot of people out there who want to buy a house right this minute. That doesn't mean there isn't a tremendous amount of demand in the market. And of course, we still don't have that many homes for sale. And to make matters worse, now people are actually delisting the properties that they wanted to sell this spring.
Yeah, and of course, all this stuff that we talk about really only recently that happens behind the scenes in the mortgage market, the grease on the wheels, you mentioned MBS trading, all these things that we really hadn't thought about since 2008 and 2009. The Fed did a good job of loosening that up. But the folks you talked to today, what are they actually hearing about how the mortgage market is functioning?
Well, the mortgage market is, you know, it's still functioning. You can, as I said, still get a loan, but it's a question of, are MBS investors still in that market? Have they gotten, you know, so priced out that they just don't want to be in it anymore? So nervous about the risk that we're going to see more prepayments, that we're going to see more loan delinquencies, that they just don't want to buy those mortgage-backed bonds. But of course, then the Fed came in and is now saying they're going to buy billions of dollars worth. So the system will continue. We will see mortgages made. It's just a question of who's going to want to be in that market. And remember, back during the subprime mortgage crisis, we had a lot of loan delinquencies, a lot of foreclosures, but they happened over a long period of time. It was 3 to 4 years that those loans went bad. Now we're looking at potential delinquencies spiking in just 1 or 2 months, and that's a lot for the system to handle.
Yeah, as Paul McCulley said at the top of the show, it's kind of a government-mandated recession in a way. Basically, they're telling you, don't do certain things. Diana Olick looking at the housing side of the story. Diana, thank you very much. All right, coming up, Boeing stock getting a much-needed boost today, but it has still been an absolutely terrible year for the company and its investors. $400 last year, $105 today. We'll find out what is next for that stock, and we are still awaiting that White House briefing. When it occurs, we'll take it to you. Meantime, we're going to take a break, and we'll be back right after this.
Index.com.
I want to show you something I honestly didn't think we'd ever see. That is Times Square. It's almost 6 p.m. This would be normally rush hour. You can see there are 2 police cars there and somebody on a bike going by, but there is absolutely nobody in Times Square. I just sent out a picture on Instagram and Twitter as well. I know it's raining, but even on a rainy night in New York City at 6 p.m., there would be tens of thousands of people rushing through that intersection right there. Truly incredible scenes in New York City. Well, probably the same in D.C. And D.C. is, of course, where we are expecting any moment. We were expecting 20 minutes ago, actually, to get this coronavirus hearing or press briefing started. It has not. When it does, we will bring it to you. In the meantime, back to the markets. And let's talk about Boeing. Boeing today rising 11%, helping to pare some of the losses on the Dow, despite the fact the company said it is shutting down factories in Washington state due to the coronavirus. Phil LeBeau has more on the Boeing story, which has been a $400 to $100 stock. Truly a year to forget for Boeing and its investors, Phil.
That's true, Brian. But in terms of what the stock did today, remember that you had Goldman ringing the bell on Boeing and basically saying, look, we think the worst news is already baked in. That's one reason why the stock moved higher today. But as you mentioned, there was some news regarding Boeing today. The company's suspending its manufacturing operations in the Puget Sound area, all around Seattle. That includes the Everett, Washington plant, where they build this 777 and the 787 Dreamliner. By the way, the suspension of that production, that kicks in on Wednesday. The workers will get paid, however, during the suspension. This is one more case of coronavirus having an impact on manufacturing here in the U.S. And in terms of the airline industry, I want to switch gears a little bit because so many people have been asking me today, are they going to get this bailout, this $50 billion that is going to help them? Yeah, they're going to get the $50 billion. The question is, will there be a cash grant so they can immediately tide over salaries? That would be $25 billion. Or is it going to be all $50 billion in loans collateralized to aircraft, which is not what the industry wants? And one last thing, check out the airline index. BofA today basically saying, look, these guys have a couple of months where they either get the bailout or in a couple of months you may see some bankruptcies there. So some news happening not only with the airlines but also with Boeing. And by the way, speaking of Boeing, you do not want to miss this interview. First on CNBC, tomorrow morning on Squawk Box, 8 a.m. Eastern. We will be talking with Dave Calhoun, CEO of Boeing. It has been a very, very challenging month for Boeing. Lots of questions for Dave Calhoun. You do not want to miss that interview. Brian?
That is a big interview. And of course, Dave coming in and thinking he's going to be dealing with the 737 MAX issues. Now he's dealing with the 737 MAX issues, but they seem small in many ways, I would imagine, compared to the largest drop-off in airline passenger demand except for a few days probably after 9/11. I mean, truly incredible times to come in as a new CEO, not a new CEO, but a new CEO to Boeing.
And the big concern in the industry, Brian, especially for investors, is will the problems in the airline industry, and it's not just here in North America, it's worldwide, will it lead to a number of airlines saying, you know what, I'm going to either defer or cancel deliveries that I'm on the books for, let's say, later this year, next year, whatever it might be. At some point, will they defer those, which obviously will hurt the backlog at Boeing to a certain extent. And it really has people questioning whether or not this great bull run that we've seen over the last 10 years, really, when it comes to aircraft orders, is it done? Is it done because of what we're seeing the airline industry go through right now? We'll talk to Dave Calhoun about that.
Yeah, that is a big interview. You cannot afford to miss. 8 o'clock tomorrow morning, Phil. We will look forward to that. Phil, thank you very much. All right, coming up more on today's market side. Dow falling another 3%, now down 37% from its all-time highs just 1 month ago. The steepest drop of that magnitude, the fastest drop in the history of the stock market. Of course, still waiting on D.C. in many ways, by the way, not just the White House briefing. We had a failed stimulus plan vote today as well. We're back with a lot more right after this. And a reminder, still waiting on the coronavirus outbreak briefing at the White House. When it begins, we're going to take it to you live. All right, investors also frantically searching, not just for some sort of guidance and stimulus from D.C., but safety in this market, which continues to drop, down another 3% today. So where exactly might there be some havens out there? Let's bring in CNBC contributor Brian Kelly. Brian, we had seen pretty much everything fall last week, even things like gold and Bitcoin, because people were in a rush to raise cash. It appears some stabilization in maybe those markets the last couple of sessions. What are you seeing, and do you believe that gold, Bitcoin, and other assets may be a place to park some money right now?
Yeah, hey, Sully. It's exactly right. There was actually some silver lining out there today. I know people focus, on the stock market and they see it down 3% and they go, oh, geez, things are still bad. But there was some good news out there. I mean, one, the bond market. That's the most important thing. You had Diane on talking about the chain effect of having rising rates and having a dysfunctioning fixed income market. What the Fed did today was essential to stop that problem. So that's step one. Bonds went up. That's great news. Yeah, they're going to be printing a lot of money. They're going to be borrowing a lot of money, but investors can protect themselves by buying things that have a fixed supply, which is gold, which is Bitcoin, stuff like that. And so both of those went up. The market started to react like it, quote unquote, is supposed to react today, which means some of the forced liquidation is likely done. And this is maybe, and I'm trying to have some optimism here, we're forming a bottom.
Yeah, BK, sit tight for 1 second. Obviously, it's 6 o'clock Eastern time, and most of our audience right now is tuning in for Jim Cramer and Mad Money. Jim and Mad will come up, but they will begin at the bottom of the hour, so 6:30 p.m. Eastern time for Jim and Mad Money. He's got a big lineup, including the CEOs of Teladoc and Ventas as well. Tonight, a little bit different because we are expecting, or were expecting, this White House press conference, which could begin at any moment. For those of you tuning in, who obviously tune in, love Jim, love to watch Mad, he'll be on, but it's 6:30 p.m. Eastern time. BK, thank you for that pause. I wanted to make sure our viewers understood why we are still on and not Jim. What do you want to see happen from the market the next couple of sessions, which might confirm some of those things that you're talking about?
Yeah, so what I'm really looking for is how the equity markets react to this stimulus bill. It looked like today when we were getting close to a vote, the equity market tried to rally, then the vote failed, equity market sold off. So to me, that's the real key here. We've got a couple pieces of the puzzle, which we have the bond market, we have the forced liquidation ending. Now, if we can get the equity market to react to the stimulus, then I think you might have, a tradable bottom, a short squeeze coming, whatever you want to call it. I think we see some stabilization in asset prices.
Yeah, and what's your concern point? We've tried to be able to find some pockets of optimism pretty much all show long, but is there something that you're still watching that has you a little bit worried still, BK?
So it's the currency markets. We've seen tremendous volatility in the currency markets and tremendous volatility in fixed income. And in particular, I'm watching Japan. So we all know that every single government out there is going to have to raise a lot of money. What's happening in Japan is very concerning because you're starting to see the yen weaken for the wrong reasons. You're seeing their credit default swaps, and we're bringing back all those three-letter names from the 2008 crisis. But this basically shows you, do people believe that Japan is going to default? And those prices are going up. So there's an issue there, and that's, if you're an investor, you need to keep a close eye on what's going on in Japan.
Yeah, by the way, according to our great data team, U.S. index futures opened for trading just a couple of minutes ago, and they are higher. I mean, it's very early right now, but the Dow's implied open is about a gain of 245 points. I mean, that would be less than half what we lost today, and we've got a long way to go. How representative do you think, BK, these futures markets, the Asian markets have been? Or has literally the U.S. market been leading the world, and we don't really know what's going to happen until trading begins?
Yeah, it's one of those things where ask me in 10 minutes. You look this morning when the Fed came in and the market had swung 1,000 Dow points, and then by 10:30 it had been all erased. So it's really difficult to get a feel and a read on this market much longer than a couple hours these days. Again, I'll go back to if the U.S. government can pass this stimulus, I think that should be relatively positive for equities.
Yeah, and we look at these equity markets and we think, okay, we're down 37% since the highs of a month ago. All the superlatives that our viewers now know. The fastest, steepest descent ever down that far, but yet we still haven't fallen as much as 2001 or as 2008. Do you think we got to test that? And Guy Adami said it earlier, 2,000, 2,100 level or 1,700 on the S&P 500 that Scott Minerd is talking about. As painful as those levels sound, do you believe we're going to get there?
Yeah, listen, we could, and I know that sounds painful, but I'll tell you what, that's when investors really want to have some cash on hand. I mean, if you look at some of the biggest rallies that we've had, they've all occurred in the bear market. And, there's a lot of stories today about this is the worst market since the 1930s. But even in the 1930s, you had an initial 30% drop from 29 to 30, and then the market rallied 50% off the lows. So if you're looking for a point to get in here, that might be the place, and you could have a massive rally, and we likely will, even if it remains a bear market.
Yeah, and that's exactly what Dan Nathan was saying earlier. He said, do not be surprised, like, by the way, we had last week and the week before, to see a violent rally to the upside. But it sounds like if and when we get that, you'd be a seller into that.
Yeah, but I would let it run for a couple of weeks. I think Dan's probably right. You've got some time here that the shorts are going to cover. Hopefully we get some better news about this virus as we kind of move out in time. But yeah, if we got a 50% rally off the lows, I would absolutely be a seller of that.
What's the next most important data point, BK, that you might be watching for? I would assume, maybe I'm wrong, that economic data is completely worthless at this point.
Yeah, it pretty much is. We know it's going to be bad. And really,
well, it's going to be backward looking, right? The U.S. economy added whatever job. I mean, come on. All we care about is what's going to happen.
And the market's already priced it in. Right. So really, listen, all that matters, what we saw out of Italy today was some good news on the virus.
Yes.
Good news on the virus. That's really what's going to change.
And by the way, if viewers don't know what you're talking about, it's the second day in a row where the number of new cases declined. Still a lot of new, not minimizing that in any way, BK, but I think what you're pointing to is the number of new cases ticked down 2 days in a row.
Yeah, and this is what markets look at. So this is not to minimize the health crisis at all. What we're supposed to do is look at the markets and try to help people invest in that. And so what markets are going to be looking for is changes in the data. So those kind of 2 days in a row, that's a data point that I can look at and say, okay, it maybe this is the peak in Italy, and then I can extrapolate and say that's coming a couple weeks here. The problem people have had, and you've talked about it all day and on the show tonight, is that you don't know how long this is going to last. You don't know what your earnings are going to be. You don't know what kind of hit you're going to take. If you can put some clarity around that, then people can start investing again.
And by the way, I mean, listen, other people can give the numbers, but I bring this from a market's perspective. I look at the Johns Hopkins screen like so many people do these days. And by the way, shout out to them and great work by them and their team. I'm sure they're working tirelessly. Every night about 5 o'clock, I look at the numbers and I mark it down. 5 o'clock on Friday, there were 16,600 known U.S. cases. Right now, there are 42,000, 16,000 to 42,000 from Friday to Monday. When, not if, but when that U.S. number also begins to roll over for a couple of days' time, what kind of a mood do you think we're going to start to feel in this market?
I think we're going to feel a lot better. I think we're going to feel an awful lot better. It's probably 2 or 3 weeks away, but I think, then people are going to start saying, okay, I can model out when this is going to peak, when we might be out of a quarantine, and when people can start getting back to work. Now I know how much earnings people have lost, and now I can start to put some valuations on stock. But to your point about economic data being worthless, I just don't know right now. So how do I put any type of valuation framework in when the most important thing is an uncertainty about earnings?
Is there any company that you're going to listen to more than any other company going forward here, BK?
Well, I mean, certainly, I want to see how the freight companies do, and I'm not just talking about FedEx, but I'm talking about some of the railroads, certainly the airlines. How fast do they get back up and running? Because that's the other key. When we get to the other side of this, are we going to have a fast recovery? Everybody going to go back out there, jump on the planes and say, all right, I'm going on vacation. do we need to ramp up that supply chain again? So I want to watch the railroads, the transports outside of FedEx and UPS because we know they're actually probably going to be doing very well because they're delivering. I don't know about you, but I can't get my Amazon Fresh order for another week.
Yeah, I know. Listen, there is a long wait time as well. These delivery folks, they've been out there pretty much all morning long, all night long in bad weather. Today, the weather was just absolutely terrible. So a shout out to them as well. And by the way, if our viewers are just joining us and they wonder where Jim and Mad Money is, Jim will be planning to come along at 6:30 p.m. Eastern time tonight. We expected that press conference that you see glimmers of, and you can see AG William Barr is on stage right now, to begin about 5:30 p.m. Eastern. That's the guidance we were given anyway. Obviously, it did not occur. It is now 6:10, 40 minutes past the start time, although it looks like they are getting started. Once they do, we will take that to you live. And if you are just joining us and you've been working hard, because a lot of you have, certainly at home, trying to keep working, dealing with the families as well, the Dow fell 582 points today. That was a 3% drop. The NASDAQ, maybe a bright spot. The NASDAQ falling just 0.3%. So technology, parts of it anywhere, like Twitter, they held on a little bit longer. The dollar index fell 0.3%, although with this London shutdown, certainly watch the currency markets. London is a hub of capital, but foreign exchange trading in particular, obviously a lot of people are still going to be allowed to go to work at the banks, but it is possible FX trading, which powers so much around the world, could see some dislocations as well. The 10-year yield at 0.79%. BK's favorite Bitcoin rising nearly 3% today, and crude oil actually catching a bit of a bid too. So there's kind of your rundown of where the markets were today. BK, I believe you are still there. And by the way, this is the most time you've ever been given on Fast Money, so you're welcome, by the way, on that. I look at oil, I look at Bitcoin, I'm trying to see a pattern. I don't necessarily see one forming yet. Have you been able to spot any patterns in this market that may start to be forming?
Well, I can just tell you from the seat that I'm on, we run a cryptocurrency hedge fund. We have seen a tremendous amount of institutional interest in Bitcoin and cryptocurrencies. So I'm starting to see that pattern first. And that certainly makes sense in this environment, right? This is the exact environment that Bitcoin was created for. It was created in 2009 during that crisis because people were concerned that they were going to print so much money.
Brian, I got to jump in. Thank you very much. Now let's go to the White House and President Trump.
Well, thank you very much. And I see we have fewer people because of the virus problem, and we appreciate you being here. And this is getting to be more and more social distancing, and that's fine. That's the way it should be, and it's too bad. We extend our best wishes to the person affected, and we feel sure that he or she will be better very soon. And thank you for being here. America continues to mobilize every segment of our society to turn the tide in the battle against the virus. I want Americans to know that we will get through this challenge. The hardship will end. It will end soon. Normal life will return, and our economy will rebound very, very strongly. But right now, in the midst of this great national trial, Americans must remain united in purpose and focused on victory. To every single American, please know that the sacrifice you're making at this time is saving lives, many, many lives. It's very important that we totally protect our Asian American community in the United States and all around the world. They're amazing people, and the spreading of the virus is not their fault in any way, shape, or form. They're working closely with us to get rid of it. We will prevail together. It's very important. From the beginning, we have been working closely with our nation's best scientists and medical professionals, and we will continue to do so until we have defeated the virus. Our public health experts, who are terrific, are studying the variation in the disease across the country, and we will be using data to recommend new protocols to allow local economies to cautiously resume their activity at the appropriate time. We also have a large team working on what the next steps will be once the medical community gives a region the okay, meaning the okay to get going, to get back. Let's go to work. Our country wasn't built to be shut down. This is not a country that was built for this. It was not built to be shut down. My administration continues to work with Democrats and Republicans to reach an agreement on an urgent relief bill for the millions of American workers and small businesses and large businesses that were badly affected by the medical difficulty that we've had. If you had a viable business in January, we are committed to ensuring the same is true in the coming weeks. In fact, we want to make it even better than it was before, and we're doing things to help in that regard. America will again and soon be open for business, very soon, a lot sooner than 3 or 4 months that somebody was suggesting. A lot sooner. We cannot let the cure be worse than the problem itself. We're not going to let the cure be worse than the problem. At the end of the 15-day period, we'll make a decision as to which way we want to go, where we want to go, the timing, and essentially we're referring to the timing of the opening, essentially the opening of our country, because we have it pretty well shut down in order to get rid of this invisible enemy. 2 weeks ago, we moved at record speed to pass paid sick leave and paid family medical leave and approved $8 billion, including money for the development of treatments and vaccines. And we're doing tremendous work on both fronts. The vaccines are coming along very quickly. Now Congress must demonstrate the same bipartisanship again and join together to pass the Senate bill as written and avoid playing any more partisan games. They have to get together and just stop with the partisan politics. And I think that's happening. I got a call a little while ago. I guess they're getting closer. It should go quickly. And it must go quickly. It's not really a choice. They don't have a choice. They have to make a deal. This should not be a time for political agendas, but rather one for focusing solely and squarely on the needs of the American people. We are going to save American workers, and we're going to save them quickly. And we're going to save our great American companies, both small and large. This was a medical problem. We are not going to let it turn into a long-lasting financial problem. Started out as a purely medical problem, and it's not going to go beyond that. We're just not going to allow that to happen. Our country was at its strongest financial point. We've never had an economy like we had just a few weeks ago, and then it got hit with something that nobody could have ever thought possible. And we are fixing it. We're fixing it quickly. And I want to just thank the American people for what they've been through and what they're doing. Our country will be stronger than ever before, and we fully anticipate that, and it won't be that long. Let me provide you with an update on critical supplies. FEMA is distributing 8 million N95 respirator masks and 13.3 million surgical masks across the country right now. Focusing on the areas with the greatest need, we've shipped 73 pallets of personal protective equipment to New York City and 36 pallets to the state of Washington. In the past 96 hours, FEMA has also received donations of approximately 6.5 million masks. We're having millions and millions of masks made as we speak, and other personal protective equipment, which we will be distributing to medical hotspots. We're focused on some of the hotspots. Across the nation, we're seeing an outpouring of creativity and innovative ideas widely shared between the federal health leaders, governors, and mayors, the scientific community, and members of the private sector. Really working together. Everybody's working together. I'm pleased to report that clinical trials in New York will begin existing for existing drugs that may prove effective against the virus. At my direction, the federal government is working to help obtain large quantities of chloroquine. And you can look from any standpoint tomorrow in New York. We think tomorrow pretty early, the hydroxychloroquine and the Z-Pak, I think is a combination, probably is looking very, very good, and it's going to be distributed. We have 10,000 units going, and it'll be distributed tomorrow. It'll be available, and is now. They already have it. They're going to distribute it tomorrow morning to a lot of people in New York City and New York. We're studying it very closely, watching it very closely. You probably saw a couple of articles today came out where a gentleman, they thought he was not going to make it. He said goodbye to his family. They had given him the drug just a little while before, but he thought it was over. His family thought he was going to die. And a number of hours later, he woke up, felt good. Then he woke up again, and he felt really good, and he's in good shape. And he's very happy for this particular drug that we got approved in record-setting time. There's never been anything even close to it. And I want to thank the FDA, which has been incredible, and Dr. Hahn, Stephen Hahn, highly respected man, but they're doing everything possible to increase production and available supply of these drugs, not only this drug, but also others that are coming. Remdesivir is coming from Regeneron. A couple of others are also under study. But the one that I'm very excited about right now is the one we just mentioned. And I think there's a real chance. I mean, again, we don't know, but there's a real chance that it could have a tremendous impact. It would be a gift from God if that worked. That would be a big game changer. So we'll see. But distribution starts tomorrow morning early in New York, and I think a lot of people are going to be, hopefully they're going to be very happy with the result, but we're all going to be watching closely. It's something we have to try. It's been very, very successful in malaria, very, very successful. And countries with malaria have had a interesting thing happen. They take this particular drug. It's a very powerful drug, and there is very little semblance of the virus in those countries. And there are those that say because this drug is very prevalent because of the malaria. So we'll see what happens. I'm also announcing that we're postponing the deadline for compliance with real ID requirements at a time when we're asking Americans to maintain social distancing. We do want to require people to go with their local DMV. We will be announcing the new deadline very soon. It's going to be announced in a very short moment. Overnight, we successfully brought home 103 American citizens after they had been stranded for 10 days in Brazil. Following a cruise, we want to thank the Brazilian government and their great president. Most of those returned were senior citizens. My administration, in cooperation with Governor Greg Abbott of Texas, and the private sector coordinated their safe return to the United States. So thank you to Governor Abbott. Terrific governor, terrific man. Earlier today, I signed an executive order invoking presidential authority under Section 4512 of the Defense Production Act to prohibit the hoarding of vital medical equipment and supplies, such as hand sanitizers, face masks, and personal protective equipment. We have a lot of face masks, a lot of equipment just coming in, and we have some people hoarding, and Attorney General Barr is going to be speaking about that in a second. We want to prevent price gouging, and critical health and medical resources are going to be protected in every form. Under this directive, the Secretary of Health and Human Services is authorized to designate essential health and medical supplies as scarce. So he'll designate certain supplies and medical elements as scarce, and that means it will be a crime to stockpile these items in excessive quantities, which is happening to a relatively small degree, we think, but nevertheless it's happening. We can't let it happen. And we can't let them resell them at excessive prices, which some people are doing. Very simply, we will not allow anyone to exploit the suffering of American citizens for their own profit. So we're going to be watching that with our great Attorney General very closely. The Department of Justice will be aggressively prosecuting fraudulent schemes related to the pandemic. Yesterday, federal prosecutors took action in their first case, shutting down a website selling a totally fake vaccine, if you can believe that one. As president, I will always fight to protect Americans from being exploited. Thankfully, all throughout the country, we're witnessing extraordinary acts of compassion, benevolence, and unity. Construction companies are donating masks by the hundreds of thousands. Manufacturing workers are transforming their assembly lines. Citizens are volunteering to deliver food and medicine to the elderly. We're truly seeing America at its best. We're really seeing things that people never thought even could happen. Frankly, we never thought this could happen. But the way most Americans are working toward getting it solved and just doing what they have to do to make this go away has been incredible. It's been incredible. I want to take a moment to thank the everyday heroes who are making our vast effort against the virus possible. And thank you to the healthcare workers and the first responders. These are very brave people. Thanks also to the hardworking men and women of Federal Express, UPS, United States Postal Service, and the truckers who are maintaining our supply chains and supply lines. We thank you very much. Great job. We also want to give our regards and thanks to everyone at our grocery stores working the night shift so that shelves can be restocked, and the restaurant workers and delivery drivers keeping our families fed. So many of these restaurants, it's incredible. They're doing service where people come and they pick it up. Delivery, I mean, it's been incredible what they've been doing. Totally different business than they were in, other than they cook food. Other than that, it's like a totally different business. Most of all, I want to thank the American people for rising to the challenge and showing incredible courage, determination, patience, grace, and grit. From New York to Seattle and everywhere in between, your acts of selflessness and sacrifice and ingenuity are a powerful testament to the American character. It's really being shown. It's really showing up at a level that people are really respecting. All over the world, they're respecting. And the world has problems. We're at 148 countries now. 148 countries are affected by the invisible scourge. And all of the uplifting reflections of the American spirit are out there for everyone to see. Together, we will care for our fellow citizens, and we will win this war, and we'll win it much sooner than people think. And we'll be back in business as a country pretty soon. You'll be hearing about that also pretty soon. Now I'd like to ask Attorney General Bill Barr to say a few words, and we'll take questions in a little while. Thank you.
Let me start by thanking you, Mr. President, Mr. Vice President, for your decisive leadership in this unprecedented battle to save American lives. At the Department of Justice, we're working hard to protect the health and safety of our personnel while at the same time keeping our enforcement efforts at full throttle. So I'd like to thank all of my colleagues in law enforcement, not just those at the federal level, but of all our state and local partners, the police officers, the sheriff's deputies who are protecting and serving their communities, often at great risk to themselves. What I'd like to do here is start with a few remarks about the order that the President mentioned to ensure the availability of critical medical and health supplies from hoarding and price gouging. On March 18th, the President issued Executive Order 13909 invoking the Defense Production Act with respect to the health and medical resources needed to respond to the spread of COVID-19, including PPE and ventilators. We have started to see some evidence of potential hoarding and price gouging. And so earlier today, the President signed a second executive order providing the authority to address, if it becomes necessary, hoarding that threatens the supply of those necessary health and medical resources. Under Section 102 of the Defense Production Act, the President is authorized to prohibit the hoarding of needed resources by designating those materials as scarce or as materials whose supply would be threatened by persons accumulating excessive amounts.
We're going to break in now. The president saying we must restart the economy soon, and it will be reopened earlier than 3 to 4 months from now. For full coverage of the president's briefing, tune into our special tonight, 7 p.m. Mad Money with Jim Cramer begins right now. We'll see you tomorrow night.
This will all end, but it's not going to end at once. It ends when we get all the ventilators we need. It ends when we get gloves and masks and spare ICU beds. It ends when we can test everyone who feels sick. It ends when we feel safe going outside again. Right now, Congress is quibbling over what to put in the stimulus package, but one way or another, it's going to happen. $2 trillion to tide over workers who are getting laid off, save small businesses from going under, and provide some liquidity to large businesses. Remember, nobody in Washington wants the economy to crash and burn in an election year. But legislation isn't enough. You know what we really need? We need demand. Demand from real people. And the thing about humans is they need to be alive and healthy enough to shop and eat and go out to big events, something we excel at as Americans. The problem? That can't happen until we have enough ventilators and enough testing to cover the whole population. The lack of those things in surgical masks are what makes the situation so dangerous and dire. Without them, the patient could die and healthcare providers could get sick. The real risk is that our healthcare system gets overwhelmed. People start dying of otherwise preventable things because we don't have the capacity to treat them. So we need to get this done by any means necessary. Hundreds of thousands of lives are on the line, maybe even millions. I know there's a lot of doom and gloom out there. The highest-ranking New Jersey health official just this weekend said we're all going to get it. Thanks for that. I think our goal should be to not get it. But failing that, you want to postpone getting it until our healthcare system has enough ventilator capacity and hospital beds instead of being overrun, as much of the Northeast already is. I hear people saying that this could last until late summer, maybe even the fall, but that's on us. If we can scale up testing, and Thermo Fisher this weekend tells me that they're shipping 2 million test kits this week, going to 5 million a week in April, we'll be able to ease the lockdown sooner. Worst naysaying of all, I hear that the People's Republic of China was only able to stop this thing because they're an authoritarian dictatorship with no regard for individual freedom. Democracy, we're told, has no defense against this scourge. And since humans have no immunity whatsoever from COVID, they tell us that our freedom will be our downfall. Wrong. Just flat out wrong. The best responses to this pandemic have come from democracies. South Korea handled it almost perfectly. Democracy. Slovakia's got it under control. Democracy. You don't need to be a dictatorship to beat this disease. You just need to get your act together. We're Americans. We may be an unruly democracy, but we can get this right. We simply have to do the work. We have to enforce social distancing. I see the frolickers out in Brooklyn, Prospect Park, Brooklyn Bridge Beach. It's crazy. They're going around like there's nothing wrong. And we wonder why it's become the new epicenter of the outbreak. Here's what I want to do. I want to set a date, a realistic date, perhaps June 6th, D-Day, where we reopen for business in this country. But before we can declare victory, we need to win. So how do we win? First, we quarantine everyone over 65. They cannot go out. They are too high risk. They should have everything they need brought to them. If there's a deadline, hopefully we can start manufacturing ventilators and masks with more urgency. Have the president go to wherever they're making them, please. Give us some hope here, not just a rancorous press conference or two. In the meantime, we need to set up convenient testing everywhere. Parks, parking lots, vacant shopping malls. We got ours in an empty high school parking lot. There's no cars, there's no high school. Every suburb has one of those. If you test negative, you know what? You should get a badge. The badge should last 1 week. Then you get tested again. If you test positive, you go home and you stay home. Maybe take a course of some of the drugs that seem to be working and throw in an online course to keep you from going insane from boredom. If you get worse, go to the hospital. Once you get better for long enough that you're no longer contagious, you get your badge and you can go outside again. We've just got to do what South Korea's been doing. Test, 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 and test. Hey, we inspect cars. Why not inspect people? Once you get your badge, you get some gloves, get a surgical mask, then go out and spend some darn money. And once Congress passes this bailout bill, both businesses and individuals will have some cash. But wouldn't it be better to have actual customers? For that to happen again, we need masks and tests and ventilators. We got to be sure you're safe if you go shopping. Restaurants are harder. We can practice table social distancing, though. Unless you just want to do takeout, which puts money directly into the hands of the business, allowing them to keep employing people, that would allow about 9 customers at my hole-in-the-wall tavern, but 9's better than nothing. At least I think so, since we're paying people anyway. Really, though, what our beleaguered nation needs is a sense of hope. A realistic date would at least give us something to look forward to. However, it's not realistic until the government goes on a war footing and bends over backward to make more ventilators, more masks, and more test stations. If we want a second D-Day, we need to get to work together. Congress, doctors, heck, why not pull 25,000 medical professionals from the military, as they have 125,000 of them? Let's get this second Operation Overlord on the road. Okay, Mad Money tonight. My exclusive with the only publicly traded play on telemedicine, Teladoc. That stock's going crazy. And I'm talking with the CEO of Ventas, the healthcare REIT that owns senior housing centers. That stock's going crazy too, but the wrong way. You don't want to miss it. Spit and pray.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
We know the pandemic has absolutely wrecked the stock market. But even this dark cloud has a few silver linings, stocks that are soaring because they thrive in the new stay-at-home economy. Take Teladoc, the only publicly traded play on telemedicine. Seeing your doctor by video chat is the perfect way to handle the coronavirus. And sure enough, 10 days ago, Teladoc announced a massive 50% week-over-week increase in visits. I'm betting demand has gotten even stronger since then. So it's no wonder the stock has been on fire, up more than 50% since we last spoke to the CEO in early February, including a monster 18% gain today. Can this thing keep climbing? Let's check in with Jason Gorevic, the CEO of Teladoc, to get a better sense of how his company is helping people get well and stay well during this incredibly stressful time. Mr. Gorevic, welcome back to Mad Money.
Thanks, Jim. Good to talk to you, and appreciate your having me on.
Oh, of course. Now, Jason, last week after the president spoke, I got an email which just said Medicare now covers telemedicine. And my first thought was, holy cow, millions must have gotten that. So millions must have said, let's call Teladoc. Did that happen as a chain reaction after that email?
Well, nothing happens quite that quickly, Jim, as you know, but we're certainly seeing a significant increase in volume, and I didn't exactly expect the president to be talking in a White House press briefing about telehealth. If you'd asked me that a few months ago, I would have said that was pretty unlikely. But it's fortunate that we're able to be here for the American people during this crisis.
Now, I mean, that does bring up the issue of the surge in demand. You have a fantastic network, but almost no network can handle that level of demand, can it?
Well, the whole system is definitely under strain, and we are happy to work with our hospital system clients, health plans, and others to try to meet the incredible increase in demand. We're really helping in probably three ways. One is to stand up virtual COVID clinics for our health system clients so that they can safely treat members in their local communities. Two is to bring technology to them so that when someone shows up in the hospital, they can effectively treat them without exposing the healthcare workers. And three, of course, is to provide hundreds of thousands of visits to our millions of members here in the U.S. and around the world.
Now, you can imagine when you go on Twitter, I mean, things people say about me and Twitter so horrible that I've had to adopt the new moniker, Jimmy Chill. But here's someone who said, I understand the unprecedented demand. We are at 8 hours of waiting with no idea of how much longer it'll be. You need to do a better job of setting waiting expectations in your waiting room. And that's Twitter from over the weekend. Is that just an oddball, or is that something you're concerned about?
Well, we have people working literally around the clock. The Teladoc Health employees have been working around the clock to activate more physicians, literally thousands of additional physicians to meet the demand. 8 hours is certainly an anomaly. We expect to be able to deliver care in minutes, not hours, and that's what happens in normal times. Unfortunately, these are not normal times. And so what we're finding is that we are able to get back to people. It may be a couple of hours rather than a few minutes. But actually, I was just looking at data that says our net promoter scores are going up in this circumstance because people are so appreciative of having a doctor to turn to.
Well, I know how important that is. It is very hard to have that kind of move, and that's unprecedented. Now, I did want to ask you, HCQ, the president has spoken about it pretty much as a wonder drug. So, of course, I check in with my doctor, and the doctor says, by the way, you can have dangerous arrhythmias. So what happens with someone who says, I just saw the president, I want this drug, and do your doctors say, you know what, look, there's some side effects?
Yeah, so, our role in the system is to identify people who are demonstrating symptoms and have a likelihood of having been exposed to the condition, and then get them in for testing. Once they're in for testing, then the local provider who's providing that testing is doing the prescribing of medication if they are confirmed for the coronavirus. So for us, we are stopping short of trying to make prognostications, and we leave it to the experts on running clinical trials about what the right treatment will be.
Great, because I do think that there are people taking this drug thinking that it's like taking aspirin. And let me ask you something. You have a mental health, a therapist thing. Now, all of us are experiencing, it's not just cabin fever. We're feeling a sense of loneliness, okay? Many of us have sent our families packing. Many of us are separated from our kids, from our parents, elderly parents. You're saying, please don't come near me. Can you get a therapist?
Yeah, absolutely. We're seeing an increase in demand for our remote virtual counseling services. And, everybody's feeling sort of unprecedented anxiety, and that gets heightened in these situations. And so we are there for people with virtual counseling, where you can remotely connect with a provider. We have therapists who are waiting and available. And that goes along with this what is likely to be an extended period of uncertainty. So definitely an appropriate time to be availing oneself of those services.
That's terrific that you have that. I mean, a lot of us are concerned about mental health to the point of suicide. And that is just so valuable that you do that. Now, meantime, you do have an office in Shanghai, which has gone from being a place that people were scared to death to a place where they want the Disney to open up Shanghai Disneyland again. So, I mean, tell us about what that's like. Is it just kind of back to normal?
So we're really, really happy to hear from our team in Shanghai that they are returning to work. They give us a little bit of insight into what's to come. And we're also in touch on a daily basis with our teams in Barcelona, in the UK, in Lisbon, and we're really understanding how this unfolds. The team in China is, in fact, heading back to work. They are saying that things are returning to normal, and they are giving us a glimmer of hope for what we can expect in the not too distant future.
Well, that's what we do have to hope. Now, I just want to gauge something. In a doctor's office, if one person has COVID, and there are many people closely connected and together, would you expect that some of the other people will get the disease?
Certainly close exposure is a risk, and that's why everyone is recommending at least 6 feet of distance and social distancing. In fact, for us, over 90% of our worldwide employees are working from home at this point. It's only absolutely essential services in some of our countries that are reporting into the office. So we are practicing that. And I was just looking at a case from a thank you note from a mom of a 7-year-old girl who was throwing up in the middle of the night and didn't want to go into the emergency room, but didn't know what else to do. And she was thanking us for being there and avoiding the exposure to what is likely in many emergency rooms and urgent care centers around the country.
I keep getting the same thing. Finally, has the Chinese government helped you at all in trying to figure out what to do? I mean, I know that the people, for instance, at Alibaba are helping us. They're helping us with excess masks. They're helping us with gowns. Has the Chinese government given you any tips? Are things good with them now?
We've been working more with the World Health Organization, with the CDC, and with our insurance clients in China than with the Chinese government. And we're fortunate to have an international network of medical directors who can collaborate on these issues. So we haven't been working as much with the Chinese government. But I think the demand has shifted forever on virtual care. And we're on the verge of a new era for virtual care in the healthcare system.
Yep, I agree. It's never going back, which is why people tell it's a parabolic move in the stock. But boy, you guys are here to stay. That's Jason Gorevic. He's the CEO of Teladoc. Thank you for being there, sir.
Thanks, Jim.
This stock and Zoom, okay? Those are the two that have redefined this year. Yeah, money's back in. long ago, America's aging population was a great secular growth story. Baby boomers, big cohort, you get it. And that's why I spent years recommending Ventas. It's a healthcare real estate investment trust that owns senior housing facilities, medical offices, and R&D centers. But thanks to COVID-19, our aging population is at risk. The virus takes a terrible toll on the elderly, and a lot of people are worried that nursing homes, which, by the way, are in surfeit, might not be the safest places for their parents and grandparents during this pandemic. In other words, checking out. Once that narrative took hold, Ventas stock got obliterated, plunging from $63 in mid-February to $13 and change at its lows last week. The market was clearly overreacting, though, and Ventas has now bounced back to 23 as of today. At these levels, it sports an outrageously large 14% yield. And if that dividend can be maintained, then this stock could be an incredible bargain. So is it safe? Let's take a closer look with Deborah Cafaro, the chairman and CEO of Ventas, VTR, to get a better sense of how our company's holding up here. Ms. Cafaro, welcome back to Mad Money.
Jim, thanks so much for having me.
All right, Deb, I know you as a winner, just someone who consistently, year after year after year, generates a great return. This year, it has been an unfortunate time for you. 63 down to 14, bounce back. I want you to give us the narrative of what you think happened here.
Well, Jim, you nailed it, really. Our businesses all got off to a great start this year. We're in 5 different businesses, all in healthcare, all in seniors housing, and we started off incredibly well. Now, all the businesses in the country, including ours, are faced with the COVID pandemic and the related financial stresses and economic consequences of the pandemic. And so we are really doing our best to focus on the health and well-being of our residents in senior housing and our employees. And we believe we're doing a great job at that. But at the current time, there's a lot of fear, as you know, in the market and amongst our population in general.
Okay, so in February, you announced that you would do a certain number. This is February 20th. And then in March 17th, you withdrew that guidance, which really did worry people. How do you assuage people? Because who the heck knows what's going to happen?
Yes, I think you're right. One thing that I continually point out to others is that we have a very experienced management team, one that has managed and navigated through incredible cycles and disruption before, whether it was 9/11 or the great financial crisis. And we've always come out very strong. We have an incredible balance sheet and lots of strength and stability at Ventas. And that is a factor that obviously is among the most important things to be able to manage successfully through unprecedented times like we're in now. And we're using all the strength that we have in our great team and our great operating partners to make sure that we are focused on having seniors, patients, residents, and our employees come out of this unprecedented pandemic in the best possible condition that they can.
Okay, so let's say I were with you. I know you've got a new person that you like very much has come in. I might say, you know what, Deb? Why don't we take a break? We don't know what the spreading is going to be here. Maybe it's going to spread like wildfire. Let's just suspend our distribution for now and come back when things are better. What do you say to someone like that? Which, by the way, because it's $1.2 billion. I mean, that's not an unreasonable thing to do. I dealt with 2 REITs this weekend that I was horrified that they did exactly what I just mentioned. But they said, what else can we do, Jim? So how do you say to people, listen, I'm going to pay it when maybe some people feel you should suspend it?
Well, as I mentioned, we're in a very strong and stable financial condition. Our board just declared our normal quarterly dividend last week. I think we want to understand the full range of potential consequences here. And there could, as you know, be an upside surprise in terms of duration, a scientific cure. There's lots of financial support that's being provided by policymakers. And so I think there is a lot we don't know yet because we're in a strong financial condition and we understand the dividend's important. our board made a decision to declare the normal dividend, and we will continue to be responsible to all of our stakeholders.
Deb, why did the glut never end? I mean, I thought that you and I had talked. There had to be a certain point where there would just be not too many beds, but not enough beds. But it never happened.
Yes. Yes, well, as I mentioned, our businesses were all off to a very good start this year. We were very optimistic. We saw some of the highest demand in senior housing that we had ever seen. We know the population is growing, and the growth rates really start to kick in 21 and 22. And as we've talked, the supply was delivered in advance of that. So we really believe that the absorption and the demand for senior housing would, over time, really go in our favor.
Right.
And now
right.
we're really faced with this unprecedented pandemic, and that's really what we're focusing on.
Do people go visit their parents? You know, Dr. Fauci has been saying it's somewhat ill-advised to do. And all I can think of is all these poor, nice people in Sunrise, and Dr. Fauci says maybe you shouldn't visit them because you could injure them or, you know, fatally.
Yes. That So that's a very good point, because our seniors are our most important asset within our communities. And we own over 700 senior living communities that the likes of Brookdale and Sunrise and Atria and other really qualified care providers operate. And most of those operators have adopted best practices and/or are required by government authorities to limit visitation. Right now to only essential visitors. And in most cases, those are really employees who are being screened daily before they enter the premises. And most family visits, in many cases, are significantly constrained. Again, all in the interest of protecting our senior population.
And what did you think when you read what happened at that terrible incident in Washington State where so many people passed away?
Yes, I mean, every death of a senior, every death of any individual in this terrible pandemic is a tragedy. And our hearts go out to them and their families. Sadly, seniors are susceptible to this, and all I can say is every effort of our team at Ventas and every effort of all of our partners who are the care providers is really dedicated toward the health and safety of those seniors.
Okay. Anyway, Deb, you know, I wish it were better times. So thank you, of course, for not dodging us and coming right on, because that's Deb Cafaro.
I appreciate it, Jim. Thank you for having us.
Absolutely.
And stay well.
Absolutely. That's Deb Cafaro, Chairman and CEO of Ventas, who comes on in tough times. Markets in Turmoil starts right now.
Good evening, I'm Scott Wapner. On day 85 of the coronavirus crisis, President Trump speaking tonight about reopening the American economy as Wall Street waits for a big move from Washington.
Stocks are falling as the Senate fails yet again to advance its virus aid bill.
Waiting on Washington.
Why are the American people still waiting? It's a good question to ask.
As the markets and America teeter on the brink, Senate leaders battle it out over the stimulus.
We're very close to reaching a deal. We all know time is of the essence.
How long can the markets hold out? How long can businesses and workers hang on without a deal? This CNBC special report, Markets in Turmoil, starts right now. Here's Scott Wapner.
And it is good to have you with us yet again tonight. Another sell-off on Wall Street today after the Senate failed for a second time to push through a massive stimulus bill. The Fed also announced today a barrage of new asset buying programs. When the bell rang, the Dow was down 582 points. The S&P 500 down about 3%. The Nasdaq closed slightly lower. During his news conference tonight, President Trump talked about the distribution of new medicine and reopening the American economy.
At my direction, the federal government is working to help obtain large quantities of chloroquine. And you can look from any standpoint tomorrow in New York. We think tomorrow pretty early, the hydroxychloroquine and the Z-Pak, I think is a combination, probably is looking very, very good, and it's going to be distributed. We have 10,000 units going, and it'll be distributed tomorrow. It'll be available, and is now. They already have it. They're going to distribute it tomorrow morning to a lot of people in New York City. Our country wasn't built to be shut down. This is not a country that was built for this. It was not built to be shut down.
So is the president right? Will America be ready to get back to work soon? With us now is the former FDA commissioner and a CNBC contributor, Dr. Scott Gottlieb. Once again, doctor, it's good to talk to you tonight.
Thanks a lot.
You heard the president tonight. This country is not built to be shut down. Is the president in danger of moving too fast?
Well, I don't know what the White House is thinking in terms of the mitigation tactics, the sort of population-based mitigation tactics that we now have in place, where people are being asked to shelter in place in places where this has become epidemic. Schools are closed, businesses are closed. But this epidemic is going to need to run its course at this point. I mean, New York is having epidemic levels of spread. That's going to continue for some weeks before we see the peak in this. That peak is likely to happen sometime in April, mid-April to late April, probably more likely late April or early May. And remember, this right now is epidemic in New York City. We likely have other large cities that are similarly seeded that are a couple of weeks behind New York. So we're going to see other cities probably have the same level of spread or something close to it as New York. Hopefully not as bad because they implemented some mitigation steps earlier. But certain cities like New Orleans were late to this and seem to have spread right now. And so you have to be very worried that they're going to also have large outbreaks.
Dr. Gottlieb, Dr. Birx tonight in that news conference said 28% of tests in New York City are positive versus 8% elsewhere. It's to the point you're making about the hot spot that New York City is. When is an appropriate time to go back to work? How many weeks are we talking about?
Yeah, well, we're going to have to see this epidemic peak and in those cases come down. And so it's maybe another 6 to 7 weeks till a peak, and in 6 or 7 weeks until it comes down. I think it's going to be very hard to fully take our foot off the brake until you start to see some significant declines in the number of new cases on a daily basis. And there's going to be continued increases in new cases for some time now. We're just at the beginning of this. We're about 2 weeks into this right now. And so what you do towards the end of the epidemic spread is you start to substitute in case-based interventions, trying to identify cases, isolate individual people, as opposed to mitigation tactics where you're isolating an entire population. So you can slowly take your foot off the brake as you introduce those case-based interventions, but you need to have the tools in place to do that, and that requires very massive screening, and we don't have that in place yet. Hopefully by April, May, we'll have that in place and we'll start to be able to make this substitution very slowly like China did. But you can't take your foot off the brake too quickly or the epidemic can flare again.
Do you feel as though the president and the medical experts, doctor, are on the same page tonight?
Well, I don't know. I mean, I don't know the discussions that are going on in the White House right now. I think that there's a desire among some to try to look for ways that we could isolate regions, isolate states, and intervene more aggressively in the places where transmission is continuous and epidemic, and maybe less so in places where it isn't. The problem for the United States right now, dissimilar from China, is that we're likely to have epidemic spread in multiple regions. We have multiple hotspots taking shape. China was able to largely isolate this to the Hubei province. They had outbreaks in other cities, but it really became only epidemic in Hubei province. And so they were able to also move in massive resources into that province and into Wuhan. They literally brought thousands of doctors from other parts of the country into Wuhan. We're probably not going to be able to do that because while New York is the first to fall, we're likely to see epidemic spread in other cities. Seattle looks very hot, San Francisco, Chicago. You have to worry about any city that has a mass transit system because this seems to be spreading through contaminated surfaces. And so mass transit can become a vehicle by which this is spreading. So Chicago, New Orleans, parts of Florida. Florida was late to implement mitigation tactics statewide, and so is Louisiana. So you have to worry about those cities that they're heavily seeded at this point. We're going to need to keep a very close eye on them.
Let me be more plain, doctor, if I could. If the president asked you tonight if people should go back to work in the middle of April, your answer would be what?
No, not in the places where there is sustained community transmission, which is a lot of parts of the country right now, and certainly not in New York. But any place that you see sustained community transmission, we need to keep in place the mitigation tactics, these population-based tactics, until we can break off those chains of transmission.
The other idea to consider is it wouldn't necessarily be up to the president, would it? I could see a scenario in which governors and mayors perhaps would have a very different perspective on what the president would want people to do. How would we manage that?
Well, look, a lot of this has been really led by the governors and the mayors. The governors have been making individual decisions, and the federal government and the White House has deferred to governors on those decisions. So while the White House can issue recommendations on what they think ought to be done at a local level, it's really up to local officials to implement these public health measures. The federal government has some authority to both supersede local officials on implementing stronger measures as well as lifting certain measures. But by and large, this is up to governors. And we've seen a lot of governors act very strongly and early. I mean, San Francisco took some early steps, and we're seeing the growth in new cases in San Francisco be slower than other parts of the country right now, I think demonstrating the benefits of acting early and aggressively. The stronger we are early in this, the less severe this is going to be, and the more ability we're going to have to keep the number of cases at any one time below the point at which the healthcare system gets exhausted and we start to see people have bad outcomes.
Are we still on pace to flatten the curve, or are we getting away from that, and dangerously so?
It's hard to know. I mean, we don't have enough epidemiological data now, enough data points, enough days into this to really know where we are. It looks like we're still on a steep part of the curve, at least as it pertains to the tri-state area around New York, where the case counts are building rather quickly and are likely to continue to build. Remember, the cases that we're seeing presenting right now to hospitals, and that's really where people are being tested. They're not being tested in the community in New York. Those cases are people who might have gotten infected a week or two ago. The time to hospitalization is 9 to 12 days. So anyone being hospitalized now for COVID-19 in the tri-state area probably got infected a week ago. And if you argue that the doubling rate is 4 to 5 days, which is probably what it is right now, because we haven't, or at least what it was 2 weeks ago before we got in place these mitigation tactics, you can imagine that there are a lot of cases right now in New York, and many of those cases are going to present to the hospital now a week or two from now. So this still needs to build some before we start to see it leveling off.
I want to discuss lastly, if I may, Doctor, the notion of a drug that the president keeps talking about. Maybe you call it a cocktail, if you would, a hydroxychloroquine and the so-called Z-Pak. The president keeps saying there's a good chance that it could have a great impact. Can you separate fact from fiction for us tonight on whether this drug should be used right now to treat this virus or not?
Well, look, it is being used. This drug was being used off-label by doctors around the country prior to it sort of becoming the subject of a lot of discussion at a national level. The data, there's both